going to be an OFS as well as a fresh issue that we're watching out for. OFS is likely to be around $800 million, while in terms of the fresh capital, it's at $450 million. Swiggy has filed to the SEBI, and this is a confidential filing for the IPO, but they've gotten an approval for that, is what we're understanding from sources. Furthermore, obviously, 33% stake is what is held by Purses, and other than that, we have SoftBank, which is also likely to be a part of the seller in the OFS. So, keeping an eye out on that. Both these are key IPOs. Swiggy has also managed to reduce losses in the near term that we've watched out for. But let's move on and talk about some of the updates that we're seeing coming in. Mumbaikars are likely to have access to its first underground metro line as early as next week. The ambitious projects of connecting Colaba to Sept is ready for its first phase, and the 12.5-kilometer stretch is poised to be commissioned soon. Depending on its safety clearance, CNBC's Shilpa Ranipeta is going to give us a look on that. Shilpa?
Mumbai's first and fully underground metro line, the first phase of which will start operations in the 1st of October. This first phase between RA to BKC will have 10 stations where 9 trains will run every day, covering a distance of 12.4 kilometers. Today, I'm at the RA station, and let's get a sneak peek into what a ride it's going to be. Let's go. This 8-coach train has the capacity to ferry 2,500 passengers per train, with one train coming every 3 to 4 minutes. Now, once the entire line is fully operational, you can expect this entire line to be able to carry 13 lakh passengers every day. And as more trains are added, expect one train every 2 minutes. But for now, come take a ride with me and let's look at what the train looks like from inside. We all know what a nightmare traffic has been lately in Mumbai. Now, this corridor is expected to cut vehicular trips by 6.65 lakh a day, reduce fuel consumption by 3.5 lakh litres a day, and also cut overall traffic by 35%. And once the entire line is commissioned and operational, it will cut down travel time from Cuff Parade to RA to just about an hour. Now, for travel between Cuff Parade to BKC, don't worry. The second phase is also almost 86% done. Now, this stretch will cover 17 stations across 21.35 kilometers, where 22 trains will run every day. And this is expected to get commissioned by March 2025. And there you will have it, the Mumbai Metro Line 3, or the Aqua Line, that will cover a total distance of 33.5 kilometers with 27 stations, 26 underground and 1 above, and done at a total project cost of 32,275 crore rupees. In Mumbai, Shilpa Ranipeta.
On that note, let's just slip into a very short break. But after the break, we'll get you what's happening in the world of commodities.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative is AI likely to be, or are we on the cusp of seeing that kind of transformation?
Usually when you get new technology, it's applied in the rich world for those who are well off. And what we'd like to do this time with AI is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice and their native language, that we actually bring these AI advances to those most in need. I mean, after all, where's the greatest shortage of doctors? It's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward, even for a topic as complex as nutrition. The AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like to address?
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I, was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was
Welcome back. You're watching Power Breakfast on CNBC-TV18. Now, according to Israel's military, an airstrike on Beirut killed the commander of Hezbollah's missile and rocket forces on Tuesday as cross-border attacks by both sides increased. Lebanon reported more than 560 people had been killed, including 50 children, and more than 1,800 wounded since Israel launched heavy airstrikes on Monday morning. Meanwhile, thousands of civilians have started evacuating parts of southern Lebanon after reports of Hezbollah storing weapons in the region surfaced. Civilians in the region are moving towards northern Lebanon following Israel's warnings. So yes, key updates coming in from West Asia. But let's move on, and Manisha Gupta is joining in with us as always every morning to tell us what's happening in the world of commodities. Manisha, good morning. Gold continues to look pretty and shine bright.
Oh, absolutely, Vinny. I mean, this is one commodity that hasn't had much of a profit taking and has seen one single straight line to the higher side. From the month of Feb, the gains have been quite constant. So $26.60 an ounce now has been taken on. And interestingly, it is the Indian gold prices which are now also trading at an all-time highs above 75,000 rupees per 10 grams. On the ground, in the physical markets, of course, you'll have to pay more in sense of GST and making charges. So the price is almost hitting 676 and 77,000 rupees now for gold there. Well, gold is not just a US dollar story. We also have seen gold making all-time highs in various other currencies as well, like the euro, Australian dollar, and Chinese yuan as well. And it's not just gold again. You have the metal prices which have surged quite strongly overnight. This is to do with the decline in US dollar and the Bank of China governor saying that the bank will cut the RRR by 50 basis points. I mean, the time of that has not been given out, but the sentiment clearly has played into the market. Is the reason you're looking at multi-month highs in many of these metals as well. Silver surged 5% overnight. Copper, aluminum are trading at 2-month highs. We've seen zinc prices gain up by 3% overnight. So everything that can come under the category of metals is blazing.
Thanks so much for that, Manisha. But that's all we have on this edition of Power Breakfast. Bazaar Morning Call up next.
Compete with, open AI and all these people. But, now I'm in the stage of saying, how do I help other people work in AI apply it to those most in need?
Today, in Kabul, a female cat has more freedoms than a woman. The way that this culture, this society has been upended is a cautionary tale for the rest of the world. In the 70s, most of the civil servants were women, over half the teachers, doctors. There were women jurists, lawyers, in every profession. And then the world upended. cat may go sit on her front stoop and feel the sun on her face. She may chase a squirrel into the park. A squirrel has more rights than a girl in Afghanistan today because the public parks have been closed to women and girls by the Taliban. A bird may sing in Kabul, but a girl may not, and a woman may not in public. This is extraordinary. This is a suppression of the natural law. This is odd.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it gets a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down. Inflation is coming down. And relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality. Yeah.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Wednesday morning, bright and early. It's still raining here in Mumbai, guys. I don't know. I thought monsoons were done and dusted, but well, woke up to a kind of torrential rains, heavy rains. But we're coming to you from the CNBC-TV18 Motilal Oswal studios, and I'm Prashant, with me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, morning folks. And it's been raining gains for pretty much in the markets around the world. Incrementally small gains, but nonetheless the color is green. Of course, we had our fair share of volatility. Yeah. Nigel, you called it, right? Yes, we got 26,000 yesterday. Remember, closing bell, I put him, right
in the spot.
In the spot. Got 2,600 and then the volatility. So let's see if we can actually sustain above that mark today.
Well, that's right. And I'm feeling good today. For me, green or red, I don't know. But for me, the color is pink. It's my daughter's birthday. So
little Natara's birthday.
Little Natara's birthday. So for me, it's going to be a special day. But let's get straight to the market action.
Absolutely. And, overnight as well, things are looking a little better. And, they've actually been like that. 1/3 of a percent, 0.5%, in that range, basically, in terms of gains. So nothing to complain. But yesterday, in a blink and miss moment, the Nifty hit 26,000. And it was so blink and miss that actually we had to, the way we figured out is we actually went back and looked at the prices. It had hit about the 26,000 mark. I think actually 26,011 was the high for yesterday. That's a new all-time high. That's a new mark for the Nifty. And then, of course, we saw some selling pressure. So we ended absolutely flat. 25,940 is where we finally left off at. Now, last night, U.S. equities were modestly higher. The Nasdaq, S&P was modestly higher. The Nasdaq was up almost about 0.6% in the green on your screen. The sort of big mover and the outsized influence came in from NVIDIA. And here, you had an article from Barron's, which essentially said that NVIDIA CEO, Jensen Huang, sold about $700 million worth of stock, but he's done for now. I think the last part, which is the fact that he's done for now, is what caused that pop. The 4% move. Now, bond yields were flat, dollar, nothing really going on. Little on the back foot on the dollar last night. As a result, the Chinese yuan is now strengthened and threatening towards the 7 to a dollar mark. So we'll see if it can break above that. Oil prices are trading above the $75 barrel mark. and prices have been very weak and they've been a little stronger, but basically in that $5-6 range is what we've seen this move. I think the continuing conversation, and it happened, of course, when we started same time yesterday, is those Chinese stimulus measures, etc. That was the big theme. I mean, actually, that was the big dominating driver through Asia, through Europe, and actually through last night out of the US as well. It's being described as the biggest sort of set of measures since the pandemic, and it's perhaps it will have a little more enduring effect on commodities and not just like a one-day flash pop. I'll just sort of circle and close this back with levels. Nifty, the levels remain the same. The upside target, the 100% sort of projection of the last move is 26,245. And on the downside, the 40 hourly has moved higher, and that now stands at about 25,694. So about 25,700, 240 points away from where we left off yesterday. That's the closest kind of support. You start to get one or two negative daily closes, and then I think you will start to doubt the market or expect a slightly bigger pullback. For now, that is not really happening, and dips are being bought. Even small dips are being bought. Bank Nifty posted a positive posted a negative close after 8 straight sessions of positive and higher close. And here I'd just like to put the support in, which is the 40 hourly, which is 53,364. Here as well, we made a new high. And I think, above that, it's all blue sky. So we'll see how it goes. GIFT Nifty will come up on your screen, and that'll give you an indication of how we start, 17 points lower. It's the season of IPOs, right? I mean, there is Swiggy, which we will talk about. There is Hyundai, which we will talk about. And there is so much demand for equity that a lot of equity is being supplied as well. So equity supply, I think, is going to be a feature which we will talk about through the course of the day. Surabhi.
Oh, yes, absolutely. And those are mega IPOs that are coming through, right? Yeah. Hyundai is seeking a valuation of, I think, $20 billion for its India business. $3 billion is how much they're raising. So, yes, we'll need money and more money to soak up all of this paper supply that's going to be hitting us. But just to talk about the cues across Asia, they're actually still largely positive. I mean, most of the markets, they're building on the gains that we saw yesterday, particularly the mainland China and the Hong Kong markets. In fact, the last I checked, the Hong Kong Hang Seng was up about 2%. Yeah, it's up 2.5%. The mainland Chinese market is still surging. It's up almost 3%. Remember, and these markets were up 4% yesterday. So in a matter of 2 days flat, you got 7% on the Chinese, key index, which is the Shanghai Composite, and 4 and 2.5. I mean, you've got 6-7% on Hang Seng as well. That's been the extent of the rebound. With a lot of optimism around those PBOC measures and the fact that you'll probably get more rate cuts in China as we go forward. That's actually powering some of the other regional markets as well. For instance, there's a bit of green on the Nikkei. There's some green on the Kospi as well. Talking about those moves, in fact, Prashant, the dollar yuan, for a very brief moment, it did dip below that 7% mark, actually. So 6.99 is what we saw. And that's the strongest level for the yuan in the last 16 odd months. And all this based on optimism, maybe the worst can be over for China and the economy picks up from here on. And eventually the currency starts strengthening. But we'll see how that plays along, because you still have a key rate differential between the US and China. So let's see how these major central banks move. Coming back home, the volatility that we had yesterday was interesting, and let's see if the Nifty can really sail above 26,000 today or not. The opening is likely to be cautious, but let's see if the buyers come in, and then we have a trending up day towards the end of it. Yesterday, it was not backed by major FPI buying. In fact, FIs were on the sell side. They sold off cash equity worth almost 2,800 crores. It was more domestic institutions that were, doing the heavy lifting and the buying, with a net buy purchase figure of about 3,800 crores. A lot of individual stocks are likely going to be in focus, and I think today's action is going to be, at least to start off with, very, very company and stock specific. So just to name a few, Delta Corp, finally they are demerging their real estate business. They'll be listing it separately. There's Easy Trip. We spoke to the management not too long ago, you'll remember, on this very show to talk about their strategic plans going forward. And now sources are telling us that the promoter could be selling up to 8.5% equity. So let's see how that stock reacts. There's MCX, there's revision in their F&O charges. Lots of individual stocks will be in focus. And of course, IPO Street keeps buzzing. Swiggy will be doing its own issue, and I think November is when the Swiggy IPO is likely to be timed. And it's interesting, it was quote-unquote confidential filing, because I think we'll have 1 or 2 more rounds of papers being filed with the regulator till we get the final details on the DRHP. And of course, and there is Hyundai Motors, $3 billion is what they're looking at raising from India. I don't know. all the IPOs, I think they'll be sucking in a lot of liquidity as well. But for now, I think 26,000 is where our eye is.
Well, that's right. On Monday morning, I made this point that since we're going to be gapping up and going by the markers which seem stretched, maybe some kind of consolidation in the near term could have played out. And if you look at it from Monday's high till date, we're up only around 20 points on the Nifty. That's effectively the move. And the other point that we made was that the Nifty Bank needs to lead from here on. And yesterday, the Nifty Bank took a bit of a breather. And because of that, the Nifty, well, it couldn't build on to those gains past the 26,000 odd mark here. The Nifty Bank, that was a relative underperformer. The other technical factor was that it was the weekly expiry of the Nifty Financial Services Index, which has insurance companies, NBFCs as well. So you had a bit of a spike in, the Nifty Financial Services Index before cooling off out there. The good news is that the India VIX, it didn't climb up too much, but in the last 3-4 sessions, it went up by close to 15-16%. So it cooled off a little bit. I don't want that VIX to go out of whack. So it's good, it's stable at around that 13.5 odd. What did the FIs do yesterday? Well, after a while, they added more shorts than long position. I like that. I want to see more shorts in the system. 3 shorts for every 1 long position. 30,000 contracts is what they added. And that's why the short positioning from around 25% has moved to around 28%. What about, the positioning? The FIs, they continue to remain net long, but they've reduced their net long positions by close to around 16,000 contracts or thereabouts. While you have the client positioning, which is still net short, but they've reduced their short positions by around 10 to 15,000 contracts odd. So they're remaining, at opposite ends, but they've reduced, the exposure to the long as well as the short side. Pulling up the options data, well, that'll give you an idea about what the range could be. So we made this point yesterday, 26,000 call, 25,950 call. Both of them are seeing a fair bit of writing at those levels, which is telling us that higher levels the bears want to protect. They want to protect the 26,050 odd mark, which becomes the marker on the upside. Once we get past that, then maybe, in fact, we'll say we're in for another couple of percentage points moves. So that's going to be a resistance mark, 26,050. While on the downside, going by the options data, the 25,700 mark is very, very important. The Nifty Bank, that's the one that plays out the weekly expiry today, the options data of them. And yesterday's high of around 54,250, that becomes a marker. You want to end above this mark, so that's important. And on the downside, 53,500 roundabout, that's an important mark that we're looking at. In terms of stocks I'm looking at a technical factor that plays out here. A lot of those stocks, they're coming out of the F&O ban, and the list comes up for you on the screen. And yesterday, you had a lot of them that came out of the F&O ban. So we'll keep an eye out on all these names for today's trade as well.
Okay, all right, Nigel, you come back here. We'll keep all those cues on board. Let's kick it off then with the equity call of the morning. Sunil Kaul of Goldman Sachs estimates MSCI India profit may grow at 14% CAGR in the next 6 years. He says this reflects India's resilient domestic economic growth backdrop, led by over 6% growth in investments and consumption, amid global moderation as domestic growth has become more important for India's earnings. He says profit pool is likely to shift towards investment cyclicals, and consumer cyclicals could see the highest absolute growth. He identifies 9 preferred growth pockets that span across power and energy, infrastructure, real estate, autos, transportation, housing, and agriculture.
Okay, well, so we'll get you more opinion. And our first on the program is Fook Hin, a senior investment strategist at Standard Chartered Bank. Fook, great to have you with us here. Thank you for your time. Just your thoughts on structure here in India. How are we looking a little draggy now as far as the frontline indices are concerned, or it's good for more? I'm talking about the Nifty, Bank Nifty. Bank Nifty, of course, is just about in the last fortnight made a new all-time high. So what's your sense?
Yeah, thanks for that. I mean, we still do very much like the market in India. India continues to be our overweight preference within the Asia ex-Japan region. And it's really because of the growth story, I think, that's been delivering. We expect that will be continue to deliver. So yeah, we still do like India on a 12-month view. Obviously, in the near term, there's a lot of excitement about China now, where positioning was very, very low. But still, over the 6-12 months period, India clearly remains our preference. Now, in terms of the banks, I mean, our preference in the sectors as financials is one of the sectors that we are overweight in India. And it's really because we think the credit growth would really flow from the economic growth that's going on. That's going to be supportive for the banks in terms of the interest income and the activity they can generate from the economic growth. So yeah, I mean, financials is one of the preferred sectors in India, along with your industrials and staples.
Okay, that's interesting. So industrials, staples, as well as financials, that's what you like here in India. Fook, but just to go back to that point on China, right? Because suddenly there's interest in that market, and we're seeing what it's doing 2 days, 7-8% across different indices. Do you reckon that there'll be more money flow tactically for the short term? I mean, what should we expect from China? Because clearly the PBOC is not done. They're saying there will be more rate cuts and more easing ahead.
Yeah, I mean, our expectation has been that the policy support will be ongoing and consistent, but just enough to keep the economic growth stable, right? We're not looking at a big bang, kind of a policy rollout to really stimulate the economy massively. But we're looking at consistent, very targeted policies that's going to be ongoing in terms of how it can keep the economic growth stable. Look, I mean, the policy that was being rolled out on Monday, I think it has taken the market by a bit of a surprise, and that's why we saw a very strong reaction. We think positioning was very, very low in the China markets, and so the policy that was being rolled out, I think, gave a bit of reason. So tactically, we think it can still go up. Valuation is still cheap, especially for the Hang Seng Index, still below 10 times. So coming up to 20,000, that could be a technical resistance for the Hang Seng. So in the short term, yeah, there could be more excitement in terms of the policies, what might do, including some support for the equity market investments as well. But longer term, in terms of consumer sentiment, right, I mean, mortgage costs will come down because of monetary policy easing, but there's still worries about the property market, and that's really still weighing on sentiment. We need to see the property market stabilize before the consumer sentiment can really pick up. So on a 6 to 12 month view, we're still neutral on China equities. I mean, we do like equities globally, so we say they'll be invested in China because, you know, if you blink, you miss the rally. Big days like this helps to be invested. But we do have a core view on the 6-12 months. We think the growth in areas like India will still trump, and so it becomes much more important.
All right. Hi, Fook. Good morning and good to see you in. So you're sounding way more positive on India than China, though in the near term, very near term, you're saying maybe China, because of its underweight stance, could outperform. Though in the next 1 year, you're still expecting India to do better. You know, you're overweight on US markets as well, I think, and the tech sector is something that you like out there. What about the Indian tech sector? You know, that as well has been fairly resilient. There are calls that maybe, in fact, growth starts showing up from FY26 onwards. Your take?
Yeah, I mean, we've got a neutral view on the tech sector in India, really. I mean, as I said, our preference is for those 3 sectors, as I said. And I mean, yeah, that's the tech in terms of how we were looking at it. AI is still going to be a very big thing. And that's where the focus is really going to be in the US, where they are very much at the forefront in terms of the investments. We're still very much in the early days, we believe, in terms of the AI investments. So the US technology sector is still where we prefer. And besides the AI investments and semiconductors, there's also the software. You know, there's a very stable, defensive, recurring growth that we see in the US software companies.
Okay, Fook, finally, just a word. I don't know how closely you track autos across the region and whether you like that space. Just wondering, because Hyundai is looking to list its India business, and it's likely to be one of the biggest, you know, primary issuances we've seen in this country. They're apparently aiming for a $20 billion valuation. So just any thoughts? I mean, whether as a foreign investor, whether you'd like to buy the stock in the home market, or whether you'd be interested in, you know, specific listing in India and then buy here, irrespective of the valuations because of the growth.
Yeah, I mean, I'll shy away from talking about single stocks just because I wouldn't do that on TV. But look, I mean, in terms of the auto space, we think that the exposure to India is great. We've seen some of the Japanese companies with exposure to India that's been driving it. That's been very, very positive. But the space within the EV and the transition within that, price competition has been very, very cutthroat. And so we're looking in terms of how the Chinese automakers are very much leading in terms of the EV space. But price competition is a very big thing. But volume growth is still growing. But the trend, as you know, in the US, it is coming down a little bit in terms of the preference for EVs. But then within China, they're still definitely leading it. But in terms of the flows, cross-border flows, there's a lot of nationalism coming into play as well. But within the whole space, I mean, we'd be more targeted in terms of the auto companies to get exposure to.
Okay, all right. Fook, great talking to you today. Thank you very much for joining in, and wish you a good rest of the week. Well, we have a lot of stock-specific action to track today, so let's just talk about the list. In just a while from now, you'll hear more on MCX, HDFC Life, Delta Corp, Sarda Energy and Minerals. There's Hariom Pipes. A lot of these companies are raising fresh money. That's why they're in focus. Car Trade Tech. All of these on the back of positive news flow. And then there is Easy Trip Planners, KC International, Gillette India and Shilpa Medicare. Maybe these stocks start off negative, and we'll tell you why in just a minute after a quick break.
So my question is all geopolitics, which may determine the state of the economy. Okay. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries get involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate, the vicissitudes of the economy. But we are spending a lot of money, and in my view, that spending the money causes growth. It also causes inflation, and whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm put me on the cautious side of that one.
Welcome back. So we got you a sneak peek into our top 10 list. Let's straight away get to the action then. Now we have our research team standing by with all the stocks that you should keep on your radar today. Guys, good morning to all of you. Vivek, let's start off. Easy Trip Planners. Interesting development you're picking up there. Tell us more.
Good morning. That's right. So two stocks on the radar. First, we'll start off with Easy My Trip. Over here, there's a stake sale happening. Block deal expected, pre-market. The promoter, Nishant Pitti, is looking to sell up to 8.5% stake in the company. Indicative issue price for this particular block deal is at 41.5 rupees a share. So the block size could be in the range of 580 to 622, depending on the price range at which the block deal happens. Remember, Nishant Pitti held close to 28.1% stake in the company at the end of Q1. The other stock on the radar is KC International. Remember, the company had taken an enabling resolution to raise up to 4,500 crore after the Q1 results, but the company has launched a QIP and they're raising just close to 870 crore this time around. Indicative issue price of close to 955 rupees a share. Equity dilution at 3.5% of the existing share capital. The company says they will be using the proceeds both for debt reduction as well as for general corporate purposes.
Okay, got it. Thanks a lot for that, Vivek. Well, let's hop across to Vamakshi. She's here to tell us about MCX and HDFC Life. Morning, Vamakshi.
Well, good morning, Nigel. Let me first start off with MCX. MCX has revised the transaction fees for futures and options contract with effect from October 1st, and this is to comply with SEBI's True to Label norms. Now, the futures transaction fee will be revised to 2.10 rupees per lakh of turnover value as compared to 1.75 to 2.6 that we saw earlier under the slab-wise fee structure. The options transaction fee will be revised to 41.8 rupees per lakh of premium turnover value, and with this earlier was around 40 rupees to 50 rupees. The company earlier had said that the impact for exchanges will be neutral, but Morgan Stanley, who has an underperform call on this counter with a target price of 2,950 per share, says that ceteris paribus, the rise in transaction fees would actually result to a 5% increase in the FY26 CPS, but it will be important to watch out for the impact that this has on the volume. So, given those factors, going with a mild green for MCX. HDFC Life is the next counter I'm watching out for. Capital Raising Committee will be meeting on September 27th to finalize commercial terms for 2,000 crore issuance of subordinated debt instruments, and this in turn will supplement the overall capital for the company, and given that, going with the green for HDFC Life.
All right, Vamakshi, thank you very much for that. Well, let's move on to more names. Delta Corp, Gillette India, Shilpa Medicare, all with news. Vinny's here to detail those out. Vinny, morning.
Good morning. So yes, starting with Delta Corp, we could maybe see some value unlocking coming in. So a positive sign is what we're expecting for Delta Corp. The board has approved the demerger of its hospitality as real estate business as well. And this will be penned and kept under the name Delta Penland. Now, so this is the ratio of exchange that they'll be getting in terms of shares. One share of Delta Penland will be allotted to every shareholder who's holding one share of Delta Corp. So yes, positive signs expected here. Gillette India, that we're expecting a bit of a downside in Gillette India because its Bangladesh distributor has terminated the agreement. This is going to be with effect from 31st of December 2024. The net sales for that was around 2%. So maybe we could see that bit of an impact coming in the net sales for Gillette India from Jan 2024. So keeping an eye on that. Lastly, Shilpa Medicare also in focus, expecting a bit of a downside here as the promoters have pledged around 3.49% stake in the company. A list of promoters are there. Overall total shares is 34.25 lakh shares. So keeping an eye on that.
Okay, all right. Thanks a lot for that, Vinny. Well, let's go back to Vamakshi and she'll wind this down with some more stocks that are in the news. Vamakshi.
Well, absolutely, Nigel. Let me first start off with Sarda Energy. The company has received a nod from Chhattisgarh Environment Conservation Board, and this is for expansion of production capacity of Garre Pharma coal mine from 1.44 MTPA to 1.68 MTPA. Given this development, going with the green for Sarda Energy. Hariom Pipes is another counter that I believe will be opening in the green, and that is because the board has approved a 700 crore fundraising plan via multiple modes, which also includes QIP. The company also has given nod to increasing its authorized share capital from 40 crores to 50 crores. So given this development, going with the green for Hariom Pipes. And lastly, let's also focus in on Car Trade Tech. There was a block deal yesterday. Hydel Investment, which is a unit of Warburg Pincus, sold its entire 8.6% stake in the company through a block deal at 920.3 rupees per share. And overall, this block deal was at a little over 375 crores. This was done through an open market transaction. On the other hand, we saw Mery Asset Mutual Fund pick up nearly 6.4% stake in the company in 3 tranches at an average price of 920 rupees per share. So given that development, going with the green for Car Trade as well.
So Warburg selling and Mery among the major buyers, domestics buying. That's been the trend in major blocks of late. Vamakshi, thank you very much for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are MCX, HDFC Life, Delta Corp, Sarda Energy, Hariom Pipes, Car Trade. Stocks that have negative news flow around them, KEC International, Gillette India and Shilpa Medicare. Okay, all right. So that's the stock list for the morning. Let's now look at the commodity cues that we're getting. And we have Manisha Gupta joining in with a roundup of all the action. Manisha, good morning.
Morning, and thank you for that, Survi. Well, a huge run-up is what we have seen overnight in commodities, and that has been extended in the Asian markets right now. The gold price is hitting an all-time high yet again, and this time around above $26.65 an ounce. India gold is expected to open at an all-time high as well. Yesterday, we saw 75,000 for the first time ever. Well, there is trend that has continued for various other commodities also. Silver prices gained up by 5% overnight, and you have a multi-month high for many of these base metal prices, where copper is trading at a 2-month highs, aluminum at a 3-month highs, and zinc at 4-month highs. And strong gains have continued for energy as a space as well, where crude oil prices gained almost 2% overnight, with the dollar index at a 14-month low, there's a lot of support coming in for these commodities.
All right, Manisha, thank you very much for that. So that's basically commodities in focus. So maybe, a bit of a bid under commodities and metals specifically because of what's happened in China. We'll take a quick commercial break here. We're going to come back with a special conversation. Ajay Singh, CMD of SpiceJet, will be speaking with us. They've raised 3,000 crores via a QIP. That conversation up next.
Welcome back. Well, cash-strapped airline SpiceJet has raised 3,000 crore rupees via its recently concluded QIP. The airline plans to use these funds to revive the grounded fleet, acquire new aircrafts, and also expand into new markets. I caught up with Mr. Ajay Singh, the CMD of SpiceJet. I began by asking him about the utilization of this QIP and whether the company needs any more funds. Let's hear him out.
In our view, this money is more than sufficient to fund our business plan for several years to come. We are in this process of reviving the airline. We are currently roughly in the same position that we were in 2015. And the plan, just like in 2015, is to expand quickly. We are flying about 28 aircraft, and the idea is to get to 100 aircraft over the next 2 years. We believe that this fundraise suffices for us to achieve that objective.
Well, the problem this time around is the competition is far more stronger. Between the Tatas and Interglobe, there's close to 90% market share out there. So it'll be interesting to see how do you get to that 100 fleet mark. But let me ask you a couple of questions with regard to what you said. To basically get to your growing ways, you require pilots, slots, and you need to have good lessor relationships as well. All three on board?
SpiceJet already has pilots more than the ones that are required to fly the current fleet. We also have a very strong pilot cadet program. And we showed in 2019 that we can add 32 aircraft in 6 weeks and provide the pilots and the crew for that. So we don't think that that's going to be at all a challenge. We already have several pilots that had left SpiceJet for other airlines seeking to rejoin SpiceJet since the news of this fundraise has become public. So I don't think that's going to be at all a challenge. In terms of lessors, we faced again a similar situation in 2015. Lessors were owed significant amounts of money. We found amicable settlements with all our lessors, and those lessors came back and did significant business with SpiceJet in that period after 2015. So we are very confident that we can replicate that again. We have already settled with our largest lessors, and everybody is, I think, is raring to go and start doing business again.
All right. So by when do you get back to 5,000 flights? You were doing that earlier this year. I think that number has come down to sub 3,000. How soon can you get back to that run rate?
Well, our plan is to get up to close to 40 aircraft by the end of this financial year, and to get up to close to 80 aircraft by the end of the following financial year. So we will stick with that plan, and I think that you will see that 5,000 flight number in the not too distant future.
I want to quiz you a little bit more on the employee salaries, but we'll keep that for a little bit later. Let's talk about market share. Market share has been sliding from around 6% in maybe November 2023. You have come down to sub 2.5%. Where do you see this number go to, Mr. Singh? You just mentioned that when you bounced back, I think, to 15-20%. So what's the goal? What's the outlook from here on? You're going to be adding fleet. You believe things are in place. So give us the guidance on that number.
So, I don't want to give you market size numbers. I don't want to give you market share numbers. We need to add planes in a market that clearly can absorb much more capacity. We will do that at the fastest pace that we can, and we will do it in a profitable manner. Our commitment to our investors is that we will run profitable operations and grow our size over the next 2 or 3 years. I don't want to give market share guidance. Market share is what it will be, and it will, of course, keep increasing as we add planes.
All right. If I look at the outstanding dues prior to this particular issue coming out, the presentation that you've put on the stock exchanges indicates that you have some outstanding dues of around 3,700 crores and roughly around 600 crores odd statutory dues. What do these numbers come down to from these numbers that you've already disclosed? How much of a relief do you get?
So, of course, the statutory dues will be paid in full. In terms of lessor dues, we are in constant dialogue with them, and we are finding settlements with all of them. We've already found settlements with some of our largest lessors, and that 3,700 crore number will come down significantly. That's our estimate.
You want to quantify significantly from 3,700 by the end of this year? What does it come down to?
I don't want to, because those are discussions, Nigel. Those are so those are discussions that are still ongoing. We have presented an estimate to the investors, and I think that we will outperform that estimate. I think one other interesting thing I want to say is that look, we are an airline that had a market cap of around 4,000 crores. After this issue, that market cap is going to be close to 10,000 crores. And at this point as well, we think that there's a lot of space for that market cap to grow. The market leader today is at 200,000 crores. So between that 10,000 crores and that 200,000 crores, we think there's a significant opportunity for SpiceJet and its shareholders, and we believe that the stock is bound to be re-rated in the space.
You mentioned that you're looking at profitable growth, and part of the investor community, they believe that the PBT could be in that vicinity of around 700 to around 750 crores in the next 3 years. Do you think that they're headed in the right direction?
I think broadly the direction is right. I think we will try and surprise them on the upside. And that's all I can say. We think that this is a terrific market, a terrific sector, and there is a clear shift happening, Nigel. More and more people wanting to fly, and despite all the growth that the sector has seen over the last few years, today only 5% of India flies. That number is clearly going to change. You see all forms of people, all strata of people now trying to take flights. And as Government of India, through the Airport Authority of India and state governments, add newer airports in small towns, you will see, and we've seen this, that the moment you start a flight in a so-called small town, there is great appetite for those flights. including, flights to international destinations. I think as we go forward, people who live in smaller towns, the so-called tier 2 towns, will not want to come to big cities to take international flights. They will want to fly directly from their towns into international destinations. So you'll see some of that. You will see new destinations opening up both domestically and internationally. And you will see many, many more people who today go by trains starting to fly. So this 5% number is I think, terrific underestimation of the potential of India. And in a few years, I will not be surprised if that 5% number rises to 10, 15, or even 20%.
Well, that's a part of the conversation that I had with Ajay Singh. Later on, he also tells us that all employee dues will be paid. The airport dues as well will be paid, and he'll clear out, any kind of dues to the oil companies as well. So that will play out later in the day. But let's get in Deven Choksi, the MD at DR Choksi FinServ, who joins us on the show. Hi, Deven. Good morning and good to see you, Ben. Well, Mr. Singh is promising great things. He's sounding very, very confident. And the good news for him is he has the industry tailwind, which could be part of the reason why he could raise this money. Otherwise, if crude oil prices were up and the travel and tourism space wasn't booming, it would be very, very difficult for him. What's your take? Do you think he can do what they did in 2015 to 2019? Or would you say, why should I get into all this hassle of outstanding dues and leverage books? Just stick to the leader. Your view on SpiceJet at around 65 rupees.
Yeah, Nigel. Good morning. Well, on one side, there are promises. Definitely, I think this particular company has done it in past. They hold future as well. I think they would probably do it. There is no doubt about it. And the way in which I think they are working on the max, I guess I think they are probably on a right track. Adding the new aircraft, a number of passenger seats getting added. At the same time, having the ground infrastructure in place, including the parking slots. I think these are some of the very fundamental things which this particular airline is already having. Fortunately, the operating cost through the ATF, I think, is remaining under control. And should it remain under control for a longer period of time, it's a big, big boost to most of the passenger aviation companies who are vulnerable to this particular cost. I guess I think this company is probably likely to see the better times going forward. How soon, how fast, how best it will happen, I think we all will witness it. But I think the promises are there. And fortunately, the market is, I think, favoring them. Today, there is a requirement for more airlines, I think, in the country. And that's what I think is giving them chance. Indigo definitely remains the leader. And I think they have got their corrective strategy in place. Come Air India, I think they are equally, I think, well placed in this particular space now. So in my viewpoint, I think competition will always be there. But at the same time, I think the dominance of the top end of the players would be high. But at the same time, I think the last leg of the tier 4 legs of people or the airline companies would probably have equal chance to probably come up to a level at least they were operating in past. So SpiceJet could be included in that. So we don't have the recommendation on this company. But I believe that I think as a sector, we find this is a positive trend that is going forward.
Okay, all right, Devin, stay on. We have lots of other questions for you as well, but we do need to take a very quick break. No, I think we can actually squeeze in my director tells me you can squeeze in a question before the break. Morning, Devin. So the stock in focus is Delta Corp, right? There's so much going on with the company. Now we know that finally that demerger of the real estate business is happening. They're listed separately and issue proportional shares to investors as well. 1:1, I think, is the ratio. What do you make of everything that's been happening with Delta Corp, the GST issues which are outstanding, but they're very confident that that demand is not going to hold up, that 22,000 crore rupee demand. And now this move towards real estate and hospitality. What's your take on the stock?
Good morning, Suji. As an outsider, I think not an investor in the company, nor I think analyst who is covering this particular company. I think as an outsider, I find that I think the restructuring that they have proposed, I think is probably working well. Demerging the hospitality part of the business and the real estate part of the business is definitely, I think, making sense because on that side of the activity, you have the support of larger funds, I think, who would possibly, I think, fund this particular expansion or the growth that they want to bring in. And I think the gaming business part, which they are already holding it faces its own challenges at the same time. But since we don't cover enough, I think, on this subject, would refrain from commenting on that subject per se.
No, I've got that, Devin. Devin, good morning. Thanks for joining in. Just a quick word, Devin, on metals, which has been the big mover yesterday. The index was up about 2.5%. I think, what we saw yesterday, that we saw something similar in Europe as well, overnight as well. Of course, it all ties back to what China has done. What's your sense? What's the best way to play this? We don't know if this will be a lasting, enduring move, but maybe a tactical one. But even then, what are the best ways?
Yeah, Prashant, good morning. So leave aside China for a while. I think it definitely helps in global environment for strengthening of the commodity prices, no doubt about it. But the other factors are equally strong for Indian metal companies per se. On one side, the demand scenario remains upbeat and quite strong because of the government spending, because of the industry spending, and the larger amount of social infrastructure along with, which is coming up in the country. So to a greater extent, I think the demand scenario remains upbeat. On the other side, the structural changes are happening in the energy cost. As more and more companies resort to higher amount of renewables and that too for the captive use, I believe that the cost of energy will remain under control and maybe I think it will come down eventually. If you are taking a directional call of next 3 to 5 years, I think systematically it will come down. Given that situation, your profitability in the commodity business, which is extremely important, is going to be assured. And that is what investors like. I think if they see the sustainability in the profitability, probably I think they love to buy this kind of companies. I believe that I think the structurally things are working in favor of metal as a commodity. Of course, this China liquidity booster is definitely helping stabilizing the global prices. And that should work in the near term for the companies, which up till now I think have been a little bit more circumspect about. So such situation would definitely favor. But otherwise also fundamentals are shaping up well for the metal commodity. So one should remain positive about this space and maybe every correction or a dip may be an opportunity to add more into the portfolio for next 3 years.
All right, Devin, got it. Do stay on. We'll come back in just a bit. Right now, a quick break. And also, we come back with some technical perspective on the market. What are the trades you can look at? Mitesh Thakkar and Sudarshan Sakhani will join in.
President Zelensky, Prime Minister, recalled his visit to Kyiv, their discussions on all matters, the bilateral issues as well as issues surrounding the Russia-Ukraine conflict. President Zelensky was very appreciative of India's attention to these issues and said that Prime Minister's visit had been highly appreciated, and he thanked the Prime Minister for the efforts that he was making for peace and a pathway to finding a way out of this conflict. Both sides appreciated that there was positive momentum on a lot of issues in the bilateral relationship, and they agreed to remain in close touch, either directly or through exchanges of visits at various other levels. So far as your question related to oil is concerned, that did not figure in the discussions today. As I said, this is the third meeting in between the leaders in the last 3 months or so. A lot of the issues have been discussed, but at this particular meeting, this particular subject was not discussed.
Welcome back. Well, we're still in conversation with Devin Chowksey. Devin, I wanted to ask you about the upcoming IPOs, and the street is looking forward to them, Swiggy as well as Hyundai. Let's focus on Hyundai first, because we have a lot of listed entities that's from the auto pack. What's your view on it? And what kind of impact it can have on Maruti? I was looking at one matrix which says that a third of Maruti's volumes come in from the SUV segment, while for Hyundai it's already around 2/3 odd. So Maruti has that scope for growth. It'll be better realizations if they can go to higher in terms of a contribution coming in from SUV, which will mean better profitability as well. What's your view on Hyundai, and how do you think? Would you rather prefer Maruti?
Yeah, Nigel. Well, I believe that I think both these companies will have an equal opportunity to play around. Maruti is already around at 4 lakh crore market capitalization, well positioned in most of the portfolios of the investors, including their mutual fund portfolios. Hyundai is a new paper coming up, and given the kind of inflow of money which the mutual funds are attracting, there is going to be enough space for adding one more company into the portfolio for sure. So from a perspective of, I think, buying the liquidity in the market, I think this particular answers the point here. But more importantly, on the fundamental side, I think the premiumization point that you touched upon. Maruti is certainly, I think, talking about scoring high numbers on the premiumization. And they are also talking about the penetration of EV through a very systematic ecosystem creation coming 2025. I believe that I think that's where Maruti holds an edge to an extent. But at the same time, I think this particular company is already there in the premiumization, and I think for them to get into further is definitely, I think, a good choice, because as we are seeing the progress in the country, the consumer is moving towards the high end of the vehicles, call it SUVs, call it, I think, the better segments, I think, within that particular thing as well. So from a perspective of, I think, looking at both these companies, I would remain distinctly optimistic about the prospects of both these companies. In fact, Tata Motors, Maruti put together, I think they are somewhere around close to 8 lakh crore worth of market capitalization. I wouldn't be surprised if Hyundai registers the case and I think goes closer into that particular territory. Maybe in the near term, I think you might have a little higher score for Hyundai and I think little lower score for Maruti as far as the stock price is concerned. But I believe that I think this particular move is likely to sustain with a higher market capitalization possible for all three companies.
Nigel, I was reading this article. I think this is the Times of India. I don't have the name. It says it's interesting and maybe a little worrying at the margin as well. Offtake of SUVs priced above 20 lakh rupees is down 18% in the first 5 months of FY25.
Okay.
So looks like the big, maybe it's just sort of too much buying which has already happened. So
Indeed.
It's a bit of a cool off. I think. And stocks have done very well sort of recently, especially names like Mahindra. Maruti, maybe not that much. Mahindra has done very well. But this is something which we will pursue. So the headline struck out. I mean, SUVs priced about 20 lakh. In the first 5 months, sales are down about 18%. And I think that's a number from SIAM, which the article is actually quoting. Devin, so just a few other names I want to throw your way. Telecom, I mean, if you can weigh in, Bharti Hexacom fell sharply yesterday. It was around about 5-6%. And of course, I mean, all which is happening with Vodafone Idea and consequently implications for a name like Indus Tower. What do you like there?
Prashant, I think it's a good challenge to, I think, go into this particular space now. You already have two established leaders, the Jio and the Bharti. And I believe that I think this is where you should be putting your, I think, focus on. Because globally also, I think if you look at the established players, first two players, I think they hold maximum amount of market share. And this is what these two companies have captured. Look at, I think, what Vodafone is doing. Look at what BSNL is doing. They are investing money in 4G to begin with, and then they will be scaling up to 5G. Yesterday was 4G, today is 5G, tomorrow is going to be 6G. The network of Jio and Bharti is ready for 6G rollout going forward, and they are already 5G rolled out. So obviously, I think to me, the companies which are basically positioning for tomorrow, they are going to be the preferred choice. Also look at the numbers. On 120,000 crore worth of revenue for Jio, there are 60,000 crore worth of EBITDA already making into this particular proposition. Rest of the companies, including Vodafone, definitely I think we have to struggle to come to the profit level first. So my take is that I think very clear choice. I think stay with the leader at this point of time. Business is actually going to grow at the compounded rate of around 18 to 20% for them. So that's where probably I think we would continue to hold the position in these leaders.
All right, Devin, we'll leave it there. Thank you very much for joining us. Good conversation, as always. Appreciate it. All right, well, let's get you the technical trading ideas as well. Mitesh and Sudarshan are with us with exactly that. Gentlemen, good morning. Great to have both of you here on the program. Thank you for joining us. Mitesh, first to you. Blinken missed 26,000 moment yesterday. Will it be more enduring today? What's the trade?
Morning, Prashant. Well, I think, one, I've highlighted it's around number two. I think there is a lot of open interest around this 26,000 strike. So maybe, a couple of days there will be some struggle. Also, we've had a good rally. We are slightly overbought, so some profit booking can happen. Yesterday, I advised booking about 1/3 of long positions and then buying back on declines, and the other way is that in case we see the Nifty spot getting past 26,000, 35, 40 zones, then you might take a 70, 80 point kind of a reasonable stop loss and take a long position. So the idea is that the trend is on the upside, but we have hit an important level. There could be a chance of about 100, 150 point kind of profit booking led decline, and that will be your chance to buy. This same situation is happening on the Bank Nifty, which has also rallied and is now slightly overbought on the hourly and 2 hourly charts.
Okay, all right. Hi, Mitesh. Good morning. What about individual stocks? What are you looking at?
Yeah. So on the individual stock side, I have a mix of buys and sell. Nigel, good morning. ABB, I think after a good consolidation is breaking on the upside. So keep a stop at 79.75 for targets of 83.30 to about 83.50. Also a buy on Hindalco. Metals were buzzing and we had buys on Tata Steel and NMDC, etc. yesterday. Hindalco is a buy with a stop at 705 with a target of 742. Disclaimer that I have some call options position, so there is vested interest in this stock. A sell on Grasim with a stop at 2651 for targets of 2540, and a sell on Coromandel Fertilizers if it breaks the pivot of 1655. I think it's closed at about 1662. So sell below 1655, keep a stop above 1690, look for a target of below 1580.
Got it. Okay, all right, Mitesh, thanks a lot for that. Well, let's hop across to Sudarshan. Morning, Sudarshan. Good to see you in. How do you approach trade? It appears yesterday we hit that 26,000 mark and we quickly pulled back. But the trend still seems to be up. What would you do at these levels, or would you wait for a bigger dip to get in?
Yeah, good morning. See, the trend is up. The market is consolidating because we had a very big move last week. The markets are not expected to, oblige us by going 200, 300 points every day. That doesn't work out. So this consolidation can take place for any number of days. Maybe it will end today. Maybe it will continue all the way to next week. I can't say that. But the trend is up, as you said, and as we have been saying for a very long time. So in an uptrend, there is only a single trade available. Look for a small dip and go and buy it. Today also, I would suggest that look for an intraday dip for about 100 points from the opening price. And that's an approximation. It could be 90 points, 80 points, whatever. And if you get that dip, go long in the Nifty. Don't take any other trade. Wait for a dip and buy.
Okay, so buy the Nifty on dips. That's the strategy and the call. Sudarshan, hi. So let's also talk about stocks, individual stock trades for you today.
Sure. See, there are a lot of opportunities coming because the market, while the Nifty does its own thing, there are many stocks which actually have minor corrections even as the Nifty was going up. So I have a long list of these stocks where a buy on dips opportunity is coming. Vedant is a buy with a stop under 437. Astral, the theme is the same. All of them are dips. Astral is a buy with a stop under 1905. BHL is a buying opportunity with a stop under 260. And NMDC is a buy with a stop under 208.
Okay. All right. Got that. Thank you very much, gentlemen. We'll take a very quick break on that note and come back on the other side. We'll have the pre-open trades joining in. And also, we'll get a chat going on the big metals rally that we saw yesterday. Parthav Jhonsa of Anand Rathi Institutional Equities will join in to talk about the outlook.
news which just came out, a government-to-government deal between US and India to set up a semiconductor fab unit in the country.
Right.
There are elements of technology transfer, etc. That's the cutting edge semiconductor and sort of plans to localize production. I just wanted your thoughts.
I think it's great. I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to
Okay, we'll start getting the pre-open rates in the next couple of minutes. As we do that, let's also look out for some F&O market action and perhaps some trades that you could consider over there. Rajesh Palvia, VP Technical and Derivative Research at Axis Securities, is joining in. Rajesh, good morning. So what calls would you go with today?
Good morning, Sulbi. So looking at the expiry for this series, it's on a bullish note, and Nifty almost gained 2.5% and Bank Nifty gained around 5% for this series. So it's turned as a bullish series for the month, and looking at the data setup, long built up is clearly there in both the indices. And the way rollover action is taking place, we believe that, furthermore continuity of uptrend we could see in the beginning of the new series also. Looking at the data setup, the major put-based concentration for Nifty is placed at 25,900, 25,800 zone. So these may act as a good support area for any kind of minor dip if we get in the market. So buy on dips is the strategy. We are focusing to buy 25,950 call option, which was closed at around 92 rupees in the previous day. And we are projecting target towards 155 to 160 for this call option, as we believe that, expiry may, be around 26,000 or 26,100 range. So this call option one can focus with stop loss of 50 rupees. So 25,950 call option we are focusing at this juncture. Bank Nifty is also looking promising. Until Bank Nifty is holding above 53,700, we believe that, this momentum can extend, and possible target for Bank Nifty 54,500 to 600 we can see in the near term basis also. So here also one can look for, going long in the Bank Nifty also for minor dip. On the stocks front, we believe that, some traction we have already witnessed in the previous day on the IT side. And we believe that, IT stocks can do well. And TCS, after this correction, has shown some sign of recovery from its important support area. So TCS one can look at to buy. We are projecting target towards 4350 to 4380 for trading point of view, and keep your stop loss around 4235 to buy TCS. Another stock that we like is from pharma space, that is Biocon. Stock came out from the Bain period, and again the way stock has moved up in last 3 days. Now stock is comfortably holding about 20-day moving average. We believe that, Biocon can extend its gain, and possible target towards 390 to 400 we can see in a short period of time. So Biocon is buy with stop loss of 365. And the third stock is from the capital goods, that is ABB is looking promising. Stock managed to give breakout of long consolidation. In the previous day, very strong buying action. So we believe that, ABB can extend its gain. We are projecting target towards 8200 to 8250. So ABB is buy with stop loss of 8030.
All right. Thanks a lot for that, Rajesh. Appreciate you joining in and giving us those calls on the index. Wishing you a good day ahead. But let's turn the spotlight on the sector that's sparkling. That's the metal index. We have Parthiv Jonsah, the lead analyst, metal and mining at Anand Rathi Institutional Equities, who joins us on the show. Hi, Parthiv. Good morning and good to see you, Ben. Well, what's the view? China seems to be trying to get its act together, and that's what's led to a big spurt in terms of commodity pricing and even our metal stocks out here. What's your view? How do you approach this theme? You have, cooling off of rates in the United States, which is good for non-ferrous companies as well. So what's your preference, ferrous or non-ferrous?
Hi, good morning, Nigel. Thank you for having me on your show. Let us first deep dive into what is actually happening in China, right? China today is world's largest producer consumer across, ferrous and non-ferrous both, whether you talk about steel, aluminium, copper, any kind of metal, right? So what used to happen is, over last, I would say 3-4 years, their property sector, which was one of the largest, consumer of the metal, was actually lagging. So if you see, especially post 2020, 21, 22 era, whatever, this is not the first time China has actually got any kind of a stimulus, I would say. Even before, whatever the stimulus they got it, they were all in piecemeal basis, and none of the stimulus has actually given out the rally. The rally did not sustain going forward, right? So whenever the prices used to rally in anticipation of those stimulus, and thereafter they used to cool down. This time around also, though this is one of the largest stimulus announced by China, I would say, the prices have rallied in anticipation of the stimulus. However, for things to turn around, you need to have multiple further stimuluses going forward in order for this to sustain. Now, when you talk about ferrous and non-ferrous, right? Ferrous also, iron ore is one of the largest drivers in the ferrous side of the business, right? Today, what is happening in iron ore that, Chinese port inventory is at its record levels. They are at about 146, 148 million tons, and there are no signs of it going down below 140, 135 million tons, at least over the last 2 to 3 months. When you talk about long steel, Nigel, what happens is there has been some there has been some inventory reduction in long steel, because especially during this autumn festival, which has been observed in mainland China, there has been a lot of outdoor construction which picks up. So there has been some inventory reduction in the long steel. However, flat steel keeps on mounting. There has been not great. There hasn't been any great reduction in the inventory for flat steel, and because the demand within the domestic within China is not that great, they have been dumping around. This year also, they are having record exports, and I'm expecting, by the end of CY24, the exports would be over 110 million ton. So until unless there is no real pickup in consumption within China, this stimulus will also be one of those stimulus, and we believe that there will be multiple stimulus which will keep on coming forward, but there has to be something big bang coming from the country.
Parthiv, so I take all of those points that you have given us. The other counter argument is that only 5% of the Chinese steel producers are making money as of now. If that is the case, then that could be a sign that pricing is bottoming out. Yes, the inventory, iron ore inventory at ports as well are piling up, and that's a big worry. So what would your approach be? If the stimulus is coming about, if things have bottomed out, then which are the top picks? Since you mentioned that longs, maybe that inventory levels are coming down, will JSPL be your top pick from the ferrous pack?
Sure. You absolutely pointed out a right fact that, hardly 5% of the mills out there are actually making money, right? The burn rate is quite huge. Over and above, the blast furnace utilization rate over the last 3 weeks has been continuously going up. So there has been continuous production, and that is actually keep on mounting on the pressure. The pressure has been there in the prices, right? As far as your domestic play is concerned, we are very positive on companies which have a pure domestic presence, which are adding capacity towards value-added products. So companies like GSW and JSPL are, as a house, we have a topic on these two companies in the ferrous space. So we are positive on the domestic growth story. India is one of those few countries which is actually progressing very well. We are expected to grow over 8.5% going forward in ferrous space. Also in non-ferrous space, when you talk about aluminium and copper, we are expected to double down on our consumption over next by the end of this decade, by say 2030 or 2032, right? We expected to double down on our consumption. Also, the new age sectors has been driving a lot of demand for the non-ferrous side.
Yeah, Parthiv, so exactly what I was coming to. Since you sound optimistic on non-ferrous and demand seems to be good, what's the best way of playing it? Which stock?
So we are very positive on companies like, say, Hindalco, which has a very strong domestic presence, which is there across aluminium, which is there across downstream, which is there across copper. Also, we are very positive because, Novelis expansion, which has been happening at Hindalco, it will come on stream over next 2 to 3 years. Once that is there, they'll be taking under next phase of expansion as well. They have been doing a lot of, debottlenecking, a lot of recycling plants they have been putting. So these all things, overall, if you consider, we are very optimistic on companies like Hindalco.
All right, but what about Vedanta? Because Vedanta is giving you exposure to everything. Geopolitical tensions, the rising crude, they'll stand to benefit. If there is some kind of disruption, then aluminium is there to play it. Precious metals is twinkling, then silver is there. but you have that promoter question mark always. You don't know what they're going to do next. What's your view at these levels? Now, actually, Vedanta has been the biggest underperformer. Their stock was more than 500 rupees, I think around 5 months ago. And now it's still at around that 470. Adjusted, it's still only at around 500 rupees.
Yes, you're absolutely right, Nigel. The thing is, we are very, I'm very positive on, especially on the Vedanta aluminium front, because Vedanta is one of those few companies which is actually adding in the primary, aluminium, right? No other Indian entity is actually adding in the primary aluminium space, right? So Vedanta aluminium, yes. Let us just wait for the split to happen, and then let us play on all the different, 6 entities which will be coming out of that split, right? So once you split, you have a very clear-cut bifurcation between each of these metals, right? Whether it is your base metal, or whether it is your power, or whether it is your aluminium or it's zinc, right? You have a very clear-cut direction to play.
Okay, all right, we'll leave it over there. Thanks for joining in, Parthiv. Good to get that perspective from you. Well, that's the metal space and the Anand Rathi call out there. Let's quickly look at the market as well. What we've got in the pre-open, now that it's settled, is about a 40-point dip on the Nifty. And the Bank Nifty is down about 0.3%. So let's see how this plays. But even today, it's actually the metal stocks that are still carrying on with a little bit of the shine and the sparkle. JSW Steel, Tata Steel, and even Coal India on the material side. So these are stocks that are still holding up. Let's quickly get to the 9-10 calls then. We have our technical experts with us. Sudarshan, what's the stock?
Well, NMDC is a buy with a stop under 208.
Okay, so going with that theme on metals and materials. And Mitesh, what about you?
I'll go with a buy on ABB for targets in excess of 8,300.
Okay, all right. So that's ABB. By the way, looking at the market, ICICI Bank once again today is looking slightly weak. It's down about 0.6% in in the pre-open. Gentlemen, just very quickly on banks, what is it in large cap private banks? What looks the strongest and what is a relative avoid? Mitesh, what would your advice be on banks?
There's no avoid. In fact, I would want to buy all of them if they are available on a mild pullback. Maybe IndusInd Bank is slightly underperforming. So is Bandhan Bank, but I think HDFC, Kotak, ICICI, Axis, I think all look very good to me on the short to medium term charts. They've run up a bit in the last 7-8 days, so you would want to buy them on mild declines.
Okay, all right, gentlemen, thank you very much for your trading calls today. Thanks for joining in, and we'll touch base again a little later during the day. Let's move on. We've got a lot of interesting stocks to consider and all the commodity cues to keep in mind as well. I think we have Horma's now joining in. Yeah, so actually we have all of them. Okay, great. We have Manisha on commodities, Horma's who's been looking at an interesting Goldman Sachs note, and Vivek who has some more stocks to keep on our radar. Thanks for being here. Horma's, let me start with you. The GS strategy note, I think that singles out a couple of stocks that they're bullish on as well. Tell us more.
Stocks on which it is bullish on, but before that it mentions that that India is likely to continue to remain the fastest growing economy over the medium term. This is part of its India strategy note, and this mid-teens profit growth momentum according to Goldman Sachs may sustain to as long as 2030 is what the brokerage is anticipating. And it says that the profit pool may shift towards investment cyclicals, and those who may see the highest rise in the profit pool include sectors like autos, real estate, industrials and chemicals. Chemicals has been an underperformer, but autos and real estate have surged a lot, as have industrials. Now, what they also say is that this growth leadership may rotate towards the power and new energy segments, and based on this, they have come out with a list of 20 stocks on which they have buy recommendations. Among the large caps, they have stocks like Reliance, L&T, M&M, Ultratech, Adani Ports and Eicher Motors. So it's a broad spectrum of names there. Within the broader markets too, they have names like Indigo, Havells, Polycab, Ashok Leyland, Phoenix Mills, Uno Minda, Hitachi Energy from the industrial space, Astral as well, Kajaria, Blue Dart and Amber Enterprises. But within the PSUs, the high-flying PSUs that have been underperformers of late, only 2 names feature in this list. NTPC and Power Grid are the 2 names. So it is that power growth leadership that Goldman Sachs is talking about, which reflects in their stock picks as well. Back to you.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's hop across to Manisha. She's here with all the updates on the commodity space. Morning, Manisha.
Well, thank you for that. Well, there are three things that have been keeping the momentum in commodities alive. One, of course, the U.S. Fed rate cut and the expectation that more central banks are headed that way. Second, that the dollar index is trading now at a 14-month low, just about holding that 100 mark. And third is the way China has been making statements and doing action on the street as well. We have seen a cut in 7-day reverse repo, reduction in RRR, and then apart from that, refinancing of nearly 37 trillion Chinese yuan in sense of mortgages, and LMF rate cut as well by nearly 30 basis points. The PBOC governor has spoken on Monday about a cut in RRR by nearly 50 basis points. That is yet to happen, but that sentiment already has played into the market. Is the reason you're looking at copper prices at a 2-month highs, aluminum at 3-month highs, zinc prices at 4-month highs, Brent crude prices gained up by 1.5% overnight. We also are looking at gold at all-time highs, silver prices gained 5% overnight. So everything that you touch in commodities is on the higher side.
Okay. All right, Manisha, thank you very much for that. So, yeah, commodities absolutely top of the mind. IEX is what we want to focus on next. Stock was down about 10% yesterday. Vivek is back to shine the spotlight in this one. Vivek.
That's right. A quick recap of what transpired yesterday, and what is the kind of impact that analysts have penciled in if in case there is market coupling that gets implemented. First up, let's have a look at it. The delivery volumes yesterday are 26.11%. Very important to note that today the stock has entered the F&O band, so no fresh F&O positions can be taken in the stock today. What LRR is saying, market coupling can lead to a market share loss. Currently, company enjoys a market share of close to 84% as far as the short-term power exchange is concerned. They believe it can drop to 70% by FY27, and they see this can cause an almost 19 to 20% cut as far as EPS estimates are concerned for FY27. IIFL, remember, wrote a note yesterday. They believe market coupling is negative for IEX. With 50% market share in the DAM as well as the RTM segment, they actually see FY26 EPS estimates getting cut by close to 26%. So market coupling is negative for IEX in case it does get implemented, but implementation still seems some time away.
All right. Vivek, thank you very much for that. So that is the word coming in on IEX. We're a couple of seconds away from the market open, and the first trades will come up on your screen shortly. We'll look at the indices, and then we'll go down and look at individual stocks which are moving around. As always, broader market, there is a fair bit happening. The pre-open has left us slightly lower. So 25,900 is where the pre-open has left us at, and we're opening around there. So 25,915 is the first rate. That's absolutely flat. I mean, 0.1% change. The Nifty Bank is down about 0.16, 53,877. So, that quick sort of, 26,000 and then the drop. I mean, so we are sort of picking up from where we left off yesterday in that sense. Bank Nifty is also down about 0.2. Midcap index is down about 0.25%. So actually all in line. IT index is down another 1/3%, 0.4% straight off the bat. So, yesterday, of course, the IT services pack, it's been a little mixed last 2 weeks or so. It's been more down than up, the IT services pack. And look at the heat map on the Nifty, which is coming up. It's overwhelmingly in the red. 30 stocks almost down and about 20 which are starting higher. Streep.
Okay, let's look at the individual movers and shakers then. On the lower side of the Nifty, Bajaj Auto, LTI Mindtree, Apollo Hospitals. So these are three diverse from very different sectors. Then there is Britannia and Lever. So some profit-taking, even Asian Paints for that matter, some of that profit-taking trend that we saw in FMCG. That is continuing this morning as well. Reliance is on the lower side. TCS is on the lower side. Infosys is on the lower side. So these are the heavyweights which are sort of keeping things down. On the flip side, like we've been saying, it's commodities and once again metals as the China exuberance continues. So Hindalco, JSW Steel, Tata Steel, these are your top drivers. And Power Grid is continuing its good form. Remember, I think it was Motilal Oswal that came out with a note on power utilities and in the entire power chain. And Power Grid is one of the stocks that they like. So still going strong, 1% up over here. L&T is higher as well. And then it starts to get a little quiet. BPCL is managing some gains for itself as well. Titan, ahead of the festive season, seeing some sparkle shape up, about 0.5% up. But very quiet. 26 points gone on the Nifty, at least as of now. But lots of stocks in the individual markets. Nigel will talk about more. And I think Delta is the one that people really have their eye on because Now, finally, the business is going to demerge. The real estate and hospitality business will be separate, and it'll be a different listed company altogether. So that's definitely one of those stocks of the morning.
Well, I think investors as well, they wanted the management to be clear whether you're going to be in the casino space, the gaming space, or you're going to be in the real estate pack. So now they're giving the option, if which one you want, you could play it post this demerger. So I guess, investor plea has been, has been accepted, and that's why, in fact, they've announced this demerger. So that's one stock that's up and about, one of the highest volume movers. Z Media, they've been talking about doing some fundraise. They put this out on the exchange late last night. So that's one stock that's high. I think PC Jewelers as well, they had put something with regard to a fundraise as well last evening. So that one as well is up close to around 3%. Both of them, some of the highest volume movers today. Easy Trip, that large trade has happened, where we understand that the promoter entity could be looking at selling some stake out there. Explains why the stock is down close to around 6.5%. Pyramid Pharma, that's had a good run of late, and they had an analyst meet yesterday. We'll try to get you excerpts of the conversation that Ekta will have with the management by midday today. For the time being, the stock is up close to around 7%, so massive move is what we're seeing out there. Metals, well, they are shining. So the best way to play it normally is Vedanta because it has exposure to all the metals. For the time being, it's up close to around 1.5%. And Nalco as well is running along because alumina prices have been elevated. SpiceJet, the management says all is well. The street believes not quite. Because though Mr. Ajay Singh says that, the dues will come down, the employee salaries will be paid, and also the airport dues are all being paid. For the time being, the stock is down close to around 4%. Yesterday as well, there was some large selling and the stock ended with a cut of around 5%. So keep an eye out on that one as well. PNB as well down 3.5%. Prashant, what else?
Well, it's a decent kind of start, right? I mean, it's not bad and in line with what expectations were. So this is actually absolutely unchanged kind of a day. 15, 16 points down, 25,924. Manish Gurmani is with us. So let's get him in. He's Chief Investment Officer at Bandhan Asset Management Company. Manish, good to have you with us here. Thanks very much. I want to start with, of course, the big story, which is the largest ever IPO, Hyundai. $3 billion IPO. Soon, Swiggy is coming, I think, planning to raise just under $500 million. There's Vari, which will be there, and so many others. The demand in that demand for paper creating its own supply. I just wanted your thoughts on it. I mean, is it evenly matched, balanced? And what does it mean for secondary markets? Does it slow the pace down just a little bit?
Yeah, I would think so. So what we've been trying to do is tell investors, distributors that we need to keep our return expectations realistic. And just because structurally we are positive on liquidity because broadly we think dollar will be weak and a lot of Indian money will move from fixed income to real estate and equities. But just because you're structurally positive on liquidity doesn't mean every 6 months, 12 months, equities will give a bumper return because this liquidity will be met with a lot of supply. And supply comes with a lag, but I think we are seeing some very big IPOs in the pipeline. And I think we should, after making very, very decent returns over last 1, 2, 3 years, we should expect that next 6, 12 months should be pretty mediocre. I mean, we should be ready for that. No one can predict, but we should be ready for that.
Okay, so yes, indeed, Hyundai is going to be making all the headlines as that IPO rolls on. Manish, great to have you on the show. Thanks for joining in. But, in a more broader sense, what is your stance on auto as well as auto components right now? Because we're dealing with different cues. Global-facing companies on the ancillary side, they're looking at slowing demand. We all know what's happening in Europe. All these major OEMs are constantly cutting down rolling back their guidance. But then you have the two-wheeler guys doing really well here in India. PV somewhere in between. So, give us a big picture on auto.
So I do think it's very difficult to find great value there because, again, stocks have run up, whereas on the ground, we're not seeing supernormal demand. In fact, I think in four-wheelers, the demand seems pretty tepid at this point of time. So in that sense, I think the probability of getting a big surprise in earnings does seem minimal at this point of time. And given the P multiples, given the market cap, so if you see the market caps of two-wheelers, as you pointed out, versus the long-term growth that is possible. Obviously, we may get a cycle because rural consumption has a chance of picking up. But when you see that this is an industry which is fairly penetrated, so if you're buying something for domestic auto scene, then you need to get something which can get massive market share, which is not easy to pick. So I do think that when you see the overall market cap of either two-wheelers or four-wheelers versus what is happening on the ground versus what are the global market caps of companies in these spaces, I do think that's very, very difficult to get great value.
Hi, Manish. Good morning and good to see you. And Nigel on this side. Manish, suddenly China's coming back into play. And if China recovers, then it could be good news for the metal space. And we're seeing that these metal stocks are seeing a pop, at least as of now. What's your view? Would you build onto some of these positions? Or would you say that, let's wait for more, evidence that China is actually recovering and then get in? The other tailwind is that the Fed is cutting rates, which otherwise is positive. So how are you positioned on this space?
So I would have a mildly positive view on metals, more tactical, because China's recovery, unless it is directed very strongly by policy measures, which some of it has happened, but we have not seen the bazooka come out in one sense. And I do think that they need a big bazooka because the real estate sector is very big. It's under huge pressure. And also, when you see the structural issues like demographics, etc., clearly it is not a very strong country in that respect. So to expect a sustained recovery in China at this point is too nascent. But yes, I think when you see rest of the market versus metals, when you see the asset value, when you see the free cash flow, the dividend yields, at this point, also helped by the fact that, as I said, if your medium-term view is that dollar will be weak, so the downside on commodity prices may not be too much from here, apart, of course, in the scenario where US goes into a deep recession. But right now, I don't think the market is pricing that in. So when you see on a relative basis, I think there is decent risk reward in metals and oil today.
No, absolutely. Got that. Just a quick word, if you will, on the sort of big, the large segment of the market, which is financials, Manish. The banks basically is what I'm referring to, because a lot of the capital market plays have all done very well, but banks have really not. So I just wanted your thoughts. Some believe, the underperformance is more than anything else technical, because it's about 25% of the market. It's a very large segment, takes a lot to move this space. Is that it, or are there any underlying issues?
No, I do think there are some challenges there, particularly on the CASA side, which we've talked before, that there are both cyclical and structural elements which are pressurizing CASA. So unless the banks display some pricing power, because if you see what is happening is that on a 1 year or 2 year basis, the balance sheet has grown more in the riskier parts, which is unsecured lending, SME lending, agri, versus the safer parts, which is AAA corporate or mortgages to salaried people. But in spite of that risk profile on the asset side moving up, we've not seen NIMs expand. In fact, we've generally seen NIM under pressure, which basically means on the same product, the margins are probably coming down, which is a lot to do with the liability cost. That if you see CASA as a proportion of the liability side, that has materially gone down over the last couple of years. Now, unless you see some kind of pricing pressure where this fall in CASA proportion is reversed by, let's say, cutting rates on saving account or something like that, very difficult to be structurally bullish. Again, the valuations are such that maybe the downside is obviously not much, but can we see massive earnings surprise? Looks doubtful.
Okay, all right, Manish, we'll leave it there. A quick conversation today. Appreciate your time, but it's good to get that. Thank you very much. Now, I want to move on to the big news development in the NBFC space, which was the Reserve Bank of India lifting restrictions placed on IIFL Finance's gold loan business. Remember, these restrictions were imposed by the RBI early March. These restrictions prevented the company from sanctioning, disbursing gold loans. I caught up with Nirmal Jain, founder and chairman of the IIFL Group, to talk about what the lifting of this ban means. Have they started disbursement? And by when can we expect the gold loan book to go back to the pre-ban levels? Let's play this out.
So disbursement has just begun, actually. It's just about 2-3 days. So maybe I'll say it's just since yesterday that we started our business. So, it's been a long gap and it'll take some time to ramp up. And it's very difficult to give any forecast or any projections on how quickly it will take. But what we are doing is, we are in no hurry or there's no panic to get back. We want to do it in a more steady, orderly manner and making sure that the compliance is fully met, the risk controls are in place, and it's a long-term business, and I think we'll scale up over a period of time. Just because there's no precedence to this kind of disruption and resumption of the business, so it's very difficult to give any timeline or how quickly it will be. But I think practically it has started yesterday, and the response has been very good. Customers are coming back, and there are some branches where there have been queues also. So I think customers trust us, and we hope that things will recover faster.
If I can ask you, what was the amount disbursed first couple of days? What can?
It's very difficult. It's not very significant. Let me put it this way.
Got it. How easy or difficult is it going to be? Because you've lost market share because you were out of the market. Customers would have switched lenders, etc. as well. So what would you have to do to go out there and regain the share that you lost?
Gold loan is a very short-term product, so it gets repaid fast, and that's why almost 60% of book ran down. But the converse is also true because it also builds up very fast. So typically our disbursements have been almost twice the AUM, and the customers will come back to us for the same reason that they chose us in the first place before the ban. Obviously, they like our product and services superior to the competition. And I think we remain focused on the customer. We aren't really very concerned about how the book will ramp up because the short-term product rotates much faster. And our people have been in touch. So, one fortunately good thing with hindsight is that we kept our people. There have been no salary cuts, no sort of deviation of job responsibilities. So they've been servicing the customer. They've been in touch with the customers. And so the trust of customers and employees is paramount to our culture, our ethos, and that is what should help us getting back our business. Whatever feedback I'm getting from customers, employees, people on the ground, there's a positive momentum. Customers basically like us, and at the earliest opportunity, they'll shift their business back to us.
That's heartening to hear. Mr. Jain, the ban came into effect on the 4th of March, right? Now, I'm not asking for the near term, but just a bird's eye kind of view. How long do you think will it take for you to rebuild the gold loan portfolio to pre-ban levels? Again, you said it's not a T20 match, so you will do it properly. But is it going to take a year and a half, 2 years? What should investors expect?
So I wish I knew. So my guess would be as good as yours. But if you get, logically, as I was saying, that disbursements can be twice the AUM, then, maybe. So again, as I said, that these forward-looking statements have to be taken with a pinch of salt because, people should do their own analysis. And as I said, my guess is very difficult to really figure out. But whatever feedback we get from our people at the branches, it can take 6 to 12 months. But our target, as I said in the beginning, is not that we are really rushed to make sure that how quickly we get it. But we want to make sure that long term we have trust with the customers, and we build this business on a much stronger customer centricity, so that whenever our market share comes, is lasting and is long term.
No, that is very well put. So just to paraphrase that, and correct me if I'm wrong, given the feedback that you're getting and the fact that your teams were intact and there was no disruption in that sense, they were in touch with customers, and the feedback that you have, the gold loan portfolio can go back to the pre-ban levels in the next 6 to 12 months. Again, I'm not going to hold you to that, but that's a bird's eye kind of view.
I think that's the correct way to put it, yes.
Okay. Got that. Can higher gold prices also act as a bit of a tailwind? I mean, gold prices are significantly higher where they were in the month of March and where we are now.
That is good and also cause of concern because I know the gold at the end of the day is a commodity and factors have been favorable globally. But one should be cautious because gold is at record all-time high. And if there's a correction in gold loan, then with other things being equal, you see that the industry level loan assets basically decline. And there was a very, actually, if you remember 2013-14, it was a big blow to the industry when the gold prices suddenly fell by, I think, 25-30%. So I would be rather cautious. And that is why we would diversify rather than just be overly dependent on gold as a medium-term strategy because gold prices, they can rise so rapidly. I mean, at any point in time, I can't say when, because as of now, all analysts, all experts will tell you that gold is looking good with interest rate cut in the US and many other factors. But we have seen historically that things can change overnight. And I would be rather cautious by the fact that the gold prices are at a very high level.
I got it. You said you want to build out the other segments as well. I mean, actually, you had pullback growth in the non-gold loan segments as well, as a means to conserve liquidity, etc. Now, with this coming back on, will that also should that also ease in a way?
So, we have three separate entities. Our listed entity is primarily into gold loan and business loans. And we have housing finance and microfinance subsidiary companies. So as far as housing finance, microfinance are concerned, they are independently managed and also funded separately. And I don't think there should be any challenge in getting the growth back in those businesses subject to industry conditions as such. Now in the NBFC, which is the listed entity where there's a gold loan, the ban on the gold loan, has another significant business, which is a business loan. And we basically focus on small businesses, MSME, as we know them. And in these MSMEs, we do both secured as well as unsecured loan. And typical loan size is less than 10 lakh rupees, or it can be up to 30 lakh rupees, but the average will be less than 10. This is a segment where we have a natural advantage because we have a network of branches. As a group, 4,500 branches. Gold loan alone has 2,700 branches. We have people on the ground. These branches are located in the clusters where these kind of MSME enterprises, typically retail shops, traders, these kind of businessmen, they're around the shops. Many of them have been our customers for gold loan. So we see this as a significant synergistic business to expand and diversify over longer term. And this business in terms of sheer target market is much, much larger. And there the growth can be a lot more sustainable. And it's really not vulnerable to gold prices.
Mr. Jain, I was reading a sort of analyst report, and it said that just to come back to gold loans for a bit, co-lending was a big driver for your profitability there. Spreads were 800 to 900 basis points before the ban came through. Is that going to be the main channel for conducting gold loans?
Co-lending will continue as an important strategy. I don't think there's a margin booster as such, but it preserves capital and also reduces the risk on the balance sheet. Because if you borrow, probably you might borrow a slightly lower rate. But I think co-lending has been our strategy as a long term to make sure that the risk is mitigated. The leverage is much lower. As you can see, our leverage around 3 is very low for an NBFC like ours. And most banks that we've been talking to are very keen to restart the business at the earliest, restart the co-lending operations. And if you see last 6.5 months, we have returned almost about 11,000 crore rupees of bank money for co-lending, DA, and all these partnerships that we had. And almost about 12 lakh customers would have closed their accounts and repaid the money. Everything has happened very smoothly. So actually, this has been trial by fire that we have stood well. because for any lending institution, the real true asset test is, if there's a run of the liabilities, can you really liquidate your assets and repay? And I'm really proud to say at the same time, it has been like the testimony of the system that we have, that we have repaid such a large amount of money, closed so many customers' accounts without a single issue of asset quality or any issue of any significance about a customer grievance or asset quality.
Absolutely. Mr. Jain, let's sort of round this up with a few projections. Again, you're coming out of a phase which is you described as unprecedented, so there is no playbook for this. But your AUM, overall AUM, was about 79,000 crores as at the end of last year, FY24. Can you tell us in FY25, what should we expect?
It's very difficult, Prashant. So
how much lower would it be? Sharply lower? Does it look a lot better now? Just some sense.
It's absolutely impossible to give forward-looking statement at this point in time. So maybe once we restart our business, couple of months, 2-3 months, then we understand the pace of growth. But I think, from a longer-term strategy point of view, India is a huge market. The growth is there. But what we learned is that we should make sure that the compliance and risk is foolproof. The customer centricity and customer service is absolutely is impeccable. Then growth is derivative and will follow. But I just cannot give any forward-looking statement. As I said, that your guess is as good as mine. So there's no point in putting numbers to that.
I mean, your historical growth rate has been between 20 to 25%. So whatever happens in FY25, beyond that, 26 onwards, I mean, one should expect those kind of rates to come back.
Think,
I mean, just looking at history.
I understand. So other like economy, everything remaining good, we should get back to our historical growth rate.
Okay. And margins as well? I mean, are there... what's the sense? There was a little bit of a dip.
Margins.
Yeah.
So here also we don't want to get into any price cutting or in a panic state to get the business back by by being aggressive in pricing. So margins over a longer term will be maintained. In the short term, because suddenly our cost has remained where it was in terms of number of people and branches, and then the assets go down. Obviously, it will impact the margins, but I think on a steady state basis, we'll get back our margins.
Okay, so we'll get back to the margin level and also to a growth rate of 20 to 25%, perhaps by FY26, once the gold business gets back on track. And when does that happen? Well, 6 to 12 months is the time guidance that Mr. Jain has given to get back to the pre-RBI ban level in terms of the gold business. So that's IIFL Finance. Finally, a sigh of relief coming in from the regulator after 6 months. Let's move on and focus on the next company which is on our radar this morning, and this is MCX. Now, the company has revised transaction fees for futures and options contracts after a directive coming through from market regulator SEBI. Morgan Stanley has issued an underperformed rating on the stock. Do note that the stock has, of course, surged more than 84% just this calendar year itself. To talk about the business prospects, we have Rishi Nathani, Chief Business Officer at MCX, joining in. Rishi, good morning. Thanks so much for being with us. So let's start with this news on the transaction charges. Now, I know that this flows from a wider regulatory move that SEBI made, not just for commodity exchanges, but even stock exchanges, saying that, how much you charge should not be based on the volume of trading. There should be a flat structure. So what does this actually mean for your profitability, your revenue? Will there be a hit? Because now you can't go up to the top of the band. Earlier, the top side of the band was more than the flat number, the flat fee that you have now.
So good morning. Thanks for having me here. So just let me explain that earlier all exchanges were charging transaction fees based on certain slabs. And SEBI said that it needs to be uniform and true to label, which means that the end client should pay what the exchange is charging the broker. So first of all, it brings a lot of transparency into the system. Secondly, it reduces the transaction costs of the end client. So in that sense, it's a very good move. Now, in terms of you're saying that we cannot charge the highest slab, but at the same time, we cannot even charge the lowest slab. So we have made the charges in such a way that it is around our average realization. So I do not see any major impact of these transaction charges on our trading volumes or our revenues.
Hi, Rishi. Good morning and good to see you. And I'm looking at a note from Morgan Stanley this morning, and they believe that give and take everything. If everything is constant, they believe that your EPS estimates could move up by around 5% in FY26 based on these changes. Do you concur? Low single-digit increase is possible?
I'm not an analyst. I can just drive business, and that's what I'm here for. And we'll focus on doing that, and we leave the predictions to the analysts.
Right. Rishi, hi, good morning. Prashant here, and good to see you. It's been a while. Could you, again, not asking you to don the analyst hat, but incrementally, does this, does this help or hurt in terms of incremental earnings? No numbers, nothing. Or you think it'll be neutral for you? You'll be able to manage this?
Thanks, Prashant, and good to see you again after quite a long time. So, first of all, please understand that this helps the market participants in the sense it helps the end clients. And wherever end clients are helped and more transparency is brought into the system, it is always better for the entire system, number one. Number two, in terms of our revenue or the impact, all I can say is that we have made the transaction charges around our average realization. So I do not see how it would impact us either ways.
The other one was, the rule requiring you, if clearing interest on clearing funds has to be returned, right? That was the other bit. Could you talk to us about that? Could you quantify some sort of an impact? What do you see?
So that's a clearing corporation issue, and we'll have to speak to the clearing corporations regarding that. I will not be able to comment from the exchange perspective.
No, but
at the exchange level, will this move earnings in any which way incrementally at the margin?
So as I said, exchanges don't handle the funds. That is a clearing corporation activity.
No, but Rishi, I think what our understanding is, and correct us if we're wrong, because this was sort of the interpretation floating around in the market, and this is still a consultation paper. I don't think we have the final rules in this just yet, that the income that the clearing corporations were earning, that needs to be given back to clearing members as well. I mean, in some proportion, there's a change happening over there. What is your understanding of the issue? Where does it stand right now? And at MCX, is there any revenue you're earning because of these returns being made to clearing members?
No, so at MCX, we do not. As I said, this is a clearing corporation issue. The clearing corporations handle the funds, and that is where the money lies. So, as I said, I would not be able to comment on that. You'll have to speak to clearing corporations on that.
Interest income that MCX is earning at all in any format because of these funds lying in the clearing corporation, right? So there's no impact.
No, so MCX doesn't earn. It's the clearing corporation which handles and gets the revenues from that.
Okay, all right. Rishi, as you clarified at the start of this interview that you drive business. So, there could be a couple of changes. There's a discussion that increase in the lot size. How do you think this impacts, business, volumes, revenues?
So as I understand, this is not applicable for commodity segment as of now. It is only for the equity index segment. And going forward, if it is applicable to the commodity segment, we will cross that bridge when we get to it.
Okay. Do you expect it to? Are there any discussions underway for commodities as well? Or
I can't comment on it.
Oh, okay. So that's a yes? Okay. Is something, is there a conversation happening? We don't know if it will result to something or not. But can you tell us that much?
No, so as I said, there is nothing about the commodities at present. And as and when it comes, we'll cross that bridge.
Okay. Now, over the last 2 years or so, and we've discussed this in the past, the big excitement and I think what has excited investors in the stock has been the huge jump in options volumes, right? And I think we spoke when total options volumes notional were not even, I think we were at about 60-70,000 crores. And we were asking you, when will you hit 1 lakh crores? Can you give us the trajectory there, Rishi? What do you expect FY25 to end with? What kind of growth can we expect there?
See, I can only tell you what we've done. What will happen is up to the market. As you know, we are a trading platform. And while we try to, focus on our business, end of the day, it's about the participants who decide how much they trade on the exchange. Having said that, all I can tell you is that in FY 24-25 till date, our overall turnover is 1.95 lakh crores versus 1.09 lakh crores last year, out of which options is 1.69 lakh crores compared to 89,000 crores last year. And futures also has seen a tremendous growth at around 26,000 crores versus 19,500 crores. So the growth has been across futures and options, and again across segments. And on 14th September this year, we hit a record high of 4.72 lakh crores, with many commodities also hitting new highs in terms of turnover. So it's been broad-based growth, it's been all-round growth, and we hope that the market continues to support us, the market participants continue to support us in this way.
So, Rishi, while of course those turnover figures are looking fabulous, the market also wants to know what this increased trading volume is going to mean in terms of revenue and profitability, right? And while MCX has been doing well with the way the stock is surging, I think the market wants more. I think first quarter, some of the estimates were on a margin of 60% plus. You were just, you were below that mark. So let's talk about, revenue projections, given that you're looking at more product launches as well. So revenue FY25 and the steady state sustainable margin profile that you will target over this year.
So both in terms of revenues and margins, I will not be able to comment. What I can say is that we hope to continue the growth we have been doing and maybe even, try and grow on that as well. So that is what I can say. We continue to focus on all our contracts, whether the existing ones, new ones, all our product segments. And with this clarity of uniform transaction charges also, we hope that the end customers will benefit and overall the participation on exchange should increase. Because, last year also we have seen a very healthy growth in our overall traded clients, and we hope to see that grow. We have seen more FPIs participating on the exchange, and that also is growing in a very healthy manner.
We have lots more questions, Rishi, and you'll have to come back again. But I just want to end with this. You said as of date, YTD option volumes are 1.7 lakh crores, right? That's what you said?
Yeah, option volumes are 1.7 lakh crores.
So another 6 months to wrap up the year, you'll be at 2.5 this year?
I don't know. You extrapolate it.
Because, if you look at estimates, it was 1.7 for the full year, FY25. You're already at 1.7 now.
Yeah, but this is average daily turnover. So, so hopefully we should continue the growth rate. So that is what I'm trying to say, that end of the day, we do not decide what that participation is. The market decides that.
All right, Rishi, we'll leave it there. Thank you very much for your time. Appreciate it very much here on CNBC-TV18. Well, we'll take a quick commercial break here. We're going to come back and look at the market. We've got one more company joining us on the other side, Kim's, the hospital company. Stay with us.
In each other, invest in each other, and I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have an interest in. And the second is just better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. National security is being prioritized, as you said. Do you see this as part of that in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have the twin of permitting. It's not going to work. So you got to be a little cautious when you.
Welcome back. Well, the next management that we have on the show is Kim's, and to help us out with all of that, we have the management who's joining in on the show. Hi, sir. Good morning, and thanks a lot for joining in. Well, when we spoke last in August, you had indicated that Q2 will be better than Q1. So, Mr. Rao, what's your take? As of now, have ARPOBs improved? Have the occupancies as well improved? Give us a rough number of how things have shaped up in Q2 in comparison to Q1.
As we mentioned before, Q2, what was the anticipation was a little better than Q1, but we don't know. We haven't got it. Once the results comes in the next month, then we'll be able to know.
But otherwise,
as of now, the occupancy and everything is going as we planned. So definitely that is the one.
All right. So occupancy is be in the vicinity of around mid-50s? Mid-50% occupancy, Mr. Rao?
Yeah, basically, see, you know that we cannot able to give anything what's happening in the futures in the Q2, and where you putting me in the soup.
Okay. All right. Mr. Rao, then tell us about that agreement with Sri Chand Hospital. You've also done that acquisition of that hospital in Vizag. So how are things shaping up on that front? You can at least talk to us about a couple of assets. What is it doing currently, and how do you see it shaping up?
Yeah, Vizag have been acquired, and we know the market in the last 10 years, and then we understand there is a great potential, and we got a good opportunity. We took over that entire thing 100%, and we are very, very confident. Now we are recruiting more and more manpower. Definitely it will show good results as we expected.
Sir, so okay, now that there's inorganic growth, there's organic growth as well. So let's just put it in terms of number of beds. Where are you now? And by the time, all of these ramp up and your capex for the year ramp ups, what will the total bed capacity go up to? And how much more money are you looking to put to work? Because you've done several of these, key acquisitions this year already. Are you looking for more? How much money are you willing to spend, both on the organic side and the inorganic side?
See, basically, as of now, we have 4,000 beds. In the next 2-3 years, we are expecting around another 3,000 beds in the 2 to 3 years period. Some of them owned by 100% by us. Some we are doing in a O&M contract. And with this, as we've been planned very well about our finances, mostly we may not able to require any external funds. We will be able to generate from our internal accruals along with the debt. As the debt may not able to cross, maximum we are trying to debt 1:1.5. Maybe in 1 or 2 quarters it may go up to 2. That's it.
So you go from 4,000 beds to 7,000 beds over the next 2 to 3 years, and in the process, maybe debt equity goes up to 2 times. What is the cash in the books as of now, and what will be the total expenditure on this in this capex 3-year program of adding 3,000 beds?
I think in 2 to 3 years will be around maybe 1,200 crores. Out of that, we may generate maybe another 600 crores we borrow from the banks.
Okay, all right. So, and just if you could leave us with expectations for this year, FY25, revenue growth and basically the margins as some of the recent acquisitions they come on stream.
Yeah, the growth will be as we anticipated before. Now we have done a few acquisitions, one in Vizag, and we have taken one in Kerala. And then with this, I think there may be a little more than what we expected usually. So we were looking around 10% growth. Maybe it may go up a little more than that. And at the same time, and these are all the EBITDAs will come down, maybe you neutralize, we have to wait and see. We are very, very confident it will be on a positive side, everything, because Vizag is a known place and we understood the business very well. This is the Kerala one, what we have taken over is already existing hospital. There is a lot more awareness in the consultants. Many people are joining. We are also expanding another 200 beds there. So we are very, very confident whatever we have taken, it will be very good.
Okay, all right, so we'll leave it on that note. Thanks very much and good luck with your expansion plans. Well, let's move on then back to the market. And the market for the time being is actually bounced in the green. So we started slightly negative. Now the buyers have come in. And let's see if they can build on it. 5 points higher on the Nifty. The only problem is the Midcap index is still slightly negative. So let's see if that position also turns around. But there you go. Sort of red and green right now on the green side. Speaking of the markets, let's get to our next big conversation. Market veteran Manish Chokhani says he's very cautious in the infra space as well as in the industrial sectors, as these are not typically high return areas. Speaking exclusively to CNBC-TV18, Chokhani mentions that he is hopeful that financialization and equity asset reallocation trends should last for decades. Listen in to excerpts of a conversation with him.
Let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then, because it'll be a fairly large company. So it needs a $4 billion PAT, profit after tax. To get to a $4 billion PAT, just for context, today TCS with 6 lakh employees makes $6 billion. So is this possible? How will they do it? Will they add more lines? I mean, Amazons of the world have done it. They started somewhere and they ended elsewhere. But if you're taking that bet, your time horizon has to be that, or your return expectation has to be that much lower. And that's the sort of stuff going on over here.
Got that. I want to talk about leadership in this bull market as well. And we'll get back to what to do and advice for investors a little later. So PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But people, defense, etc., right? That part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done, or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like, what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So. And people are shy of doing leverage after, again, the last cycle. And the flip of it, sorry to just complete, the leadership of the last cycle was all the high-quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank, even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies. But it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very bullish.
And financials, right? I mean...
So, look, I've been presenting for years. I said there will be 4 big things which will happen in this decade in India. When you're expecting a melt-up, obviously, you get ready for it. The first, obviously, was people will come and get excited about financialization of India, and we were coming off, remember, the financial cycle. And not to say that you want to be in those same stocks which led the last cycle, and hence we had all these PSUs and stuff, and the so-called corporate banks, which have actually given staggering returns even now. The second theme was that India will have to privatize a lot. And that privatization theme, whether it's airports, ports, railway, roadways, it's basically that whole make in India, where we are taking over what the government used to do and we will do it better and faster and cheaper. That was theme 2, which has played out really well. 3 was you knew the advent of these platform plays and digitization will come. And indeed, all the Zomatos and the Nykas and all played exactly into that theme, which have also done remarkably well. And the 4th was that people will come to India. Why? For consumers. And the consumer discretionary will be the place to be, not the FMCGs of the past. Right. And those also have done incredibly well. So whether it's to buy home improvement products, consumer durables, travel and tourism, and so on. So 3 of the 4 have done remarkably well, and I suspect are discounting a lot of the future.
Yeah.
And you have to be, like Mark Faber used to famously say, in the beginning of the bull market, the entrepreneur has the vision and the investor has the money. By the end of the bull market, the investor has the vision and the entrepreneur has the money, which is happening in some places already, as I mentioned. Yeah. So of those 4 big themes, I think financialization has still not fully played out. Right. We've participated very happily in the capital market themes, which are fund managers and so on, and the ancillaries, the exchanges and so on. But the banks, which are looked on with a very sort of, as if the NPA cycle has already started coming and it will be a repeat of the previous cycle where it blew up or margins will collapse, deposits will never come back. I think the narratives are a bit misplaced over there. And therefore, it's a question of taking an asymmetrical bet with a time horizon. And of course, a return expectation which is not as spectacular as we've already had in the last 4 years.
So banks and financials are...
I think that's the
comfort
center point.
Kind of zone? I mean,
comfort and, look, eventually, where is wealth going to be parked? Is even today, the issue in financials, which everyone tries to justify for fundamental reasons, I suspect is a lot more technical. The financials as a category must be, to my mind, 25% of India, which is $1 trillion. And to take $1 trillion market cap up, it takes a lot of money and demand. Absolutely. So if and when this money and demand comes from overseas, and when the locals wake up, that we don't necessarily think that 20% return is so easy. And actually, you can make very safe, go-to-sleep kind of 15% returns in financials. That may be the time for their moment in the sun. Having said it, they led the last bull market. Yep. So it's not like the bull market ought to come and trigger it off immediately. Yep. So it's question of what your time horizon is and what your return expectation is.
Okay, well, that's an excerpt of the conversation, but you can catch the full one with Manish Shokani at 11:30 a.m. Today. And that's going to be an interesting one. We sort of go all over and discuss a lot more sectors, examples from the past, and essentially advice for investors as well, I think. Very, very nicely put by Manish. So that's coming up later, 11:30. We'll take a quick commercial break here. We put the focus on commodities with Manisha when we return. Stay with us.
Yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead? Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do. Well, no,
it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
U.S. has been trying to reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously, every nation look at it and say, we can't rely on someone who might one day be an adversary. That doesn't make them an adversary today for supply. Just like JP Morgan's always have multiple diverse supply chains. We don't rely on anything. The second one is around disagreements around policy. Like, if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, these are going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. There's semiconductor, you're talking about 5, 10, 15 years. So
welcome back. Well, the equity market is, consolidating. The bias is a little positive, but let's find out what's hot in the world of commodities. We have Manisha joining in. Manisha, what's catching your eye today?
Everything is hot.
Always in commodities.
But gold should be on your screens because, we've seen not just another all-time high in the US dollar terms, but for the Indian markets as well. Well, India was actually trying to catch up since the duty cut of nearly 9% this budget. So there was this huge divergence in the international markets and the Indian prices. But with 75,000 now taken off in the Indian markets on MCX, we are looking at all-time highs for the Indian markets as well. And then it is not just in dollar terms or rupee for that matter, because the gold has hit all-time highs in various other currencies like a Chinese yuan, a Japanese yen, euro as well, and various other currencies in Asian markets also. So the gold run clearly is golden right now. But the US consumer confidence has slipped to the lowest in last 1 year in US, and that clearly led to the last leg of gains in prices. And then apart from that, if you look at the dollar index decline to a 14-month low, that has been supportive as well. If you look at the gold prices for the month of September, we have gained by almost 5%. And if you look at the international markets, well, we have seen the gold prices gain up by 28% in this year until now. There are prospects of less restrictive monetary policy going forward that has been supportive. Also, the elevated geopolitical tensions in Middle East, where more countries perhaps seem to be joining in, is what is leading to safe haven buying in case of gold. And then there is consolidation in gold mining, more mergers and acquisitions happening. That tells you that there is lesser mines and then no more mines coming in for this area, and that has been supportive. Also, when you look at the gold longs that have been constantly on an increase, highest since March 2020, by the way. So the net longs continue to be very bullish in case of gold as well. And then it's not just gold. If you look at the silver prices, we gained up by 5% in the overnight markets. This one is trading at around 4-month highs as well and above $32 an ounce. And that has been the case with overall precious metals. Platinum prices gained up by 3% overnight. Palladium has been up 2% as well. And there is loads of data coming in this week, and that would tell you on where the dollar index would go and how you should be dating at gold as well. So the new home sales data from US comes in on Wednesday. Then you have the weekly jobless claims that comes in on Thursday. And the most important PCE data from US comes in on Friday. That would tell you on how the Fed would react in the coming months as well. So until then, more gains continuing in case of gold there.
Okay, all right, Manisha, thank you very much for that. Well, with that, we have to take a quick break. We'll come back on the other side. And in our special segment, It's the Economy, today Lata gets chatting with Jahangir Aziz and Luis Organis of JP Morgan on the Fed rate cut, the China picture and more.
Take place, it's going to take a long time, but companies are doing it on things like iPhone. I know iPhone production, so some things can move quick, some will take years. Huge opportunity for China. I mean, for India, a huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got US elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that. I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one. So that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
They say that the proof lies in the pudding, but this SEBI study is neither the proof nor the pudding that many F&O traders would want to see, read or hear. Now 1.8 lakh crore rupees. Now that is the cumulative loss made by individual traders within the F&O segment between FY22 and FY24. That's the big number from this latest SEBI study. Now a study that the market regulator released last year said that 89% F&O traders lose money. Now that number remains where it is, as 9 out of 10 individual traders stay.
The week before was dominated by the Fed and what it would do to all markets. But this week has been dominated by Asian central banks. The BOJ has sounded less hawkish than was expected. And the Chinese central bank, the PBOC, has surprisingly cut more than expected. So there is a lot to discuss on rates, commodities, currencies, and what it can do to, of course, the Indian economy and Indian stocks. Joining me are two experts from JP Morgan. We have Jahangir Aziz, who heads Emerging Market Economics, and Luis Ogares, who is the head of Global Macros, Commodities, Currencies and Rates at JP Morgan. Luis, Jahangir, thank you very much for joining me.
Thank you.
Well, let me start with the big announcement from China. Yep. Was it more than expected, this 20 basis rate cut and promises of more cuts? What does it do to the Chinese economy?
So there are two separate questions. So the first question is that was it expected? It was more or less expected, right? But you have to look at the two of them separately. The 50 basis points of RRR cut, that was meant to create enough liquidity for the Chinese government to continue to issue bonds, because that was the basis on which we had called for a 50 basis points of rate cut. The 0.2% repo cut, that was tad higher than what we had. We had a 10 basis points of cut. But again, the amount and the timing of that was always quite uncertain. Clearly, as you pointed out in introduction, the Fed cut of 50 basis points is having an impact on emerging market in Asia. Asia was the place where you did not have enough amount of cushion with the Fed, and that was where the concern was, that these countries or these current central banks could not cut without triggering concerns about and financial stability. I think the rate cut by the Fed has opened that space, and I think you will see other central banks follow. BI was the day before, yes. And BSP is probably going to be adding more rate cuts. So I think that the overall idea that the Fed, intransigency over its rate cutting cycle and making us wait for quite some time, was holding back
the central banks in
central banks in Asia, particularly, not in Latin America or other places, is playing out to be true.
Okay, before you analyze the impact on the Chinese economy, sure, which we are all terribly interested, just to complete the argument, does this make it more incumbent on the Reserve Bank to act, at least from the currency angle? Because if there are so many cuts and the Chinese central bank also cuts, rupee appreciation will be uncomfortable.
So I wouldn't bring FX directly into it, okay, because obviously, RBI has a, very ambivalent attitude towards what it does to the rupee, insisting that it only smoothens out volatility. But clearly, they have a view about where the rupee goes. But I would say that it's much more domestic driven, the need for RBI to cut. So if you have an economy, and let's not go into what recorded growth is or not growth is, let's look at the proof of the pudding. The proof of the pudding is core inflation. And core inflation today is at its lowest level since the inception of the index in 2012. And it has been falling over the last 9-10 months. I've lost count of that. In any country where core inflation has fallen to this low level, and it has been actually falling on a sustained basis, it always smells of serious excess capacity in the economy, and not only excess capacity, but widening excess capacity. You can have, core inflation falling 1 month and then go back at other, and then you can say, well, it's something else that was working. And but 9-10 straight months to its lowest level in 2012. So I think that it is incumbent on the RBI, just like the Fed did, which is that we need to recalibrate the restrictive trend. Nobody's asking them to be
calling for a December cut or an October cut itself.
So my India team does not have an October cut. They say that in October they will change their language, and then there'll be December cut. I'm probably on the side that, why change the language only? If this was a 25 basis points of cut by the Fed, then I would say, yeah, change the language and then go for a December cut. It's a 50 basis points of rate cut.
Okay. Well, there has been a 50 paise appreciation of the rupee. It was almost 84 and it's gone all the way to 83.50. But let's see. Let me come to the reason why perhaps core inflation is down, at least a small reason, is this huge Chinese disinflation. In specific areas like steel, EVs, solars, it's very clear. The Tata Steel managing director was on our channel on the record saying that the Chinese are selling steel HR coils at $50 lower than their own cost. So, Louis, to come to that, do you think the Chinese disinflation recedes somewhat if the rate cut recharges that economy?
I don't think that is going to recede anytime soon, because the problem is that China has a problem of excess supply right now because there is not sufficient domestic demand. There is still a problem in the real estate sector, which demands a lot of steel, to your point, or other commodities. And the solutions to that are not, anywhere to be seen. And we know from experience of any country that has had, boom-bust cycle in the real estate market, it takes time for these cleanups to happen. So what China is doing is obviously, keeps manufacturing and keeps flooding the global economy, global markets with its, cheaper production. Yeah, that has been generating a lot of reactions, right? US, Canada, EU, you name it, imposing restrictions, some tariffs or protesting, this attitude. But China is not, they see it to their benefit. Yeah.
Yeah,
so
exactly.
I think that this disinflationary impulse from China, in my mind, is going to continue.
Is not going away anytime soon.
No.
Okay. Just a word on the Chinese currency as well. It has appreciated from around 7.3 a couple of months ago to 7.03 now. Do you expect all currencies have, like the rupee has. What's your sense about the yuan itself? Will it depreciate more because of the inherent weakness?
I think that the path in our mind is more for depreciation, but there as well, to the extent that it is a currency that is heavily intervened, right? And yes. And the reality is that I think that at this stage, probably the Chinese authorities don't want to add insult to injury, promoting more currency weakness than what is strictly necessary needed, but. Growth weakness, interest rate cuts that you're discussing here, all that points to less support for the currency. So I think that the path should be for weakening. And we're not even talking about what may come next in the U.S. if there's tariffs, etc. Right?
Oh yes. We'll come to that because that's such a binary event, the U.S. elections. But if there is a dollar depreciation and yuan depreciation as well. India has the highest current account deficit with these two countries. I don't see the Indian Central Bank not reacting to it, and that buttresses your point. But what about the Chinese economy itself, Jahangir? You said that the 50 basis, CRR cut or whatever, triple R cut is to give space for fiscal stimulus. With a bit of more fiscal stimulus and this monetary stimulus, are you any more confident?
Look, so we have been continuously disappointed on the lack of change in the direction of policy. As Louis was saying, it isn't so much you need more quantum of fiscal stimulus. You need the fiscal stimulus to be in the right place. So China is facing a problem where domestic consumption has been continuously disappointing. On the other hand, if you look at fiscal policy has not provided any support to domestic consumption. Fiscal policy continues to push in towards more production. So if you have more fiscal stimulus that goes into fueling more production, then exactly what Louis said is going to happen, which is that the excess capacity increases, inventories build up, and the Chinese will have to find another market outside of China to sell their goods. Deflation is a serious concern in China, not just deflation in export prices, but also deflation internally. So we have been looking for a shift in the policy direction, not
towards consumption.
Towards consumption, whether it takes the form of income transfers, whether it takes the form of more support to low-income housing, to public housing. That's the change that we have been looking for. And unfortunately, we've been waiting for a long time for that change, and that change hasn't happened.
Okay. Fine. Let me shift to the other major Asian country which has suddenly loomed in terms of importance in currency markets in particular. What's the expectation from Japan? More hikes?
Yes. So we have to understand that what has happened in Japan is not a fluke. It is not all of a sudden that inflation is coming back. Japan did take significant amount of structural reforms in the past 2 years, and the result of all of that is that Japan finally is seeing inflation going up, wages going up, and that is being done with concerted government effort. We have a rate hike in December, but we have 2 more rate hikes in 2025. Market only has 1 rate hike right now priced in. So our view, and Louis, correct me if I'm wrong, is that if you get these 3 rate hikes rather than just only 1 rate hike, which is what the market is pricing, the yen appreciation that you've seen more likely has more legs to go on. And the argument, and just to connect to the previous point that you were trying to make about why CNY appreciated, the first leg of that appreciation, not the second leg, but the first leg of the appreciation was the unwinding of the yen carry trade. So that did have an impact. So in our mind, we are significantly above the market consensus in terms of where BOJ will go. And if that's the path, then my guess is that currency is probably headed towards more appreciation rather than depreciation.
Okay. But before I take a break, the most important question which our viewers will want to know: where is the yen headed, and is there a chance of a repeat of the yen carry trade unwind which hit us in early August, or these things don't repeat really because the world is prepared?
The projection that we have is that the yen is going to be, potentially crossing, piercing again the 140 level, going to the high 130s. But this assumes a U.S. going into a soft landing. And nothing dramatic happening around the U.S. elections. If we get a U.S. recession scenario, it is possible that we actually get more rate cuts by the Fed. It is possible we'll get to the low 130s or even the high 120s. This is clearly not in the market. As Jahangir said, our team expects more hikes than what the market is discounting right now. So if you speak to JP Morgan traders, dollar yen is a currency, so the yen is a currency that they seem to favor, just because it is still not consensus. People are not convinced that these inflation dynamics are here to stay, that the policy path for the BOJ is for more hikes. This is still, not everyone is believing it.
Well, hold on to that thought. I have to take a break on that note. We are going to continue to speak with Jahangir and Louis. You will get to hear the whole show after market hours. For the moment, after break, Chartbusters.
Continue to incur quote-unquote significant losses. Now let's tell you more about those significant losses. Including transaction cost, the average loss of over 93% or over 1 crore individual traders stood at 2 lakh rupees each. If that is not enough, the top loss-making traders raised the bar higher. The top 3.5 loss-making traders averaged a loss of 28 lakh rupees per person, of course including transaction costs. Again, all of these figures between FY22 and FY24. So does anybody make a profit? Absolutely. A staggering 1% of the traders in the F&O segment made a profit over the last 3 financial years. And if there ever was a gulf between domestic and foreign traders, the upcoming graphic will show you that. Proprietary traders made a profit of 33,000 crores in FY24 before adjusting for transaction costs. FPIs made a profit of 28,000 crore, and putting these two numbers together, the individual traders made a loss of over 61,000 crore rupees in FY24. So how did these traders manage the profit? Now, most of these are generated by larger entities using algorithms. 96% of proprietary profits and 97% of FPI profits are generated through these algorithms, according to the SEBI study. Now, if you wondered that the SEBI study from last year would act as any deterrent to youngsters from venturing into this unknown territory, that has definitely not been the case. The number of traders below the age of 30 within this segment has now risen to 43% from 31% in FY23, and 72% of the total trader base is beyond the top 30 cities of the country. Shows you the extent of the F&O penetration in India. Now, if there would be a study that proves F&O penetration being faster than insurance, don't be surprised. We spoke to you about the losses that individual traders made that ran into lakhs of rupees. 75% of those traders had an annual income of less than 5 lakh rupees. And I'll end with possibly what is the highlight of this report, and nothing better can describe this than a famous Hindi film dialogue, and I quote, "रोज आते हैं इस उम्मीद में आज जीतेंगे, कल जीतेंगे, परसों जीतेंगे और रोज हारते हैं." Now, why do I say so? Because despite making losses for years, 75% of these F&O traders continue to trade as per this SEBI study. So there you have it. Foreign algo trades making money in F&O while the individual retail investor continues to struggle. Of course, what people do with their money is an individual choice, but these stats would definitely set alarm bells ringing for sure.
Metals continue to rally for the second straight day as rate cut guidance and a possible stimulus in China sparks optimism. Delta Corp surges as the board approves the demerger of its realty and its hospitality business, which will be housed under listed entity Delta Penland. Investors will get one share of the demerged entity for every share that they hold in Delta Corp. East My Trip corrects nearly 8% after a big deal sees nearly around 10% equity change hands at around 38 rupees per share. Promoter Mr. Pitti is likely to have sold 8.5% stake. Pharma surges after bullish guidance at its analyst meet. Shares rise after the company says that it has ambitions of being a global pharma company by 2030 and is eyeing $2 billion in revenue and 30% EBITDA margin by 2030. And Power Grid surges close to 5% as the Ministry of Power finalizes the National Electricity Plan from 2023 to 2032. Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me today is Vivek Iyer. Well, Vivek, it's a day of consolidation, so to call it. We've seen a heady run. And for the time being, the Nifty is down, I think, 25, 30 points, par for the course, one would say. So the metal index continues to shine along and the Nifty Bank is holding one end up.
Good morning, Nigel. Pleasure to be here. The most important thing that we saw yesterday was that the 26,000 mark, as far as the Nifty was concerned, that's something that didn't hold on yesterday. We've not closed above that, and we've seen quite a bit of sell-off from those levels. So that is going to be very important going forward. And also, like you mentioned, metals are doing quite well. Some of the power stocks and ancillary stocks are doing quite well. Power Grid, in fact, one of the top gainers today. But quite a lot lined up on the show.
Well, that's right. Vivek, it's not too often that on Chartbusters I feel a little tiny in front of someone. But that's the case today because Vivek outbeats me in terms of height. But that's as a side note. Well, let's get in Soni Patnaik, who joins us for a technical check on the markets. Hi, Soni. We're down 30 points. What do you do? Rush in to buy or wait buy?
Good morning, Nigel, Vivek. Thank you so much for having me on the show. So I think yesterday Nifty we saw it tested around 26,000. It could not sustain. It's an overbought zone as we speak. So there's a possibility that Nifty can sustain in the range of 25,800 to 26,000 until tomorrow's expiry. And post that we may see a small healthy correction up to 25,500, which is a very strong support. So look to buy only on those support dips, and at current levels, one should just avoid book your profits out of indices. If we talk about Bank Nifty, the expiry range for Bank Nifty is somewhere between 53,800 to 54,200 odd levels. I think that's a range where Bank Nifty may expire. It's good. It's stronger in comparison to Nifty. So Bank Nifty becomes a buy on dips, but the dips is around 53,500 to 53,300 odd levels. If that zone gets tested for Bank Nifty, one can buy on those dips and look for targets of 55,000 in October series. So both these indices are fine. The upside is still intact, but it's mostly like a buy on dip sort of a strategy.
Good morning, Sony. Sony, which are top technical trades for the day?
Certainly. So Vivek, the first pick would be from the cement space. That is Ramco Cement, which has seen a fresh breakout today on charts, and it's showing a bullish engulfing candle pattern. So one can buy Ramco Cement around 865 and on small declines up to 860. Keeping a stop loss of 845 and a higher target of 890 to 900 can be seen. So the second pick comes in Tata Communications, which is consolidating to take a fresh breakout above 2080 levels. So I think for Tata Communications at current levels of 2050 and on small declines up to 2040 can be bought. A very strong support of 2010 can be seen at current levels. So keep your stop loss at 2010 and look for higher targets of 2120 and 2150. And both of these stocks can also be done in futures for October series as well.
Thanks a lot for that, Sony. Well, let's focus on another news piece that came in. Vivek, the National Electricity Plan has been announced, and that's one of the reasons why, in fact, we do have Power Grid that's surging in trade. Explain this to us.
Well, that's right. This is an important development, something that was expected as far as the entire power sector was concerned. So the draft NEP, or the National Electricity Plan, was in place. And what's happened in the last couple of days is the fact that the government has gone ahead and they have finalized this particular electricity plan. So what is it that they're saying? Number one, they've gone ahead and said that the spends that they have finalized is close to 9.15 lakh crore. Now, this is a significant spend. So what does this indicate, and what will be the kind of capacity addition that you see? Number one, the plan is aimed at meeting a peak demand of close to 458 gigawatt. This is by 2032. Remember, you're also talking about the transmission network capacity targeted at getting higher from the current 4.85 lakh circuit kilometers to 6.48 lakh circuit kilometers by 2032. Along with that, the transformation capacity, that is also seen from 1251 GVA to almost 2342 GVA. So this basically means that there's going to be significant amount of spend as far as, number one, laying transmission lines across the country. There is also going to be enhanced focus as far as ensuring that there is enough systems in place for green hydrogen as well as pump storage. And this is quite positive. Number one, of course, Power Grid, given the fact that it is the main transmission play in the country, but also players like cable makers, transformers, all of these guys too will do very well, given the fact that there is now a clear line of sight as far as ordering is concerned.
Okay, all right. Thanks, Vivek, for neatly explaining all of that to us. Well, I'll tell you what, for the time being, we'll slip in a short break. On the other side, we'll get chatting with Mr. Lal Puria of Indicott Industries. They've just done some inorganic growth. We'll understand more about Flovytex.
भारत का 5G मार्केट, बताऊं? बुरा नहीं लगेगा ना? आज भारत का 5G
Welcome back to Chartbusters. Well, as promised, we will be going to the management of Intercount. Remember, Intercount's subsidiary acquired close to 81% stake in US company Fluitex. We are joined by Kailash Lalpuria, the ED and CEO of Intercount Industries, to discuss the recent acquisition and the future outlook for the company. Good morning, sir. First of all, thank you so much for joining us. Give us a sense of what was the rationale behind this particular acquisition. You also have an option to buy an additional 19% stake. So what were the valuations at which this particular deal was done, and what is the outlook here?
So good morning, everyone. This is a strategic move in order to build the utility bedding business, and it's a pivotal step as well as the stepping stone to, make US manufacturing active in utility bedding, where there is a large opportunity, and also distribution across the US. So this is a strategic move which we have been planning, and it overall builds a full synergy to our bedding businesses, because pillows are an important part of the product portfolio. And with the acquisition of Vamsuta, it also provides us in order to build up this business, which is brand, focused to distribute goods to both the existing customers and new customers in the US and Northern America overall.
Okay. All right. Hi, Mr. Lalpuria. Good morning and good to see you in. It's been a while since we spoke. With regard to this acquisition, I'm just looking at it in the last few years. You have done revenues in the vicinity of around 25 to around $38 million approximately. But I believe you have ambitious plans. Could you tell us if in the coming year you can scale it up to, say, $50 million? Would that be something that you're looking at? And also in your current business, you do around mid-teens margins. On the acquired business as well, margins are around that 15-16%?
Of course, and that's why you see this acquisition has given us an opportunity to ramp up from the existing 30 million kind of revenue to almost 50 million within a year. Because the anchor customer, which is an existing customer with Fluitex already, has also assured us a 4-year renewal and a commitment to buy goods from us on a continuous basis. So this provides us a visibility of almost 125 million with just the existing customer. And then we will be able to divert this production to our other existing customers over there. So overall, we look at a visibility of almost 50 million plus revenues in the very first year of operations post-acquisition.
And on margins?
Margins, of course, you see, currently it is a margin-making company already. It will be in the range of 15 to 16%, and our endeavor will be with capacity utilization, with product mix which we are offering to the customers. We should be able to improve our overall margin profile as well into this business.
Mr. Lalpuria, at the end of Q1 FY25, you guided the street, to an FY25 volume guidance of 110 to 115 million meters. Now, with this acquisition, would you be looking to, go ahead and give an upsized guidance? Also, what will be the, resultant top line? Now we are almost at the end of Q2. So do you have better visibility in terms of what kind of realizations you'll be able to make over there? Also, the guidance you've given in terms of EBITDA 16 to 18%, this acquisition seems to be at a slightly lower margin profile. So would you be at the lower end of the guided band?
Not at all. We are on track of the guidance which we have provided, 110 to 115 billion. And of course, this acquisition would help us captively consume to certain extent of our capacity. So it will further add up to our volumes going forward. But you see on the Q2, we should be able to better provide you, guidance post our earnings. Secondly, on the margin profile, as I mentioned, currently the capacity utilization is only 60%. And post this acquisition, we are building up the customer base and the product mix, which will help us scale up the margin to 16 to 18% which we have provided for our overall business. Definitely the capacity utilization will play the role of operational leverage, as well as you see the product mix which we have completely on the bedding side will help us scale up the product mix and offer both on the branded side as well as the non-branded sides to our existing customer and new customers, thus providing us the benefit of the margin profile.
Okay, all right. Mr. Lalpuria, just to get back to the acquisition that you were talking about, you're also getting 1.5 million quilts in that, I think so. And if I got it correct, the unitary pricing of a quilt in comparison to a pillow is nearly 4x. Is that a fair estimate, 4 to 5x?
Of course. And looking at all the logistic issues which, globally we are facing, quilt is an important part of our business profile, which we have acquired. And we should be able to also make, some sort of comforters and other field products over there. So definitely this will add up to the revenue and the margin profile.
Okay, all right. Now, how do you fund this? It's a small acquisition, $25 million approximately in total is what you'll pay. How are you positioned currently? What is the cash, the debt in your books as of now? You have an ambitious capex as well, I think, going ahead. So list that out for us as well. So what's the balance sheet looking like? And what is the capex plans for this year and the next?
So we all know that we have a robust balance sheet, and as a company, we have been conservative into drawing debt, and we will keep it like that. So our net worth is about 2,000 crores. Our long-term debt is only 175 crores on the books. Of course, we need working capital for the textile business, which is a 90 to 120 days cycle. So being conservative, you see the debt always will be drawn in order to fund the growth. And the board will appropriately take measures in order to fund this and finance this growth going forward too. So looking at last year, what we reported, the net debt was only 750 crores. So going forward, we will fund wherever there is a synergy of both revenue and margin. We will fund that growth both through internal debt as well as internal accruals as well as long-term debt. And
so
we will keep that. Yeah.
Yeah. So Mr. Lalpuria, running a little short on time. So you're saying you're very comfortable currently, but your capex plan is around 1,000 crores for the next few years?
The next few years, 1,000 crores, you can always take into consideration, but we have already spelled out that the core capex is already over. We have built in a capacity of 153 million. We are at 110 level. So 2 years, we are looking at the similar growth. We are investing into zero liquid discharge, into solar power for optimization and improving our overall profitability going forward. So wherever there is a synergy, the board will take appropriate decision to finance the growth and will take on steps to see how we can grow our bedding business in the USA because we are at a leadership position.
Right. Mr. Lalpuria, you spoke about USA. Now, 3 countries, and request you to keep your answer a little short because we are running out of time. There are FTAs, that are already present as far as Australia as well as UAE is concerned. Also hopeful of an FTA with UK. Could you quantify the opportunity size for you for FY25 and FY26, and do these typically happen at a higher margin profile?
The FTA for us is a cherry on the cake. We are already existing in the UK market with an office distribution, in Manchester and Leeds. So we have the entire range of customer base from high street, say a John Lewis or a Marks and Spencer's, or you name any of the high street retailers. So we have a large customer base, but of course, the FTA would provide us more competitive edge in order to improve our overall competitiveness across the product segment, whether it is we are now positioned into the mid to high segment, but it will also give us an opportunity to explore not only the luxury segment, but also the below the mid segment as well, where Pakistan and Bangladesh are having the duty advantage. So once the level playing field is there with the FTA, we will have more distribution of our product mix and more, revenue will generate from this particular market. And we presume that what we have been informed by the government sources, that a lot of discussion has already materialized as far as the FTA is concerned. And there are only few things which are remaining from a policy standpoint in order to declare this FTA in the near term. So we are all hoping that this should help us, the entire textile sector to speeden up their growth into this area.
Okay, very quickly, Mr. Lalpuria, before we let you go, you seem to have laid out the capex and you're looking at brighter prospects for 2027. Are you on track to hit revenues of around 6,000 crores? And your VAP, value-added products, as a percentage of your mix is 20%. Where does it go to? What does it mean for margins? Very quickly.
So in FY23, Nigel, we had already embarked on a journey to double our revenue growth, and we are on track. Let me tell you, I'm glad to say that we are on track despite, there are so many challenges out there and there are a lot of uncertainties still holding out. But we are on track to double our revenues in the next couple of years or 3 years maximum. And also the margin profile will improve both due to the operational leverage and the addition of the utility, fashion and institutional business, as well as the branded business, where we also have started, our journey with a bang, by acquiring this Vamsuta brand, which is positioned into the specialty and departmental store categories.
Correct. So you'll double your revenues. What does it mean for margins?
Margins, of course, will improve. As I mentioned,
16 to 18%. 16 to 20.
It will further improve. That's what we endeavor to,
Got it.
So,
got it.
That's what,
all right.
We are hoping for.
Got it, Mr. Lalpuria. All the best to you. You have done this inorganic growth. It's looking up for you. You're going to scale it up to $50 million. For the overall business, you're guiding for better volumes growth ahead and also margin improvement. Thanks a lot for joining in. For the time being, though, we slip into a short break. You come back, we'll continue to focus on markets and stock-specific action.
अमेरिका से भी बड़ा हो चुका है। आप हैरान होंगे, आज भारत का 5G मार्केट, बताऊं? बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। और ये 2 साल के भीतर भीतर हुआ है। अब तो भारत मेड इन इंडिया 6G पर काम कर रहा है। ये कैसे हुआ? ये इसलिए हुआ क्योंकि हमने इस सेक्टर को आगे बढ़ाने के लिए पॉलिसीज बनाई। हमने मेड इन इंडिया टेक्नोलॉजी पर काम किया। हमने सस्ते डेटा पर मोबाइल फोन मैन्युफैक्चरिंग पर फोकस किया। आज दुनिया का करीब करीब हर बड़ा मोबाइल ब्रांड मेड इन इंडिया है। आज भारत दुनिया का दूसरा सबसे बड़ा मोबाइल मैन्युफैक्चरर है। एक जमाना था मेरे आने से पहले जब हम मोबाइल इंपोर्टर थे, आज हम मोबाइल एक्सपोर्टर बन गए हैं। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। ये तीसरे टर्म में हमें बहुत बड़े लक्ष्य साधने हैं। हमें 3 गुना ताकत और 3 गुना गति के साथ आगे बढ़ना है।
Welcome back to Chartbusters. Well, big IPOs are all set to hit D Street. Market regulator SEBI has cleared food delivery and quick commerce player Swiggy's confidential IPO filing, and auto major Hyundai could also be set to list by Diwali in what could be India's biggest ever IPO. Vinny's here with more details.
Good morning. So yes, we're watching out for 2 IPOs this time, and Hyundai Motor, that's the first one. SEBI has given a green light for that one. Planning to raise around $3 billion in the IPO, and this is the second largest passenger vehicle OEM in India after Maruti Suzuki. They hold around 14.6% market share in the domestic market, and obviously in terms of exports also they are the second largest in terms of the PV players in India. When you're looking at it in terms of the pricing and margins also versus peers, 9-month FY24 margins, when we're comparing them, it's much better than peers like Maruti Suzuki, Tata Motors, M&M, the auto segment of that. So yes, clearly an interesting one to watch out for. In this, the parent company, that's HMC, that's Hyundai Motor Corporation, will be selling 17.5% stake via OFS, as that is what we are picking up. Other than that, Swiggy also is yet set to got a green light for its IPO. That find a confidential draft for the IPO, and now they've gotten an approval for that. The price of the IPO, $1.25 billion is the IPO size. In that, $450 million is fresh issue, while OFS is expected to be at $100 million, and likely sellers in the OFS is expected to be SoftBank as well as Porces, who's holding 33% stake. There are a lot of key investors in this as well, and a lot of interest here, so keeping an eye out on that, because the company in FY24 had managed to reduce their losses almost by 50% versus the last year, as well as revenue had seen an increase as well.
Okay, all right. Thanks a lot for that, Vinny. Well, let's shift focus then to our special segment where we get you a few ideas for profit from Money Control Pro. Nitin Sharma of moneycontrol.com joins us to talk about a stock that he's tracking closely. Nitin.
Today's idea for profit is MapMyIndia. As the leading geospatial company in India, it has delivered a strong revenue growth in the last 3 years, while broadly maintaining 40% plus operating margin. In the Q1 FY25, company's performance was dull due to the softness in the automotive and mobility vertical. That led to a 5% Q-on-Q decline in the group revenue. In contrast, EBITDA margin expanded by 5 percentage points in absence of low margin hardware sales in the quarter. Hardware sales came down sharply due to the funding shortage with G-Trophy business and had a 10 to 12% impact on the overall revenue as per our estimates. Management now has a shareholders' approval for G-Trophy funding. Therefore, hardware sales should pick up in coming quarters. Recent win of Hyundai and Kia orders should also start reflecting in the financials from the Q2 onwards. Deceleration in the automobile industry may have a near-term impact on the business, while consumer tech continues to gain strength and expected to drive the company's growth. Multiple order wins in the quarter prompted management to retain ₹1,000 crore revenue goal by FY27, FY28. However, management did not retain 40% operating margin guidance for FY25. Post recent correction, stock currently trades at FY26 PE of 52 times. Investors may use correction to build position in the stock gradually.
Okay, all right. Well, on that note, though, we'll have to wrap up on this edition of Chartbusters. You stay with us, though. Trading Hour comes up next.
आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। पुष्प, और मैं पुष्प को डिफाइन करता हूं, पी फॉर प्रोग्रेसिव भारत, U for Unstoppable Bharat, S for Spiritual Bharat, H for Humanity First को समर्पित भारत, P for Prosperous भारत, यानी पुष्प। पुष्प की 5 पंखुड़ियों को मिलाकर ही विकसित भारत बनाएंगे। साथियों, मैं भारत का पहला प्रधानमंत्री हूं जिसका जन्म आजादी के बाद हुआ। आजादी के आंदोलन में करोड़ों भारतीयों ने स्वराज के लिए जीवन खपा दिया था। उन्होंने अपना हित नहीं देखा, अपने कंफर्ट जोन की चिंता नहीं की। वो तो बस देश की आजादी के लिए सब कुछ भूलकर अंग्रेजों से लड़ने चल पड़े थे। उस सफर में किसी को फांसी का फंदा मिला, किसी के शरीर को गोलियों से भून दिया गया, कोई यातनाएं सहते हुए जेल में ही गुजर गया, कईयों की जवानी जिंदगी जेल में खप गई। साथियों,
Good morning. Welcome to Trading Hour. I'm Sonal Bhutra. With me is Hormaz Patakia. Hormaz, good morning. Well, you know, we touched that 26,000 mark yesterday finally, but we've come off from those levels. We did that yesterday itself. But yes, that level has been reached too. And for now, the Nifty is absolutely choppy. This is something that we were expecting as well, even though Dow and S&P again touched record highs, Nvidia up 4%. So a lot happened in the global markets, but the GIFT Nifty was indicating that maybe the start could be muted, and that's exactly what has happened. 24 points lower on the Nifty right now. The broader markets, they are the ones which have come in for some profit booking. So that index is down around 371 points. Like yesterday, where we did see the advance decline ratio being absolutely equal, today there are more declines than advances in the markets. The CPSE index is doing well. The banks are in the green as well. Metals did really well yesterday. They have added on to those gains, but not as much as we saw yesterday. So yes, a lot of moving parts, but Nifty choppy today.
Taking a bit of a break, right? Yeah. Usually is the case after a major landmark. We finally managed to get to 26,000. Now, okay, fine, let's take some profits off the table and then consolidate for a bit, then move higher. That has been, and today also, of course, it's the expiry for the Nifty Bank as well. So you keep that in mind for the second half of the trading session. But for now, the Nifty remaining around those levels of 25,900. The Nifty Bank too, just about the flat line around levels of 54,000 is where the Nifty Bank is. That has been the index to watch out for over the last 10 sessions, will be the index to watch out for in today's session as well. What's leading time during last week, during Thursday or Friday, the PSU Bank Index was the top performing sector, but it's now seeing some bit of profit booking. It was down yesterday, down today as well. The top sectoral loser over 1% down. FMCG index is down 1% as well, courtesy the downgrade that has come from Dabur from UBS. So FMCG and PSU banks are leading the losses. But yes, the benchmark indices remain choppy, but some pain in the broader markets.
Yes, some pain in the broader markets, and that is something which was expected to continue for a bit, but we'll see which way things go for the markets. But we have to talk about market fundamentals. Joining us now is Prashant Paroda, portfolio manager of Allspring Global Investments. We're going to talk about global markets, Indian markets, and a lot more. Prashant, good morning. Thank you so much for joining us today.
Good morning. Thanks for having me.
You know, there's so much happening in the markets. If we talk about the global front, we do have the Fed rate cut that just happened. We do have the US elections coming by as well. And markets at new record highs when it comes to India as well. Just speaking about India, you tend to be bullish on India on the longer term. But for now, do you think valuations are stretched? And in the EM basket, where does India stand for you?
So, we have several products. We kind of market neutral in the all cap product, but in the small mid cap, we are overweight India. And we think, the rally still has a lot more legs. I think a lot of people have missed the rally from a global perspective is because they look at hindsight valuations. But if you look at the earnings growth trajectory of a lot of these companies, you don't find that everywhere across the globe. And the beauty of the Indian market is, they're defensive plays too. So even if the market corrects, if you pivot to the defensive plays, you can still generate alpha. So it's not just you just buying banks, infrastructure plays. You have IT companies, you have pharma, you have healthcare. So the diversity and the breadth of the market, I think there's no market like this in emerging market space. And that's why we think, alpha generation, India is the place to be from near-term and a long-term basis as well.
Prashant, good morning. Thank you for joining in. We're going to talk about flows now, the foreign investors. There's been some bit of inflow that has come in after the Fed cut its rates. But when you talk to a lot of global analysts, they mention that valuations remain a concern for a lot of these FPIs who are sitting on the sidelines with cash. They want to wait for a 5-10% correction before they deploy their cash in. What is the conversation that you are having with your clients? Is valuation a deterrent for FIIs to pour in more money? And if the Fed continues to cut rates, will that lead to more inflows as well?
Yeah, I think the Fed cutting rates is just going to be the booster shot for emerging markets. And, yesterday we saw China rally as well. So a lot of people think it's an either or, but I think China rallying is great for the asset class as well because, India is put in a bucket. So if India is doing well, China is not doing well, overall returns aren't that great. And then people don't notice that bucket. But when every other country also starts performing and India has done the heavy lifting this year, I think everybody notices the asset class. So from an allocator's perspective, this is great. The caveat just is, US elections coming through and what it will do to trade. So if, there are two compelling thoughts. There are two candidates. One candidate, Trump, is hell-bent on opening the trade issues again. The other candidate, she's going to be more strategic, at least for now, on trade issues. So I think a lot boils down to what the geopolitics looks like on November 5th. And that is probably going to be a key concern for allocators to see how it will play out from that perspective.
So, of course, the tariff hike that could come by, and of course, China has been playing a very important role when it comes to no demand in their own country, so dumping goods outside their country. Prashant, in that case, you said there's still some legs to this rally that we'll see in select pockets. Where are you putting in your money in India? Is there something where you still see valuations are reasonable? Because you have to say valuations are stretched in the country right now.
Yes, from a historic perspective, they are stretched. But, there are still pockets, we think, whether healthcare or pharma, more defensive play, you can still, see earnings growth and you can project that, 2 or 3 years out. So you're paying a higher multiple than before, but as long as there's earnings growth, I think the stocks will still perform. So I think from our perspective, we just look from a bottoms up where the earnings growth will be. And, sometimes markets gives you opportunities where they think something is cyclical and market thinks it's structural. So we take that opportunity to get liquidity on those names. And the idea is to just reposition the portfolio where the earnings growth will be from our perspective.
Is there a pocket like that which the street currently believes is structural but you think is cyclical?
No, I think I mean, my sense is at least a lot of the infra names have run up, but one thing you have to understand is that post the elections, there is more of a pivot to the social side of things, right? And, you know, there was a scheme in Madhya Pradesh that got a lot of seats for the ruling party. That scheme is going to be deployed in Maharashtra. And my sense is if that's a successful scheme, it could be deployed throughout India. So you have to think about what it will do to government budgets and how it will constrain on the, you know, the investment side. Because so far the government has done all the heavy lifting. Like, you can't blame the government for anything. They've done their job. It's for the private sector capex to sort of pick up for real estate. And a lot of that is moving in the right direction as well. But if for some reason the government year-on-year growth slows in a certain bucket and grows in the other bucket, then you have to kind of reposition your portfolio for that.
Okay. You know, the other thing that's happening now is that big IPO rush that the markets are seeing. It's incessant. We do have approvals coming for 2 big IPOs again, Hyundai and Swiggy as well. What are you making of this rush in the markets? Anything that you've liked from the recent listings, any space? Yeah. And the 2 that are coming now, do you think those are exciting as well?
Yeah, I think, you know, people always tell me, oh, there's all this liquidity rush, but, you know, there's sellers too, right? So the market will work. Like, you'll find sellers, you know, people will sell, promoters will sell, and you'll find, and I think it's very good. Like, if you look at Hyundai, the IPO that's happening, you know, where their shares trade in Korea versus what they'll trade here will be a marked difference, because they'll be comped to whatever Maruti is, you know, at some valuation around that. But I think it's good for India, because India gets to see the growth in Hyundai India, right? So, and, you know, they've been a dominant, I mean, second player in the market for so long. I mean, so I think it's great that all these new companies are coming into India, and investors will get opportunity to take advantage of that growth. You know, someone might not like the global play, might like just the India play. So the India play would trade much higher than, you know, the global plays.
The IPO rush is all set to continue, I guess. But Prashant, thanks a lot for sparing time and joining us today to share your views on the markets and on the sectors that you prefer as well. Thank you so much for sparing time.
Thank you for having me.
And that was Prashant Baroda there of All Springs Global Investments. Time for a short break. Up next, we talk all things commodities. Manisha Gupta joins us on the other side. Stay tuned.
मर नहीं पाए, लेकिन हम देश के लिए जरूर जी सकते हैं। मरना हमारे नसीब नहीं था, जीना हमारे नसीब है। पहले दिन से मेरा मन और मेरा मिशन एकदम क्लियर रहा है। मैं स्वराज के लिए जीवन नहीं दे पाया, लेकिन मैंने तय किया सुराज और समृद्ध भारत के लिए जीवन समर्पित करूंगा।
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready.
Welcome back to Trading Hour, and Manisha Gupta now joins in to talk about all things commodities. Manisha, good morning. What's on your radar today?
Well, I'm looking at overall commodities right now, Hormuz, because there's a strong momentum here and the price gains have extended in the day-to-day as well. Well, we have seen the dollar index decline to a 14-month lows. Most of the high-yielding currencies are trading higher because the commodity currencies also are trading higher, and that is what really seems to be taking an impact. Also, the kind of statements that we've been hearing from China for the last 2 or 3 days have been having its sentiment impact. China, to begin with, has cut in its 7-day reverse repo. A reduction in RRR to inject nearly 1 trillion Chinese yuan is what they have done, and then there is also a refinancing of 37 trillion Chinese yuan for mortgage of various sectors there. Also, China has lowered today MLF by nearly 30 basis points to 2%, and the China governor has said that they are going to be looking at cutting RRR to by 50 basis points. When that is going to be done, that timeline hasn't come, but that sentiment clearly shows in case of prices is the reason you're looking at copper prices trading at a 2-month highs, aluminum at 3-month highs. You have zinc prices trading at a 4-month highs right now. We do know that gold is trading at all-time highs. In the overnight markets, we've seen silver prices gain up by 5% as well. Platinum gained up by 3% into the markets there. And then you have also the crude oil prices, which also are trading at around 1-month highs, 1.5% on gains onto this one as well, and $75 seems to be holding. So everything in case of commodities is doing well. And then to add to that, the markets will wait for the retail sales data, PCE numbers, weekly jobless numbers from US. All of that comes in the next couple of days, and that is where the next direction would come in from.
It's all about commodities today, right? You pick one up and you'll see it surging. Thank you so much, Manisha, for joining us with all those important details. The commodity markets definitely on our radar today. We'll do one thing, we'll slip into a short break. When we come back, we'll discuss market technicals with Mitesh Thakkar, also discuss his top trading bets.
Bajar at this time on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. and award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architecture.
Welcome back. You're still tuned into Trading Hour. Choppy markets today, so it's a good time to get a technical check on the markets. Mitesh Thakkar is joining us for that. Mitesh, good morning. Thank you so much for joining in. What are the charts suggesting now? Some up move from these levels, or will remain range bound for a while?
So my sense is that I think there could be some consolidation in the indices given the fact that we've had a good run. And earlier in the day I talked about waiting for the dip if you want to enter afresh, because we've had a good run. We've hit an important level on the Nifty. The 26,000 is a round number, as well as there's good call open interest there. And also is the fact that, we are overbought with the rally which we've had. So I think a similar scenario is playing out on both the indices. So maybe you will have a quieter day today. And towards the end of the expiry, which is when the Bank Nifty expiry comes into play, maybe you'll see some movement. But overall, broad bias is on the long side. I'm still positive on metal and a couple of banking names. So I have a buy on Vedanta. Keep a stop below levels of 469 here. Look for targets of 495 on the upside. And on the selling side is Bata with a stop at about 1435 for targets of roughly around 1380.
Mitesh, good morning. What would be that suitable level then that you were mentioning, a suitable dip to enter? What would that level be?
So on the Nifty morning Hormuz, the level which I'm watching is closer to about 25, 830, 850 as the support area. So around 25, 880, 890 zone, you can take a long position with a 60 odd point kind of a stop loss.
All right, Mitesh, thanks a lot for joining in, sharing with us your views on the index as well as specific stocks as well. Time for a short break. Get you more on the markets on the other side. Stay tuned. We'll be right back.
Politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
As far as India is concerned, the role and relevance and the significance of India, especially as far as the foundation is concerned, and what you're hoping to do on the innovation side.
So India's the country the foundation does the most in. Other than the U.S., that's our largest group. We have a great team there. We work a lot with the national government and many of the state governments. And not only do we see in areas like nutrition or using ultrasound to detect a difficult pregnancy, we're doing a lot of studies with our partners there, which will have a benefit for India. But also, because the digital infrastructure in India is so strong, we can try things out there and take them to other countries. You know, the digital infrastructure itself is a great example where, you know, the leadership has laid that foundation, and now both India and Gates Foundation are going to Africa and other places and saying, hey, you should do the same thing.
Was there a specific learning from this trip to India for you?
Well, it was pretty amazing in Odisha to see how the digital approach was connecting with farmers, that they had categorized which farmers were in which location, what were they growing. And so when they would see crop disease outbreak, they could notify them. If they saw weather coming, they could notify those farmers. If the market prices were changing, they could help guide the farmers. And so the digital revolution, bringing that into that agricultural sector, that was the first time I saw that at work. And you know, it's being scaled up in India. Now we'll take it to the rest of the world.
Back with us here on Trading Hour, the markets are exactly where they were when we began the show. The Nifty is still around those 25,900 levels. The Midcap index trading around 0.5% lower. The FMCG index, though, has extended its losses now down over 1% at the lowest point of the day. The Midcap index seeing some bit of recovery from the lows of the day. But the PSU Bank index and the FMCG index both are adding to their losses so far. Among specific stocks, Power Grid is the top gainer on the Nifty, and that is also because of the national electricity policy, and of course also it's find some mention among one of the 20 buy recommendations in Goldman Sachs' India strategy. So Power Grid, the top Nifty gainer, currently 3% higher. But the broader markets seeing some bit of pressure, Sonal, but the benchmark indices remain where they are.
Yes, and as Mitesh also said, he expects some consolidation to come by, right? Because we've already run up so much. So this is something which would be par for the course. We do have a lot of movers. Z Entertainment, for instance, that stock has moved to the day's high, up around 5%. And SH Kelkar, after yesterday's move, is adding on to those gains, up another 5% on SH Kelkar right now. But that is about the secondary market. We have a lot of action in the primary market as well. Big IPOs set to hit D Street. Market regulator SEBI has cleared Swiggy's confidential IPO filing. Auto major Hyundai could be set to list by Diwali in India's biggest ever IPO. As sources tells Money Control that SEBI has cleared plans for a $3 billion listing. Vinny is here to give us more details on this. Vinny.
Yes, so in terms of two big IPOs that we should be keeping an eye out, Hyundai Motor India, that is finally cleared for IPO. The SEBI has given an approval last evening, and the company is planning to raise around $3 billion via IPO. It's going to be an OFS where Hyundai Motor Corporation, that's the parent company, will be selling around 17.5% stake. So it's a completely OFS. There is no fresh issue that is happening for Hyundai IPO as of now, is what we understand. Now, obviously, this is the second largest IPO that we are watching out for in India. The first one was LIC, and now this is bigger than that as well. So yes, keep an eye out on that, because Hyundai Motor is the second largest passenger vehicle OEM in India, 14.6% market share they have just in the domestic market, plus globally in terms of exports also. They are their second largest in terms of exporters for PV from India as well. So keeping an eye out on that. Margins also better than its peers. So whether you compare it to a Maruti, Tata Motors, M&M's auto segment, the EBITDA margins for 9-month FY24 has been much better. So an interesting one there. Swiggy also has got the green light from SEBI in terms of the approval for the IPO, the confidential IPO which they filed for. Proposal is for around $1.25 billion, I beg your pardon, is what Swiggy will be raising. In that, $450 million is expected to be fresh issue, while $800 million is expected to be OFS that we're watching out for. So yes, keeping an eye out on that. We have Porses, who's holding 33% stake, is likely to be selling some part of their stake, as well as SoftBank is among the name of the OFS sellers. So keep an eye out on these two interesting IPOs.
Very interesting IPOs indeed. Vinny, thanks a lot for that. Big ones set to hit the primary markets. But Piramal Pharma is the other stock that is on our radar today, and that stock is trading with gains of up to 5%. Now, the company is saying that its estimate to be a global pharma, health and wellness company. Ekta is joining in with more details. Ekta, what were some of the key takeaways from their investor day?
Well, a couple of important takeaways from the investor day is that the estimate to be around $2 billion in terms of revenues with 25% EBITDA margins by 2030. Now, in terms of a breakup, the CDMO business is estimated to be around $1.2 billion in terms of revenue with 25% margins. Complex hospital generics, estimates of around $600 million in revenue with 25% margins. Consumer healthcare, around $200 million is what they're targeting in terms of revenue with double-digit EBITDA margins. They aim to reduce their leverage to 1x net debt to EBITDA by 2030, and they're targeting high teens ROCE by 2030 as well. Remember that the company has made around 15 plus acquisitions in the past 10 years and had 350 plus regulatory inspections which have been successful since FY12. Now, a couple of analysts have written on it. Elara has said that the goal translates to about 3,900 crores EBITDA in FY30. The estimate equity value of around 54,600 crores by the end of FY29. The equity value is around 15% annualized return from current levels. The implied top line CAGR is only about 13%, which is quite achievable according to them. The implied EBITDA margin expansion of 900 basis points is, however, a tough task according to them. Margin improvement along with targeted improvement in ROCE could be challenging for the management.
Okay, so the stock is reacting to that commentary, and of course we'll be talking to the management of Piramal Pharma very soon as well. So stay tuned for that conversation. Thank you, Ekta, for joining in with all those details. Time for a short break. An exclusive conversation with Manish Chokhani of Inam Holdings coming up on the other side.
President Zelensky, Prime Minister, recalled his visit to Kyiv, their discussions on all matters, the bilateral issues as well as issues surrounding the Russia-Ukraine conflict. President Zelensky was very appreciative of India's attention to these issues and said that Prime Minister's visit had been highly appreciated, and he thanked the Prime Minister for the efforts that he was making for peace and a pathway to finding a way out of this conflict. Both sides appreciated that there was positive momentum on a lot of issues in the bilateral relationship, and they agreed to remain in close touch, either directly or through exchanges of visits at various other levels. So far as your question related to oil is concerned, that did not figure in the discussions today. As I said, this is the third meeting in between the leaders in the last 3 months or so. A lot of the issues have been discussed, but at this particular meeting, this particular subject was not discussed.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative Is AI likely to be, or are we on the cusp of seeing that?
Hello and welcome to this special edition of Market Masters. We are in a bull market unlike any other. Comparing the current bull market to the previous one, which is between 2003 and 2007, now actually seems a bit underwhelming, isn't it? This one feels so much bigger, more broader and wider as well. And we're doing all of this with little help from foreigners. My guest today is someone who I think is one of the best articulators, thinkers about what is going on and where we are headed. I have with me Manish Chokhani of Enam. Manish, great to have you with us here on the program. Thank you very much.
Been a long time. Thanks for having me.
Thanks very much. Now, I mean, $4 billion a month mutual funds are getting. It's a flood out there. You know, and by the way, it's increased. Pre-elections, pre-June elections, we were getting about $2 billion. It's now $4 billion a month. I mean, you would have thought numbers would go down. It's actually increased. Where are we headed? With the flow picture first.
So, before the flow, I just want to take one step back. That as Indians, I'm just so happy that the kind of wealth creation which has happened in our country is unprecedented. And as you said, comparing it to 2 decades ago, while the percentage returns may look similar, the absolute amounts, remember we are at a $5 trillion market cap. And 85% of it is owned by Indians. There's only 15% foreign ownership. So the absolute amount of wealth creation which has happened in this bull run is just unbelievable. And hopefully it's a start of a virtuous cycle where you make the money, you reinvest it, you create more jobs and employment, you create more profits, and the cycle continues. So fingers crossed this continues. And like I said, the asset allocation mix of Indians, which we've been waiting for a long time to shift towards equity away from hard assets, is only just beginning. We are just 6 or 7% of assets are in equities. The bulk of it is still real estate and gold.
When this began, you know, people could have argued that maybe this is a bull market phenomenon because people are chasing things, they're seeing other people make money. But this is now continued and it's actually becoming bigger.
When you see it continuing in, you know, even through the drawdowns which have occurred, and this year we've had 2 or 3 major reasons for people to pull back. And this advent of SIPs, which the mutual fund has done an outstanding job, the whole industry, of getting people into the markets and not getting scared away at every downturn, I think is great. And remember, for context, if you remove the promoter holding, which includes the government and the 40% Indian ownership, remove the foreigners, the value of stocks with Indian investors per se is still less than the value of gold they're holding. And it's far below the value of the real estate they're holding. So it's easy to get scared away, but over the last 20 years, we never got scared that, oh my God, people might start selling gold because price is going up. And gold itself has been in a bull market during this entire episode and almost tracked the same returns as the index.
So you think this can continue? This will continue, or at some point it slacks off? What's your sense?
See, liquidity melt up. Remember we spoke last Diwali where I said in every decade since we broke this Bretton Woods gold standard and went to this dollar peg, we created bubbles in every decade. So in the 70s, it went to, you know, all the Nifty 50 stocks of the US. And of course, it culminated in the blowout of oil and gold and silver in that decade. Then it went to the emerging markets, which then was Japan and Taiwan in the 80s and completely blew off. In the 90s, it culminated in the NASDAQ bubble. In the 2000 to 2010, it came to BRICS, in which China was really the center of the bubble and commodities. And the last decade then went to TMT and the Magnificent Seven, which have got extended due to this excess money printing through COVID and so on. So for me, it looked like in context of history and market cycles that India would be the epicenter of the next bubble. And the conditions were ripe because the country is reaching a critical takeoff point. The economy is reasonably well governed. The entrepreneurship has been unleashed. The reforms are good. Infrastructure is getting built, both physical and digital. So, and this move that the youngsters were happier to take risk in financial assets as opposed to hard assets. So the culmination of all that still looks like we are still heading for a big melt-up. And I don't think it's over yet.
Where are we in that melt-up period?
If I knew that, I would be Warren Buffett, right? So that's $1 million answer.
But halfway through, early on...
No, look, I've been underwhelmed, to be honest, by the amount of foreign inflows.
Right.
Like this year, I think we have, 15, 16 billion over a calendar. The last 12 months, maybe it's 20 billion. But 20 billion has come only through the JP Morgan
So this
debt
year in
indices.
2024, FIs have put in about $7 billion
Which is
to
nothing.
work. Locals have put in 39, I think, almost $40 billion.
So that's what I'm saying. The foreigners, I think, couple of reasons, and this is just post facto justification, because I would have expected a lot more to come in. that number one, you're making a lot of money in your home market in US.
Yeah.
And if US is 65% of the world, and remember, it's a $65 trillion market. And if India, even after the MSCI rebalancing is reaching 3%, and the global funds don't frankly look at India, and they will start looking at now. But let's say you get the 3% market wrong and it goes up a lot. You basically drag off 1%. But you're making like a couple of percentage on NVIDIA every week over there. So I think that's one reason. The other side of the world, which is Japan, Europe, they are basically dead. So it's the flip of that is happening, that when you're dying in your home market, you're not really looking to invest abroad. So A, that has to happen. And it's also, I think, a reason why FDI flows have been relatively subdued, so on both fronts. Although debt flows, which we expected with the JP Morgan index inclusion and then the others to follow, those flows have started coming. So I would still expect it's not even like the first inning in a baseball game analogy of the foreign inflows into India. And the domestic flows, remember, if they keep lifting this market, they've so far only lifted what I say quadrant 4. Quadrant 1, 2 and 3, which are really the large caps, which is where the bulk of the money of the market is, hasn't yet seen massive flows. And eventually every fund manager in the world, hand on heart, is a momentum chaser. So if this market keeps performing for long, they're going to be here. Because if it were only valuations, as they all claim, then everyone would have been buying China, which is the cheapest market in the world. So I think it's a story which is unfolding. And maybe they come in through primary issuances, where again, we've not had the big companies coming with big issuances, neither from the government nor from the top 10 business houses. And that becomes then an entry point to start sucking in these flows.
Actually, I was at the JP Morgan conference yesterday, and they were telling me that there are lots of investors from mainland China there.
Interesting.
Interesting. So when we say melt up, I just want to sort of finish that point. It usually we are talking about like a frenzied move in the very short term, but that's not what you mean. You think
it makes a major long-term top, which is not a great thing. So I mean, it's great that we are going up on a wall of worries in a way that every time we meet, we are worried about, is this the end? Is this market going to fall? Will the investor flow stop?
Correct.
Will people run away? Markets don't climax at periods like that. And this seems to be more like the 90s bull market, where small caps were doing phenomenally well. And what tipped it eventually, of course, one was the Asian crisis, which happened outside our control. And B, it just got overwhelmed with supply. And that's really what capitalism should do, that prevent what I call that melt up, where the entire market goes up 10x in a decade. And then you don't see that prices for, maybe next 10 or 20 years. So I'm hoping we don't get a melt up, and supply response takes care of it. And supply is coming, but it's still what I call a quadrant 3 or quadrant 4 level supply. The big guys haven't yet come. And in the bigger ones, if I take the top 10 companies, no one is supplied. Having said that, the owners of those companies, whether it's BAT selling down ITC or Singtel selling down Bharti, that's happened. But it's not like the Reliances or the Tatas or someone has come with massive issuances, which I think is around the corner. It should come.
I mean, bankers we speak to tell that over the next 12 to 18 months, about $25 billion worth of IPOs should happen. But that is, I'm not sure how much of the...
So, Prashant, 25 also, I'm saying, is a small number now. It's a $5 trillion market cap. So if you don't do 50 billion, is 1%. So issuance is, the government ought to be doing 25 billion. The larger groups easily can take 25 to 50 billion. And this is combination of primary and, of course, QIPs and so on. We've seen promoter selling. We've seen PE selling. We've seen MNC strategic selling. And it's gone from across the world, right? If GE of US has sold, Whirlpool has sold, BAT has sold, Sumitomo from Japan has sold, Singtel has sold, and now Hyundai is approaching the market. So all these chaps are getting it right. But we still haven't come and raised the money.
And that will happen according to you?
I think it's inevitable. I mean, that's what capitalism is, right? That demand for paper will create the supply.
And we are a long way off from that climax. Or
I hope I'm not proven wrong next week, but I think this has legs to go.
This has legs to go. All right. Manish, we're going to take a quick commercial break here. Stay with us. We're in conversation with Manish Chokani of Enam.
Usually when you get new technology, it's applied in the rich world for those who are well off. And what we'd like to do this time with AI is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice, in their native language, that we actually bring these AI advances to those most in need. I mean, after all, where's the greatest shortage of doctors? It's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward, even for a topic as complex as nutrition. The AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like to address?
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was somebody young, sure, I'd compete with, OpenAI and all these people. But, now I'm in the stage of saying, how do I help other people work in AI apply it to those most in need?
Today, in Kabul, a female cat has more freedoms than a woman. The way that this culture, this society has been upended is a cautionary tale for the rest of the world. In the 70s, most of the civil servants were women, over half the teachers, doctors. There were women jurists, lawyers, in every profession. And then the world upended.
Welcome back to the special edition of Market Masters. We are sitting down with the one and only Manish Shukani of Enam. Pullbacks are a regular feature of a bull market. It's just that this one has been without pullbacks.
Yeah, see, the fun and games actually this time has not been in... so again, let me step back. The top 11 companies are 25% of India. And average market cap there is in excess of $100 billion. And I'm just taking the NSE 500 at, let's say, $4.8 trillion. Of that, 25% is $1.2 trillion, which is 11 companies. So that's $110 billion average. Nothing's happening there.
Yeah.
The next quadrant, which is from 1.2 to $2.4 trillion, has another, I think, 31 companies, which gives you that average as well over there. Again, nothing. So the top 40 companies are half of India, and which is where the bulk of the foreigners were invested, and these stocks haven't actually really done very well. Right. And when we talk financials or Reliance or whatever, they've given decent returns, but it's underperforming. Yeah. Quadrant 3 is, I think, another 80, 90 companies. So 130 companies are 75% of India's over. It's harder to lift these companies because these are in the categorization of large cap, which is over a 50,000 crore market cap.
And these 130, 140 companies, about $3.5 trillion in market capital.
75% of 5 trillion, whatever it is. Yeah. So that you pretty much nothing has happened. And this is where the coverage universe of the brokerages used to be. This is where the FIs used to invest. This is where the mutual funds buy. By definition, they are large cap.
Yeah.
All these are over 50,000 crores. The whole action has been happening in whatever the balance 370 companies, which is in quadrant 4.
Yeah.
But it's $1.2 trillion. It's still a staggering amount. And therefore, the domestic wealth creation, like I can talk of it as if it's small, but it's thousands of crores of profits being made by investors, and people who thought their companies are worth 2,000 crores are seeing them at 20,000 crores now. Because everyone's trying to lift it up and get it into a mid-cap index or get it into the small-cap index and so on. The worry to me is that end of the market is trading at twice the multiple of the market. Now, historically, yes, a smaller company can grow faster, and we ourselves made our money in, the first era was all the Infosys and ZTVs and Maricos, which were compounding like crazy in the 90s. Yeah. but very small percentage of those companies, as I just explained, will make it from their 387 list to the 30 list or to the 11 list.
Yeah.
So the stock picking which you do there is important, because if you get that wrong, God help you. And I'll give you the most famous example of the best company in India, I can argue, is Infosys. It made a dramatic top in March of 2000. It was a $46 billion market cap back then. It basically doubled in 24 years, which is, I mean, nothing wrong, but 20-year double is, I mean, drastic underperformance for a fantastic company. Company did
From
everything
the top
right.
of 2000 over the next 20 years,
46 billion to it's probably what, 93, 94 billion today. The market is up from 6,000 to close to 90,000 or 84,000, let's just say. So it's what, 14 times up. The market is 14 times up. Forget what's happened to other companies. Whereas the best company probably only doubled. And of course, I'm excluding dividends and buyback, but add a few percentage points there. But it's not that dramatic. So when you get pricing wrong in a small cap, heaven help you. And why small cap? Even from the top of 2007, when Reliance kind of went to sleep then for the next 12, 13 years, you didn't make any return. Then it quadrupled during COVID when they did the Facebook placement and so on. And I think that's really the central risk in our market, that small caps and this SMID exchange, my God, it's I think some of the indexes up 80 times in the last 3 or 4 years. What's going on there is far, far bigger than the whole worries we have on FNO. FNO is a $4-5 billion problem in a sense of the losses being made. It's not insubstantial, but in the context of what's going to happen, maybe in this quadrant 4 of the market, as I call it, and this whole SME exchange, that's going to be painful.
That quadrant
losses.
4 includes the SME?
No.
That's separate,
That's
right?
tiny, but I mean, a 12 crore issue attracts 5,000 crores of investments. Something funny is going on. And I'm not casting aspersions on the companies or the people, but I mean, who's putting 4,800 crore applications into a 12 crore issue? So something's going on, God knows. So those are the things you worry about.
Okay.
But having said that, the broader market, when I say the top 30, 40 companies, usually if something goes wrong there, that's when the market collapses. Or supply from there will overwhelm the market. But it can't be a quadrant 4 problem which blows up the market.
But you're saying that in quadrant 4, there's a problem in the sense...
The valuations are berserk over there. I mean, again, great companies, but... And again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example. Let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then, because it'll be a fairly large company. So it needs a $4 billion PAT, profit after tax. To get to a $4 billion PAT, just for context, today TCS with 6 lakh employees makes $6 billion. So is this possible? How will they do it? Will they add more lines? I mean, Amazons of the world have done it. They started somewhere and they ended elsewhere. But if you're taking that bet, your time horizon has to be that, or your return expectation has to be that much lower. And that's the sort of stuff going on over here.
Got that. I want to talk about leadership in this bull market as well. And we'll get back to what to do and advice for investors a little later. So PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But people, defense, etc., right? That part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done? Or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like, what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically, these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after, again, the last cycle. And the flip of it, sorry to just complete, the leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers, retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies. But it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very much.
And financials, right? I mean, advice for investors who are watching, Manish. I mean, because in many ways you're saying that a lot has happened. So one must be cognizant of that when you make fresh purchases.
So what happens, and again, it's something I've experienced in the past, so maybe that would be of benefit to investors, is, look, the market tends to be a 75% large cap, 20% mid cap, 5% small cap type market. And that's the distribution. Few of these will graduate to box 2 and few of these will graduate to box 1. So your normal portfolio allocation tended to be a 80-20 mix, that we would keep 80% large cap for safety and 20% to give you the alpha, to give you much better. Given that we guys also came back from, we built a lot of our wealth on the small and mid caps only. But when you start doing that, you realize your portfolio mix tilts because those companies become reverse. The small and mid become 80% of the portfolio and the large become 20. And whenever something goes wrong, like you had crises in 2008, 2018 even, for no fathomable reason, they can tend to fall 60 to 80%. And that is very, very damaging for the portfolio. And that is what really scares you out of the market. Like, again, the same famous example of Infosys. It went from 16,000 to 2,700, which is like almost more than an 80% fall in a high quality company. Because when that happens, liquidity, you'll be surprised, it just vanishes in the stock and you just can't get out. And what you think my portfolio value is, whatever, 100 rupees, it looks like it's less than 50 suddenly. So if you can just keep tilting your portfolio, that if your asset allocation is okay, that you may have maybe 50, 60, 70% of your money in equities. It's very easy right now to feel you're making so much money, get out of banks, liquidity or whatever, put it all in the market. If you're not prepared for a downturn in the market, then you'll get scared out. So asset allocation to equities, number one. Within that, what is your mix in your portfolio? Be very cognizant. Too much concentration in a small or mid category or too much concentration in one sector. Again, for example, the parallel of TMT in the 2000s. If TMT became 50, 60% of your allocation and that fell by 50, 60%, where were you? So just be cognizant of portfolio balances. I'm not suggesting this is better or that is better, but just do what's right for you and what stage of life you are at. So I'm finding people who are 60, 70. I have a cousin who's 74 years old in another city, and she's calling up and she wants to buy small caps. She wants to buy like the 3 most powerful, high volume stocks in India nowadays with 60 lakh shareholders, or is it 60 lakh or 60 million? I don't know. Yes Bank, Idea, and Suzlon. I mean, maybe it's great companies and they have a view on it. But, I mean, is it the right stock for you? First, you think about that. People will call up and, if they'll ask me, should I buy a bank? And if I end up saying ICICI or HDFC, they're like, but this bank goes up every week. Again, nothing wrong with it. But is that right for you? So just think of allocation in your portfolio and what you're doing.
And the other point I think which you made before as well, riding existing winners is one thing. Going into new things. That's absolutely right. So when you're in the middle of a cycle, most horses are going to run. Don't be impatient if in this cycle, this horse handles another. For example, if, let's say, financials haven't run and you feel, oh my God, defense and railway is running, and you leave this and you come to this horse and this horse is already run and it's ready for a downdrift or a sideways move. And you've jumped here, and you know less about this than you knew about that. It's going to be damaging again if something wrong happens over there. So I think just stay away from what I call FOMO. This is not a FOMO moment in life.
Don't get greedy. Returns have been extraordinary, and there's no reason India won't. I still think 90% of our wealth lies ahead of us in the next 20 years. If we do 4 times in 10 years, and we again repeat the 4 times in the next 10, it's 16 times.
Yeah.
Even if we don't do 16, we go 10x from here. You really have to have patience over here. That's all. You get the right companies. If they're around 20 years from now, believe me, you'll be really wealthy.
So it's not a sprint from here.
It's not a sprint. Don't
We've
try
had
to
a
keep
sprint,
jumping.
but it's not a sprint.
Yeah, I mean, it's like in an era of T20, I'm advising play like a test cricketer.
Yeah, but because you have played
Let's
T20
put it
already.
that. Yeah.
I mean, most
Yeah,
have
it's
played
true.
the T20
True.
game. Now it becomes
True.
more of a test match.
True.
Right?
So I think just be a bit relaxed. I think the country's future is bright.
Right.
The entrepreneurship is still very much there. The potential for growth over here is still very much there. When I look around the world, they're all ex-growth, highly indebted, waiting to blow up. So the opportunity is here, but just don't blow yourself up in the process.
You've got to stay in the game. You've got to be around, essentially.
Like
to
Buffett
take
used to say, 2 rules of investing. Rule number 1, don't lose money.
Yeah.
Rule number 2 is don't forget rule number 1. I think that's all you can do.
That's such a wonderful way to wrap up this conversation, Manish. Thank you so much for dropping by, and thank you for sharing all that wisdom with us.
Thanks for having me.
Thank you.
A cat may go sit on her front stoop and feel the sun on her face. She may chase a squirrel into the park. A squirrel has more rights than a girl in Afghanistan today because the public parks have been closed to women and girls by the Taliban. A bird may sing in Kabul, but a girl may not, and a woman may not in public. This is extraordinary. This is a suppression of the natural law. This is odd.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it gets a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality. Yeah.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's
Midcap see profit-taking even as frontline stocks stay ranged. Power sector plays and financial see some green even as most others drag.
Power sector stocks like Power Grid continue their climb on finalization of the new National Electricity Plan that aims to meet a peak demand of 458 gigawatt by 2032. To this end, 50.9 gigawatt of transmission capacity with an outlay of over 60,000 crore rupees has already been approved by the government in its first 100 days.
The IPO Q grows longer with SEBI clearing offers of Hyundai, India and Swiggy, while the Korean automaker is expected to raise nearly $3 billion. Swiggy's offer size is pegged at about $1.25 billion.
SpiceJet CEO Ajay Singh strikes an upbeat stance after its successful fundraise. Despite pending liabilities, eyes big expansion, but the stock slips. IL Finance too envisages a quick recovery in its gold loan book after RBI's green light.
And gold continues its ascent with the yellow metal hitting a record high of 76,000 rupees per 10 grams on the MCX exchange. Rising tensions in the Middle East, weak dollar and hopes of stimulus-led recovery in China fuel the move.
Hello and welcome to Halftime Report. I'm Nigel D'Souza and joining me is Ekta Batra. Well, Ekta, it's not too often at the midday you see the markets down 60-70 points. And the breadth of the market as well has decisively turned actually as we speak. So just keep an eye out on the screen. As of now, it's looking a little bit jittery. Your portfolio may not be feeling too good. But I'll tell you what, we've had a big run in the last couple of weeks. So some kind of profit taking is par for the course, one would say. Just a few stocks that I wanted to highlight. Easy Trip, the promoter entry went ahead and they sold some stake. Initially the stock was down, but just take a look at what's happened right now. Now it's down a good 15% as we speak. So the street doesn't like that. SpiceJet, we had, the MD, Mr. Ajay Singh, assuring us pending liabilities will be taken care of. He believes that expansion plans are on track. But the stock is down close to 7% after being down nearly 7% yesterday. So the street is not buying that. And now it's moving to below that QIP price, which will make investors very nervous. So just keep an eye out on that. And Vodafone Idea as well, they did a fundraise at around 11 rupees. Post that, we saw a bit of a bounce on Monday, but the stock can't get past that level. And I think till it decisively gets past the 12 rupee mark, we could see supply pressure continue on Vodafone Idea. Ekta.
Hi, Nigel. Well, yes, absolutely. On that point, we need to learn how to temper our enthusiasm with the markets as well. For example, the Nifty is up around 19% on a year-to-date basis. The Midcap index is up around 31% on a year-to-date basis. So we're sitting on hefty gains in any case. So a little bit of profit booking, a little bit of consolidation should probably be par for course. And not to mention gold prices, which are now up 18% on a year-to-date basis, in fact, giving competition to the Nifty in terms of gains. But nonetheless, let's talk about specific stocks. Let's focus on Pharma, which is in focus. The stock is up over 5% in trade today. The company said that it estimates to be a global pharma health and wellness company by 2030. To discuss the roadmap for this and a lot more on their CDMO business, consumer business and more, I did catch up with Nandini Piramal, who's the chairperson of Pharma. Listen in.
One of the things we wanted to do was say, what do we want to be by 2030? And as you rightly said, we want to be a $2 billion company. But one of the other things we also want to do is increase our EBITDA to 25%, which means a tripling of EBITDA. And in the meantime, we also want to reduce our debt to EBITDA ratio to 1, less than 1. So the way we plan to do that is our three businesses, we believe that there are secular and macro tailwinds that will help us. In the contract manufacturing business, we want to focus on innovative work. Last year, our innovation work was about 50%. We want to focus on integrated projects which cross more than one site, whether it's east and west or even two sites. And we want to focus on cross-selling and deepening our capabilities. Third, our differentiated offerings, whether it's antibody drug conjugates, high-potent API, sterile fill finish, also give us very good options to work with customers. And that's the things that attract customers to us. They're kind of magnets and help us get that more RFPs.
You're expecting a tripling of EBITDA. You're estimating margins of 25% by 2030. Till now, the margins have been extremely volatile for the company. How do you expect to achieve 25%, and is that a sustainable rate?
We do think 25% is sustainable, and the way we want to do it is primarily by doing operating leverage. As we increase utilization at our sites in the CDMO business, we expect that operating leverage will flow through to EBITDA. As we actually do higher quality revenue, whether it's the innovation or the differentiated offerings, those margins are higher, and we expect to see that benefit as well. We're also continuing our focus on operational excellence and cost and procurement, and we'll continue to manage that.
What is your near-term guidance for the margins? Because in Q1, there was an improvement year-on-year, but overall, the trend has still been volatile.
I think overall, we're still saying for the year, we want to keep early teens, actually mid-teens growth and improvement in EBITDA and a significant improvement in PAT this year. So I think we're going to stick with that at the moment.
Okay, so that means that you all will be in the black on the bottom line?
Yes.
Okay. What is your guidance in terms of profitability by 2030? Because the other concern has been the volatility in terms of your profitability or your losses which the company has been making. Can you give us a sense in terms of what the profit target would be?
The profit target will, see, as EBITDA improves, we will see an exponential improvement in PAT. I can't actually give you a specific number, but we will, because EBITDA will improve and debt to EBITDA ratios will be lower, we do think there will be a significant improvement in PAT. But one of the things is that the year is cyclical, so sometimes in the first quarter it is a little bit lower, but and the way the fixed costs work, there might be a loss, which there was the first quarter, but we expect to be in profit for the year.
The company's targeted $1.2 billion from CDMO segment. What is the expected driver? Can you tell us how much is probably going to be innovation-led CDMO, which is around 50% of your business? How much do you expect that to grow to? And how much will probably be from emerging biotech, which has faced funding problems in the US?
So currently, our innovation-related work and our differentiated work has been growing faster than the others. And we expect to continue that going forward. We also and it's hard for me to give you a number between emerging biotech and big pharma, because what is happening is innovation is happening in emerging biotechs, but they often get bought by big pharma. So what we're seeing is right now a third of our business is between generic pharma, then a third by emerging biopharma, and a third by big pharma. But what has happened is we've often started our business in emerging biopharma. They get bought by the big pharma, and sometimes the big pharma don't change it. So that's the benefit is, so I can say I can start out in emerging pharma and then it becomes big pharma. So it's very hard for me to give you a number.
Okay. All right. But overall, the trend has been higher order intakes for the CDMO business, considering that in Q1, your revenue was up 18%.
It has been higher, and where the leading indicators of requests for proposals have been very good. Obviously, biotech funding is still a challenge. Over the year, it has been better than the last 2 years, but it's not reached the peak yet.
Okay. $600 million from complex hospital generics, which is basically your anesthetic products, etc. You've been facing pricing pressure in some of your key products in the US. Where does that stand currently? And do you expect all of these factors to probably settle? How much of complex hospital generics will be from the US? How much of it will be from other geographies by 2030?
So the biggest market is the US, and so obviously we will continue to focus on it and grow products. We will add new products to that and expect to see revenues from the US still continuing. In particular, in inhalation anesthetics, we have about 40% market share there. We don't expect that market share to grow too much, but we will continue to focus on growth outside the US for inhalation anesthetics in particular, because we don't have as much market share in those places. But in the other complex hospital generics and the new products that we intend to add, those will be focused on the US and Europe.
And pricing pressure?
This is a generics market. There will always be pricing pressure, but the pressure is, I would say, slightly less than other generics because there are just fewer competitors.
All right. Consumer health, that's been growing in double digits. Your power brands such as Little's, Lactocalamine grew around 19% in Q1. You're estimating $200 million in terms of sales. How much do you expect the growth rate to probably accelerate within this segment? What do you expect it to be driven by? And any kind of monetization plans for this particular segment, which is, playing into the consumption story of India?
I'm very excited about the consumption story of India. I think there is a great value for money consumer products, and especially as the Indian urban class is growing, they're focused more on health and wellness. So that's something I'm very excited about. I think our power brands, that's the things that we will focus on, whether it's in promotions or whether it's in new products. Over the last few years, we've seen the growth, and we expect that will continue growth. Our tail brands will continue to grow at market rate, and as they grow bigger and at the right time, we'll decide if we want to actually invest in media and promotion then.
Your net debt to EBITDA has improved. It was around 5 times at the end of Q1 FY24. It's 2.8 times as of Q1 FY25. And now you're targeting even a lower net debt to EBITDA, around 1 times by 2030. Give us a sense in terms of the trajectory. Where does it stand today? And what can we expect subsequently in terms of reduction?
So right now it is 500 million approximately, and net debt to EBITDA. We intend to reduce it as a ratio because we will be growing EBITDA and we will use some of our free cash flows to both do CapEx as well as reduction in debt.
Okay, so when do you expect to get to 1 times? Would it be probably
by 2030 for sure? But it will be, the ratios will be reducing across.
What does that mean for M&A? You've done around 15 M&As till now, which have been successful. What would your M&A strategy be, considering that you will also want to reduce debt?
We'll continue looking at M&A. I think if we see the right opportunities at the right price and basis our debt and cash flows, we will look at them.
Okay. Quickly, before we wrap up, Nandini, wanted your thoughts on the Biosecure Act. And it's been passed by the lower house in the US government. What is your sense in terms of an opportunity from the Biosecure Act for Piramal Pharma?
I think the Biosecure Act hasn't been passed yet by the Senate, and it does have an 8-year time period. But what it has forced everybody to take a look at and see what is their strategy for their supply chain. And one of the benefits that we have at Piramal Pharma is that we can offer an East and West solution that doesn't include China. And I do think that is an opportunity.
Okay. But are you seeing only more queries at this point in time, or are you participating in pilot projects?
So in the CDMO business, it is a long sales cycles. And so people are sending out a lot of RFPs, but I don't think anyone has decided yet.
Okay, so that is the management of Piramal Pharma talking about the Investor Day highlights which took place. The stock is up around 5% They have tall targets of around $2 billion in terms of revenue, as well as an EBITDA margin improvement all the way to around 25%. To put it into perspective, they did around 10 to 11% margins in Q1 of FY25. So they are expecting sustainable improvement and a reduction in debt going forward as well. So that's the word coming in. We'll take a short break, but up next we'll get you more on the markets. We'll also connect with Biju Mohandas of Leapfrog Investments to focus on opportunities in the healthcare space. Stay tuned.
So, I mean, are you a little more...
So my question is all geopolitics, which may determine the state of the economy. Okay. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries getting involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate, the vicissitudes of the economy. But we are spending a lot of money, and in my view, that spending the money causes growth. It also causes inflation, and whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm put me on the cautious side of that one.
investing.
Welcome back. Well, the markets are still sitting with a cut of around 50 points or thereabouts, but Godrej Properties, that's really bounced back. And we had made this point earlier that Godrej Properties, if it can defend the 50 DMA, it'll see a good bounce. It went multiple times to around 2,850, 2,880. And from there, it's seen a bit of a bounce. So you pull up the last 1 month chart. Numerous times it went down to that 50 DMA, and from there, it's seen a bit of a bounce. Now it's at the high point of the day. So that's one of the outperforming stocks, so to call it. The one on the flip side, though, is Granules India. That slipped 1% just in the last 10 minutes or so, and now it's down close to around 3% from the high point of the day at the day's low, Ekta.
Okay, all right. So yes, that's Granules India. That's stock down around 2.6%. Remember, one of their biggest plants has received a Form 483, which was quite scathing. But nonetheless, let's talk about one particular segment, and this is our segment on private equity on Halftime Report, which is called Fundraise. We do have Biju Mohandas, lead of healthcare investment strategy, Leapfrog Investments, joining in to discuss their strategy in terms of private equity within the healthcare space. Biju, hi, welcome to the show. Well, you do have a portfolio of investments as of now, and that, ranges from MedGenome to Healthify, as well as the likes of diagnostic companies such as Redcliffe. Just give us a broader picture in terms of what the healthcare strategy is when it comes to private equity, and how much money do you have currently deployed?
Sure. Thanks, firstly, Ekta, for having me. With respect to our investment strategy in healthcare, it's driven by three factors. We are an investor that invests across Asia and Africa, from countries ranging from Nigeria all the way to Philippines. India is our biggest market, where we have our largest set of investments. And across all of these markets, three trends really drive our investment strategy. One, we are seeing rapid urbanization. If you just look at India, over this decade, the 2020s, we will have another 100 million people living in cities and towns. A large number of them will be in the tier 2, tier 3 towns and cities in India. And this in turn results in massive opportunity to provide good quality healthcare, among other services, to these people. So that's one major driver. The second driver is the rise in non-communicable diseases across all of these markets that I spoke about, and India is no exception, being the diabetic capital of the world, with a massive morbidity, mortality resulting from other chronic ailments as well, like cardiovascular diseases and so on. And then finally, across, again, all of these markets in Asia and Africa, you see a massive mismatch between the demand and the supply, as well as availability of infrastructure and resources like talent. At the same time, technology is emerging quite rapidly. So we see the opportunity to use technology to act as a force multiplier of doctors, of healthcare infrastructure, and help meet the demand-supply mismatch. So across these three drivers, urbanization, growing burden of non-communicable diseases, people living longer but not very healthy lives, and the opportunity to leverage technology to act as a force multiplier, we anchor our strategy in the healthcare space.
Correct. But Biju, I wanted more numbers from you. If you could tell us how much you've deployed currently in terms of investment within the Indian healthcare private equity space.
Just in Indian healthcare private equity space right now, we have about $130 million deployed currently.
Okay. You have $130 million deployed currently. What kind of investment horizon do you have in terms of a timeline for these investments?
We are a standard private equity firm in that respect. Our typical investment horizon is 5 to 7 years. We come in, our strategy and unique value add is helping founders, management teams institutionalize, improve governance, help drive the specific organic, inorganic growth that will result in value appreciation in the company and the impact that it has on its consumers. So we support all of that, and that takes about 3 to 5 years to really put in place. And subsequent to that, we tend to look for exit options.
Okay, all right, fair enough. You have investments in, companies such as Redcliffe, which is in the diagnostic space. What is your sense in terms of growth there, considering that it is quite an overcrowded market?
Well, on the one hand, you could say that it is overcrowded. On the other hand, if you look at the utilization of diagnostics in India per capita, it is it's very, very low. So there's a massive opportunity for continuing growth. Even if you look at the current ecosystem, among the top listed players, they account for, top of my head, I would like to say 10 to 15%, if that, of the market share, with the rest being regional players and hospitals, and then the vast chunk being fragmented mom and pop operators, right? So top of my head, if you were to ask me for a number, I would say 30% approximately of the diagnostic market today is provided by some sort of corporate entity. And the 70% is fragmented, unconsolidated entities. And that is where the growth is going to happen. I mentioned urbanization. Redcliffe has driven bulk of its growth from tier 2, tier 3 cities and towns, places like Guwahati, Agartala, and so on, where there hasn't been I'm forgetting the word you used, but the overcrowding. It certainly is not true of a lot of these small tier 2, tier 3 towns and cities. So yes, I do think for disciplined operators who are looking to provide really high quality service with the affordable pricing, the sky is the limit, really.
Okay. What is the kind of return you're envisaging on your portfolio, your healthcare portfolio?
We would expect the standard returns in the 20-25% dollar IRRs. Some obviously end up doing significantly better than those, some not as much, but overall, that's the ballpark that I would expect from our portfolio.
Okay. Any of these companies which are probably going to go to market and where you'll probably see an exit via an IPO?
Look, right now, the Indian IPO market, particularly for healthcare, is really, really attractive. As we build many of these companies out into the future over the next 3 to 4 years, they're exiting via an IPO in India is a very real possibility. We haven't yet finalized or gotten into specific IPO preparation for any of these, but overall, we would want the standards in our portfolio company by the time we are starting to look for exit to be such that they should be able to list in the public markets. And as I mentioned, listing in the Indian Stock Exchange, particularly for our healthcare companies, is probably option number one, though there are other options as well.
Okay, and what is the pipeline looking like for further investments?
It is a very vibrant pipeline. We have opportunities ranging from hospitals in tier 2, tier 3 cities and towns. We have very interesting opportunities to leverage technology to access a force multiplier, as I mentioned earlier. There are very interesting themes playing out as the China Plus strategy takes shape on the manufacturing side, medical devices, but also pharmaceuticals. So across all of these spaces, the pipeline is quite rich in India right now.
Okay, all right. On that note, Biju, we're going to let you go. Thanks very much for joining in and speaking with us. So that's the word coming in from Leapfrog and their investments which are focused in the healthcare space in India. Well, for the markets, it's turning out to be a day where the mid-caps are seeing further pressure. So we have the mid-cap index, which is down around 1% at this point in time. And we have the advanced decline ratio, which is favoring the declining side. So around 850 odd stocks advancing to around 1,500 stocks declining at this point. Otherwise, the Bank Nifty just about holding its head above the water at that 54,000 level. So just watch out for that. But let's cut across to Ashmit, who's in conversation with Gopal Vittal, who's the MD and CEO of Bharti Airtel.
Mr. Vittal, thank you so much for joining us on CNBC-TV18. The first question I wanted to ask is, we already have applications such as Truecaller. The TRAI is working towards caller name display. How is this AI path solution different?
So the advantage that this solution has is that, firstly, this is a menace. So everybody, more people working on it, better it is, right, for the industry, because there's a problem for the customers. I think what our solution does is that it doesn't require an application. The application you referred to requires an application, right? So ours doesn't require an application. Secondly, like I mentioned on CNAP, you will know a user calling, XYZ calling, but you don't know whether he's a spamster or not, and you could still be frauded. So what our solution does is actually uses over 250 parameters on a real-time basis across every single call and every message on our network, which is roughly 1.5 billion SMSs, 2.5 billion calls, and alerts the customer if it's a spam, suspected spam. We have seen tremendous power in this in the last 6 months. It's an AI model which is constantly learning. We've seen a 97% right identification of spam calls, 99.5% right identification of spam messages. So we're very excited that this will really put power back in the hands of the user to know that they have been protected.
When does this go online, and what will the user experience look like? What will it reflect on my interface on my smart device?
So it will go live from tonight, starting midnight. So tomorrow it was really when it will be active. What the user will see is on the dialer, the number is flashing, the dialer. Above that, he will see a big, bold, suspected spam. And for the SMS, when the SMS shows in his inbox, above that he'll see suspected spam. So that's what we'll do.
One final question. You will have with you a long repository of bad actors. Yeah. Are you open to sharing this information with other regulators, other telecom companies?
Yes. To the benefit of customers, if there are bad actors, we are absolutely open. We have to set up a mechanism. This is the reason I wrote to the CEOs to share what are the B2B customers, so that we can identify those who are not legit and do something about it.
Wish you the very best, sir. Thank you so much for joining us.
Okay, all right. So that's the management of Bharti Airtel. We need to take a short break, but Pritesh Mehta of Yes Securities will join.
Will join and help us out with some trading strategies. Don't go anywhere.
President Zelensky, Prime Minister, recalled his visit to Kyiv, their discussions on all matters, the bilateral issues as well as issues surrounding the Russia-Ukraine.
Welcome back. Well, let's take a quick check on the options data because these strikes will expire tomorrow. Tomorrow you have the monthly expiry that will play out as well. So let's get them up for you on the screen. We've been making this point that 25,900 call, it's seeing a fair bit of open interest build up. And now the premium has come down by close to around 35%. The indications are the bears believe they can defend this 26,050 odd mark just between today and tomorrow. If in case we can get up and running beyond the 26,050, 26,100 odd mark, maybe we can have a big spurt on the upside. But for the time being, it appears, going by both these two strikes, 25,900, 25,950 call, both of them are seeing massive open interest built up with the premium down 35 to 40%. On the downside, though, the 25,900 put, there's a mix of activity out there. And though the markets are down, you're not seeing the premium spurt up. So that's telling you there is some writing that's taking place at those levels as well. So keep an eye out on that particular strike in the near term. That's between, this week itself. The bulls will count on the 25,700 level odd holding out. So, that's the broad options picture that we're looking at. But let's get in Pritesh Mehta of Yes Securities. Hi, Pritesh. Good day and good to see you in. How would you trade the index? Will you be looking to buy the dip, or do you think a couple of days of consolidation, maybe a mild couple of percentage point pullback, and then you look to get in?
Hi, Nigel. Good afternoon. I think you said it correctly. I think we could see a bit of consolidation, a bit of retracement. The trend is on the upside. See, when I look at this market in current scenario from a slightly broader perspective, it's a risk-on trade we are talking about. MSCI EM index is about May 2022 peak. MSCI World Index, the developed market index, it is trading at all-time high levels. A volatile metal space have made a comeback, and believe me, there is more room on the upside in this particular space. Dollar index, it is attempting to break below the 2023 low. So I think if you put all these things together, I think we are likely to see more upside in this market from here on. Yes, and also leadership space, that is private bank index, financial space, they have broken out of multiple resistance zone. So I think if we conclude the things in a short, in a shorter duration, I think we are likely to see more upside. As I mentioned earlier, bit of retracement expected, but when I look at my upside count, it is open to 26,600.
Okay, 26,600. Got it. What about individual stocks then? You're sounding very, very bullish. And the good news is the one that's led us up till here in the last 1 month or so has been the Nifty Bank. Even on a day when the Nifty is down 40, 50 points, that's holding its ground. Tell us about your stock calls.
Yes. Along with Nifty Bank, Nifty Financial also played an important role in this rally. So from the financial space, we like SBI Life. It's a continuation pattern in play. We have seen series of double top buys, and we have seen follow through the bullish anchor column. So buy for a target of 2100. Stop loss would be around 1780. The second stock that we like is from the auto space, Escorts. We are talking about a bullish ABC breakout, and we can see the stock has bounced back from this 10 column average. It has already rallied by 11% this month, but I'm expecting more from the stock. So buy for a target of 5500.
Okay, all right, Pritesh, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's the word coming in on the technicals. We need to take a short break, but more on the markets once we're back. Stay tuned.
President Zelensky was very appreciative of India's attention to these issues and said that Prime Minister's visit had been highly appreciated, and he thanked the Prime Minister for the efforts that he was making for peace and a pathway to finding a way out of this conflict. Both sides appreciated that there was positive momentum on a lot of issues in the bilateral relationship, and they agreed to remain in close touch, either directly or through exchanges of visits at various other levels. So far as your question related to oil is concerned, that did not figure in the discussions today. As I said, this is the third meeting in between the leaders in the last 3 months or so. A lot of the issues have been discussed, but at this particular meeting, this particular subject was not discussed.
Welcome back. Well, Dabur is under pressure after UBS downgraded the stock, citing rising downside risks. Vinny is here with more details on that.
Good afternoon. Yes, Dabur clearly under pressure today. UBS has downgraded to a neutral rating. Target price is 700 rupees per share. Now, the key risk that they are highlighting is that the potential sales of real juice that could be impacted because there's a rise in competition in terms from cola players. So, Campa Cola by Reliance that was launched recently, where it was launched at a bit of a reduced price. So, that could create a bit of a pricing pressure, and a price war is what one could be watching out for from the carbonated soft drinks players, which could be impacting real juice, which accounts to around 9 to 10% of their sales. Even heightened competition in terms of oil that is increasing, coconut oil, which is we've seen new entry coming in from Bajaj Consumer as well. So yes, that overall the sales from coconut oil accounts to 2 to 3% of their business. So because of increase in competition, there's a concern around that. Plus valuations are obviously trading at quite high in terms of the levels. Rural demand surely making a recovery, but does it merit in terms of the valuations it's trading at? UBS doesn't find it that attractive, though they said that the long-term story for Dabur, yes, that continues to be in place, and there's a limited risk in terms of demand that is there from the festive side. So keeping an eye out on that, but some bit of a pressure is what one could expect from Dabur. UBS downgrading the stock.
All right. Thanks a lot, Vinny, for joining in and filling us in on reasons why Dabur is under pressure today. Well, for the time being, though, we'll slip into a short break. You come back, we'll continue to focus on the markets. We'll also tell you about IEX. The stock is under pressure after getting trounced 10% yesterday. It's down another 5%.
News which just came out, a government-to-government deal between US and India to set up a semiconductor fab unit in the country.
Right.
There are elements of technology transfer, etc. That's the cutting edge semiconductor, and sort of plans to localize production. Right. I just wanted your thoughts.
Well, I think it's great. I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other. And I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have an interest in. And the second is just, a better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. National security is being prioritized, as you said. Do you see this as part of that in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have, the twin of permitting. It's not going to work. So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead. Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do.
Well, no, it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security, and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
Welcome back. Keep an eye out on Stovecraft. The stock was down yesterday when the markets were fairly stable, just came off a little bit from the top. But currently, that's bucking the trend and Stovecraft has taken off. So the stock has moved back towards the high point of the day. Now up close to around 5% in a market that's actually seeing selling pressure in the broader markets. But the one that's really got a pounding yesterday as well as today is IEX. Vivek joins us to give us a bull versus bear case scenario on this particular name. Vivek, it's almost a 200 rupees stock. I think from the time this news came, it's down from 235 to 200 rupees in a matter of 24 hours.
Well, absolutely right. It was the single biggest risk factor as far as IEX was concerned. Most of the brokerage that had upgraded the stock, from July onwards after seeing Q1 results and also after seeing the slow progress as far as, the grid implementation was concerned, they had highlighted this as a risk. And what's actually happened is that it appears as though this particular key risk of market coupling is something that may play out sometime in the future, and this is what is keeping markets, very worried. Very interestingly, remember yesterday the stock fell over 11%. Today the stock is in the F&O band, and despite that, it's seeing quite a sharp down move. Delivery percentage yesterday was close to 26%. Let's have a look at the bullish case. Post the news, we are analyzing what analysts have put out. Investec yesterday said that number one, it is a good opportunity to actually buy the dip. They believe the simulation that is being conducted should actually show if the coupling is beneficial, which in itself is not clear. He's also saying coupling software needs to be prepared and then also stabilized. Need to see how other exchanges react in terms of pricing. Operationally, is it possible that they will be able to handle bigger market shares? So he actually goes ahead and advises this particular dip as a buying opportunity. But bear case, what is Elara saying? Elara is saying market coupling can lead to significant market share loss from the current around mid-80s, 84% to close to 70% by FY27. And they see a 19 to 20% EPS cut as far as FY27 EPS estimates are concerned. IIFL also believes that market coupling is negative for IEX. They see this particular move could risk IEX dominant market share in the collective transactions, and they see almost a 25% cut to their FY26 EPS estimates in case this key risk of market coupling plays out. But markets at this point of time clearly don't like the uncertainty, and IEX is seeing significant selling pressure.
Okay, perfect. Thanks, Vivek, for explaining all of that to us. For the time being, we slip into a short break. On the other side, Manisha Gupta joins us with Philip Newman, the MD of Metal Focus.
reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation will look at it and say, we can't rely on someone who might one day be an adversary, that doesn't make them an adversary today, for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like, if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. There's semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got U.S. elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that? I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one. So that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
They say that the proof lies in the pudding, but this SEBI study is neither the proof nor the pudding that many F&O traders would want to see, read or hear. Now, 1.8 lakh crore rupees. Now, that is the cumulative loss made by individual traders within the F&O segment between FY22 and FY24. That's the big number from this latest SEBI study. Now, a study that the market regulator released last year said that 89% F&O traders lose money. Now, that number remains where it is, as 9 out of 10 individual traders in the F&O segment continue to incur quote-unquote significant losses. Now, let's tell you more about those significant losses, including transaction cost. The average loss of over 93% or over 1 crore individual.
Welcome back, and joining us now on the show is Philip Newman. He's MD Metal Focus. Philip, hi, thank you so much for joining us. All-time highs yet again, another day for gold here. 2660 is done, and it's not just the dollar terms that we are making all-time highs. It's in Indian rupees and Japanese yen and Chinese yuan and euro and various other currencies as well. How do you see this one-way surge continuing for gold?
Well, first of all, thanks for having me on the show. It's good to be here again. I think the point you make is really on the money in the sense that because we are having these highs in the range of currencies, not just the dollar gold, that gives you a sense that this is not simply a currency play. We are having investors coming into the market in a meaningful way and obviously driving gold higher. Of course, we have the 50 basis point cut behind us. Expectations are, of course, that the Fed will continue to reduce rates, perhaps not at that pace, of course, this year, but that will carry on into 2025. And unfortunately, the other factor that is obviously out there from a geopolitical standpoint, what's going on in terms of Israel and Lebanon, and unfortunately, how that may escalate. So I think those are, two of the factors that are really out there and encouraging investors to come into the market and potentially push it higher as well.
Philip, as the line goes, what goes up comes down. So should people be taking profit, or you think the way the situation is, even if a correction does come, isn't going to be so steep?
Well, I think there's always that risk that you will have profit taking, especially when you are reaching these unprecedented highs and fairly quickly as well. The way we've sort of gone through the 2600 and crashed through that and apparently at holding at those levels, I think it's quite likely that you will see some profit taking from investors. So you could very much lose that momentum and see gold potentially fall quite steeply. I think the other thing we have to think about, Manisha, what's happening in some of the physical markets as well, which have been so important in terms of really helping to provide a very solid floor to the gold price. And I'm thinking, obviously, India and China both are trading at a discount. Speaking to my colleagues today in both markets, India seems to be around the $20, $25 level. In China, we're around the $12 level discount. So that gives you a sense that these markets have backed off. And so I think we can see, which point will they come back into the market. So I think that's something we are certainly looking out for. And so when you bring that all together, I think, yes, you are certainly at risk of a correction. But I think also it could be short-lived. We still have that positive momentum in the market. I think there are still those investors, and it's something we've spoken about on your show many times, those investors that perhaps have missed out on these levels that we're seeing. And so if gold was to, fall perhaps, towards, say, the $2,400 level, I think that would encourage a lot of investors to come back into the market. And so that would suggest that any correction would be, fairly short-lived, I would suggest.
Oh, absolutely. I'm sure a lot of people are waiting on the sidelines to, hop into those kind of corrections there. But Philip, also about silver, and this one also continues to surge higher. How are you looking at the current prices, the very, very strong fundamentals, and what would you say about silver, let's say, 2 years from now?
Well, so it's a very good question there. So, as you pointed out, silver is doing pretty well, but the ratio against gold is still pretty elevated. It's come down to around 83, I believe, this morning or today. So it's still, I guess, underperforming gold. I think investors are looking at that. But I think a dynamic that we've seen play out over the past, few weeks and months is that, on occasion, when gold, reaches these levels and institutional investors think, well, perhaps, at least for the short term, the upside may be contained. Let's think about silver. And we see some of those investors switch their focus to silver, and then it can do fairly well from an investor standpoint. But you're absolutely right also that the fundamentals are very healthy. On the industrial side, the largest end use is the solar market, the photovoltaic market, as we call it. That's still going great guns, and we think will continue to provide that solidity in the market. Obviously, the price-sensitive areas are struggling, but given those fundamentals are pretty healthy, well, I think silver could at least get into the mid 30s and potentially push on from there as well.
All right, so mid-30s for silver and gold. If I can push for a quick word on that, Philip, what's your sense on where the gold prices could be headed?
Oh gosh, well, I think we're still playing to catch up with where gold is really. I think overnight it got up to about 2670, around that. So it does seem as though investors are pretty aggressive in pushing it higher. It seems as though, is 2700 possible? I think that would still be quite a push, even though we're only $45 away as we talk today. I think there could be a wall of selling as we reach that level or approach that level.
Well, it's all about numbers right now, isn't it? And we will keep an eye on all of that. Philip, as always, thank you so much for joining us with your sense on gold and silver, both of those commodities which clearly are making the headlines for many days now. But with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.
Stood at 2 lakh rupees each. If that is not enough, the top loss-making traders raised the bar higher. The top 3.5 loss-making traders averaged a loss of 28 lakh rupees per person, of course, including transaction costs. Again, all of these figures between FY22 and FY24. So does anybody make a profit? Absolutely. A staggering 1% of the traders in the F&O segment made a profit over the last 3 financial years. And if there ever was a gulf between domestic and foreign traders, the upcoming graphic will show you that. Proprietary traders made a profit of 33,000 crores in FY24 before adjusting for transaction costs. FPIs made a profit of 28,000 crore, and putting these two numbers together, the individual traders made a loss of over 61,000 crore rupees in FY24. So how did these traders manage the profit? Now, most of these are generated by larger entities using algorithms. 96% of proprietary profits and 97% of FPI profits are generated through these algorithms, according to the SEBI study. Now, if you wondered that the SEBI study from last year would act as any deterrent to youngsters from venturing into this unknown territory, that has definitely not been the case. The number of traders below the age of 30 within this segment has now risen to 43% from 31% in FY23, and 72% of the total trader base is beyond the top 30 cities of the country. Shows you the extent of the F&O penetration in India. Now, if there would be a study that proves F&O penetration being faster than insurance, don't be surprised. We spoke to you about the losses that individual traders made that ran into lakhs of rupees. 75% of those traders had an annual income of less than 5 lakh rupees. And I'll end with possibly what is the highlight of this report, and nothing better can describe this than a famous Hindi film dialogue, and I quote, "रोज आते हैं इस उम्मीद में, आज जीतेंगे, कल जीतेंगे, परसों जीतेंगे और रोज हारते हैं." Now, why do I say so? Because despite making losses for years, 75% of these F&O traders continue to trade as per this SEBI study. So there you have it. Foreign algo trades making money in F&O while the individual retail investor continues to struggle. Of course, what people do with their money is an individual choice, but these stats would definitely set alarm bells ringing for sure. Midcap see profit taking even as frontline stocks stay range bound. Power sector plays and financials see some green even as most others drag. The 10-year bond yield touches fresh 32-month lows on rising hopes of a dovish RBI in the October policy.
Power sector stocks like Power Grid continue their climb on finalization of the new national electricity plan that aims to meet a peak demand of 458 gigawatt by 2032. To this end, at 50.9 gigawatt of transmission capacity with an outlay of over 60,000 crore rupees has already been approved by the government in its first 100 days.
The IPO Q grows longer with SEBI clearing offers of Hyundai India and Swiggy. While the Korean automaker is expected to raise nearly $3 billion, Swiggy's offer size is pegged at just around $1.25 billion.
SpiceJet CEO Ajay Singh strikes an upbeat stance after its successful fundraise despite pending liabilities, eyes big expansion, but stock slips. IIFL Finance too envisages a quick recovery in its gold loan book after RBI's green light.
And gold continues its ascent with the yellow metal hitting a record high of 76,000 rupees per 10 grams on the MCX exchange. Rising tensions in the Middle East, a weak dollar, and hopes of a stimulus-led recovery in China are fueling this move. Good afternoon. Welcome to Business Lunch here on CNBC-TV18. I'm Horvas Patakia. With me is Vinny Motiwala as always. Vinny, it seems to be a sluggish sort of a day for the benchmark indices at least, but the broader markets are not having a very good day.
Absolutely. Broader markets are not having a very good day. You know, they are twinning with me, decided to twin with me. Some bit of a profit taking is what we're seeing here, because in the last few trading sessions, we had seen broader markets actually outperform the benchmark indices. Look at the Nifty 50 also, not much of an excitement, right? Off the day's lowest point, almost at the day's lowest point is the Nifty Midcap as well. So not much of an excitement there. PSU banks, let's pull that up, right? Nifty PSU banks, that's also down and out on trade, among the top sectoral loser that we're seeing coming in for the Nifty PSU bank. So yes, not much of an excitement that we're seeing coming in here. A lot of individual stock names also, whether in the mid and small cap side, that we're seeing a bit of a fall coming in. So let's talk about Ease My Trip. That's down almost 15% in trade. We also had Gillette that was under pressure, down almost 2 to 3% as of now as well. So let's pull up Gillette India. That's also under pressure. Dabur and IEX2 not doing anything exciting, Urma. So clearly some bit of a pressure coming in. FMCG too not participating or, you know, supporting the market. So a dull day.
Pressure points coming in the broader markets, right? The Nifty continues to remain range bound, but the Nifty Bank is the one that is still holding on to that flat line, and that will be the index to watch out for in the second half of the trading session as well. In fact, it's still around 60 points higher is the Nifty Bank, above the mark of 54,000. Remember, today is the monthly expiry of the Nifty Bank index, and it is these banking stocks that are holding on to these gains. HDFC Bank, Axis Bank and ICICI Bank, they are the three names that are keeping the index afloat and also ensuring that the downside on the Nifty remains capped. But the talking point of the morning has been this meteoric rise in gold prices, and they have hit a record high following these geopolitical tensions in West Asia and the rate cuts by the US Federal Reserve. Manisha is here to tell us more. Manisha.
Well, yes, the gold prices have just continued to run up from a low of around $1990 an ounce in this year to around $2660. It's more than $650 of a jump up in this year. This year actually is going on as the best year in sense of gold price gains since 2010. We are up by nearly 5% for the month of September, up 28% for this year as well. And the Indian gold prices have gained up by 22% in this year until now. Well, the strength comes in on the back of the dollar index, which is trading at a 14-month lows. Second is the US Fed interest rate cut by 50 basis points. And while the market is awaiting more data in this week, the consumer confidence numbers in US were at a one-year low, and that supports the fact that you could be looking at more higher rate cuts going forward. It's not just dollar index and the rupee where you have seen the gold prices hit an all-time highs, but also in other currencies like a Chinese yuan, Japanese yen, and a New Zealand dollar and a euro, etc. So the gold prices seem to be running up across time zones. Going forward from here, it is going to be interesting to see on how the ETF buying continues. The global central bank buying in case of gold has been on the higher side, and the money managers and the hedge funds net long positions in gold are the highest in last 2 years as well. All the corrections that we have seen in gold have been small, inconsistent, and not too long. And that's exactly what the street believes from here on as well. With the kind of geopolitical tensions that we have, higher highs is what the world is moving towards when it comes to gold.
Higher heights is what we're expecting for gold. Though equity market today is not participating in the rally, we do have the bonds that are picking up the baton, and the 10-year bond prices have actually touched a fresh 32-month high, taking the yields to as low at 6.74% in today's rally in the bond market. And this is based on expectations that the RBI will turn dovish in the October policy. Lata is joining you with us to give us more on this update. Today, bonds is something that is, that everyone is watching out for as well. Equity market's not exciting.
Yes, 32-month highs on bond prices, which means yields, which move in the opposite direction, are at 32-month lows, 6.74. And this is largely because the policy which comes on October 9th from the Reserve Bank is expected to be dovish. Now, why are people penciling in this increasing, why are they getting this increasing confidence that the Reserve Bank will turn dovish? One, because the rains and the La Nina effect that is expected, continued rains is expected to engender a softer regime of food prices. That has been the only sore point in the inflation numbers, food inflation. Core inflation has been falling for the past 10 months. For the past 10 months, it's below 4%. 4% is where the MPC is mandated to keep CPI. Of that, core CPI is below 4 for 10 months. And the crude price, as we know, last few weeks has been falling to around the $70 to $75 mark. The fact that the US Fed has cut more than expected, leading to the PBOC cutting more than expected, has led to a global fall in yields. And that is abetting the fall in yields in India as well. An important, but maybe, not immediately important point, there is a gentleman called Nick Timiraos. He is kind of the Fed's mole in the market. He writes for the WSJ. And it was he who first signaled that it might be a 50 basis cut even in the September policy by the Fed. The market was penciling in 25. Now, Timiraos has tweeted that in the conference board data that recently came out, the difference between plentiful jobs and hard-to-get jobs is declining. That usually means the labor market is not offering too many jobs, which is being read by some in the market as a sign that November also could be a 50 basis cut by the Fed. Of course, that's a far cry. But what I'm telling you is that there are so many factors that are adding to dovishness in the Indian market as well. And last but not the least, the government is going to announce the second half borrowing calendar. It borrows via bonds. That calendar is going to be announced tomorrow. Because the first half ends on September 30th, obviously. That amount is likely to be about 6.3 lakh crore if you just do the arithmetic from the budgeted estimate minus first half borrowing. But there is a small feeling that it could be even lower than expected, simply because the government didn't spend too much in the first half. Taxes have been better than expected. So all this is leading to the fall in the bond yields and the rise in bond prices. But the dominant feeling is RBI's. People are not going to the extent of saying that they will change the stance to neutral, but they're definitely expected to sound dovish.
All eyes on the Reserve Bank of India then on the 9th of October. Lata, thanks a lot for that explainer. But moving on to the primary markets then, and some big names are slated to hit the bourses very soon because SEBI has given clearance to two very big IPOs, Vinny.
Absolutely. Two big IPOs that we're watching out for. One is obviously from the food delivery and quick commerce Swiggy, and the other one is from the auto side that we're watching out for, Hyundai Motors. So yes, that's a big one, right? Because both these are big names coming in. They are among the top two players in their own industry. Now, Hyundai Motors, obviously, the approval came in last evening. $3 billion is what they're planning to raise via the IPO. And what they're looking at is in terms of, this is going to be an OFS. So Hyundai Motor Corporation, which is the parent company, the Korean company, that will be selling 17.5% stake in the company. And this is what we're watching out for. It could be the second largest IPO in the Indian markets. And this is coming after LIC that we saw in 2022. This could be one of the largest ones. So let's keep an eye out on the final amount for that. Let's not forget Hyundai Motor is the second largest PV player in terms of OEM. 14.6% is the share that they have in the domestic market. And in terms of EBITDA margins also versus peers, they managed to be a bit better in terms of a trend versus the peers like Maruti, Tata Motors or an M&M on the auto side. They managed to do well. So that's on Hyundai Motors. But Swiggy also, they too have gotten that green signal from the SEBI. $1.25 billion is what they're looking to raise. It's going to be an OFS plus a fresh issue. So OFS is going to be around $800 million, where we have Persons who will be selling some stake, as well as SoftBank in the name is what we understand. So yes, keeping an eye on that, Persons holds around 33% stake in a Swiggy as of now. Other than that, there are a lot of key holders and investors already in Swiggy. The financials in FY24 surely have seen an improvement because the losses have reduced by around 50% for them versus FY23. Revenues have seen a good growth. So interesting to watch out for that, Vermas.
It'll be interesting to see if they can deliver those shares via their Instamart facility. But yes, all eyes on Hyundai and Swiggy, the two big IPOs on the radar. But moving on then to some corporate voices, Piramal Pharma is aiming to be a $2 billion global pharma, health and wellness company by 2030. Now, chairperson Nandini Piramal told CNBC-TV18 that 25% is a sustainable rate for margins and also guided for mid-teens growth in FY25. Listen.
One of the things we wanted to do was say, what do we want to be by 2030? And as you rightly said, we want to be a $2 billion company. But one of the other things we also want to do is increase our EBITDA to 25%, which means a tripling of EBITDA. And in the meantime, we also want to reduce our debt to EBITDA ratio to 1, less than 1. So the way we plan to do that is our three businesses, we believe that there are secular and macro tailwinds that will help us. In the contract manufacturing business, we want to focus on innovative work. We do think 25% is sustainable, and the way we want to do it is primarily by doing operating leverage. As we increased utilization at our sites in the CDMO business, we expect that operating leverage will flow through to EBITDA. As we actually do higher quality revenue, whether it's the innovation or the differentiated offerings, those margins are higher, and we expect to see that benefit as well. We're also continuing our focus on operational excellence and cost and procurement, and we'll continue to manage that. I think overall, we're still saying for the year, we want to keep early teens, actually mid-teens growth and improvement in EBITDA and a significant improvement in PAT this year. So I think we're going to stick with that at the moment.
Okay, on that note, we're going to slip into a very short break, but don't go anywhere. After the break, we'll bring you snippets of the conversation with the Commerce Minister, Piyush Goyal, on PLI schemes as well as quick commerce, so stay tuned in.
आज भारत का 5G मार्केट, बताऊं, बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है।
Welcome back. You're watching Business Lunch on CNBC-TV18. And as India completes 10 years of Make in India program, my colleague Parikshit caught up with the Commerce Minister Piyush Goyal and began by asking him about the new PLI schemes and the battle between quick commerce and brick and mortar stores. Listen in.
I think we will continue to look at different sectors to see where we can give that competitive edge through any support that may be required. You will recall that after the initial PLI schemes, we came out with the semiconductor mission and the additional support for the semiconductor industry. We are currently assessing different sectors, and if at all it is required to support any particular sector, I think the government will not be found wanting. Prime Minister Modi is committed to providing jobs for the youth of India, to create new opportunities for our startups, to create an ecosystem of innovation in the country. And I'm sure that this government, committed to a bright future for the youth of India, will always be there to support manufacturing. Make in India over the last 10 years has been a flagship of the government of India, but I'm sure going forward, manufacturing in India, the Make in India program, supplemented with the Serve from India or the Design in India, the Innovate in India program, the whole holistic ecosystem will provide a natural source of goods and services for the rest of the world.
India's e-commerce policy. Now, as part of India's next 5-year roadmap, e-commerce is also extremely important, and you've always said that we'll have a policy which protects our domestic retailers as well. Today, there are some concerns around quick commerce. How would you address that in the days to come, sir?
Well, I think largely quick commerce will have to have the local kirana store, the corner store, the small retailer for last mile delivery if they want to sustain in the long run and not make losses. By making losses in the initial period, they may be able to capture some eyeballs or some business. They may be able to build up valuation. But ultimately, in the long run, a sustainable model on quick commerce will necessarily integrate the local retailer. My only request to all e-commerce companies is to go by the law, go by the letter and spirit of the law, and we are fine with it. We want to encourage technology, we want to encourage modern trade, but not at the cost of the small retailers. ONDC, the Open Network for Digital Commerce, is going to make a significant expansion in the days to come. We have requested Mr. R.S. Sharma to join as non-executive chairman. He's revamping the ONDC to suit small retailers and give them a bigger opportunity to participate in e-commerce. I'm very confident about the e-commerce story in India.
Piyush Goyal there speaking to Parikshit. On to elections now in Jammu and Kashmir. Over 24% voter turnout has been recorded till 11 a.m. in the second phase of polling there. Now, key candidates include Omar Abdullah, Altaf Bukhari and BJP's Ravinder Raina. Polling is taking place in sensitive areas like Rajouri, Poonch and Reasi, where increased security has been enforced to past terror attacks, especially near the line of control. CNN News 18's Ishan Vani has the latest.
Brisk polling is taking place for the second phase of Jammu and Kashmir Assembly elections, and we are in one such polling station which has been specifically kept for persons with disability. You will see red balloons around it, and it has been decorated in color to ensure that voters come out in large numbers. This polling station also has a pink polling station on the other side so that women can freely exercise their franchise. Now voting is taking place for the second phase, and you have contestants like Umar Abdullah, who's the former J&K Chief Minister, and has been trying to fight from the National Conference bastion of Gandarbal, where we're reporting. And you also have, leaders like Ravinder Raina of the BJP, who is the, vice president of J&K BJP. This polling station is entirely manned by the CRPF women, and they're all around this polling station. This is one such area in Gandarbal where key candidate like Umar Abdullah is contesting, but he's being given a tough fight by Bashir Mir of the PDP, who is trying to contest against him. And Umar Abdullah is fighting from 2 seats, but this particular election is important given the fact that application of Article 370 has taken place, and Jammu and Kashmir is now a union territory. What is expected from these polls is that the long vacuum that the government has been talking about needs to be filled, and the polling percentage is going up, which means that there is a lot of enthusiasm among voters, and something which has been expressed by the Election Commission themselves. You'll see still women coming out in numbers to cast their vote and exercise their franchise. Now, this democratic process is something which was much awaited by the people in J&K, and now the voting process has begun. With Bashir Lone in Gandarbal, Shanwani for CNBC-TV18.
Thank you so much for that update there. But let's take a short break on that note. And after the break, we'll talk about the latest comments that have come in from the Israeli president as the state continues its bombing campaign in Lebanon.
आप हैरान होंगे, आज भारत का 5G मार्केट, बताऊं? बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। और ये 2 साल के भीतर भीतर हुआ है। अब तो भारत मेड इन इंडिया 6G पर काम कर रहा है। ये कैसे हुआ? ये इसलिए हुआ क्योंकि हमने इस सेक्टर को आगे बढ़ाने के लिए पॉलिसीज बनाई। हमने मेड इन इंडिया टेक्नोलॉजी पर काम किया। हमने सस्ते डेटा पर मोबाइल फोन मैन्युफैक्चरिंग पर फोकस किया। आज दुनिया का करीब करीब हर बड़ा मोबाइल ब्रांड मेड इन इंडिया है। आज भारत दुनिया का दूसरा सबसे बड़ा मोबाइल मैन्युफैक्चरर है। एक जमाना था मेरे आने से पहले जब हम मोबाइल इंपोर्टर थे, आज हम मोबाइल एक्सपोर्टर बन गए हैं। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। ये तीसरे टर्म में हमें बहुत बड़े लक्ष्य साधने हैं। हमें 3 गुना ताकत और 3 गुना गति के साथ आगे बढ़ना है।
Welcome back. Now on to some updates from West Asia. In a recent turn of events, Iran-backed Hezbollah said it fired rockets targeting Israel's intelligence agency Mossad's base in Tel Aviv today. Now, Hezbollah commented that the strike on Tel Aviv was in retaliation to the attack that killed its senior commanders as cross-border attacks from both sides continue to ramp up. Thousands of civilians have started evacuating from parts of southern Lebanon after reports of Hezbollah storing weapons in the region surfaced. Civilians in the region are moving towards northern Lebanon following Israel's warnings.
And Israel's President Isaac Herzog has threatened further military action on Lebanon if the attack on the Israel continues to increase. And speaking to CNBC's Dan Murphy, President Isaac reiterated the focus on Israel's military action was to be safeguard its borders.
Israel is not interested, did not want this war, and is not interested in going to war with Lebanon. But Israel has been attacked from October 8th from Lebanon endlessly. And if you look at the situation today, Hezbollah has launched missiles and rockets all over the northern part of Israel. So we will do whatever it takes to bring our citizens back home and enable calm in our cities. That's the situation. Let's not be mistaken here. The attacks started by Hezbollah following the horrific terror attack of October 7th by Hamas, as they are proxies of the Iranian empire of evil. And all of these proxies are trying to close in on Israel from all sides of our borders. The position of the Israeli government has been clear, and I reiterate it all the time. We don't have territorial expectations or any ambitions in Lebanon or elsewhere. We don't have territorial ambitions in Gaza either. But we have the inherent right which is given to any nation in the world to live in peace and quiet, not to be attacked day in, day out by missiles and rockets and terror.
The latest updates there from Israel. But with that, we call time on this edition of Business Lunch. From Vinny, myself, and the team that put this show together, thank you so much for watching. Midcap Radar takes the action forward.
आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। पुष्प, और मैं पुष्प को डिफाइन करता हूं, पी फॉर प्रोग्रेसिव भारत, U for unstoppable Bharat, S for spiritual Bharat, H for humanity first को समर्पित भारत, P for prosperous भारत, यानी पुष्प। पुष्प की 5 पंखुड़ियों को मिलाकर ही विकसित भारत बनाएंगे। साथियों, मैं भारत का पहला प्रधानमंत्री हूं जिसका जन्म आजादी के बाद हुआ। आजादी के आंदोलन में करोड़ों भारतीयों ने स्वराज के लिए जीवन खपा दिया था। उन्होंने अपना हित नहीं देखा, अपने कंफर्ट जोन की चिंता नहीं की। वो तो बस देश की आजादी के लिए सब कुछ भूलकर अंग्रेजों से लड़ने चल पड़े थे। उस सफर में किसी को फांसी का फंदा मिला, किसी के शरीर को गोलियों से भून दिया गया, कोई यातनाएं।
Good afternoon. Welcome to Midcap Radar. I'm Sonal Putra. With me is Vivek Iyer. Good afternoon, Vivek. Looks like markets have decided they don't want to do anything today. They just want to chill and rest. Markets are absolutely where they were in the morning. We did see a further dip, but that has been bought into as well. 26 points lower on the Nifty. Bank Nifty doing well, but a bigger cut that we are seeing on the mid-caps today.
Mid-cap, small caps taking it on the chin, and a little bit of correction was warranted given the fact that, you saw the magic figure of 26,000 actually being hit in the session. So some profit booking from the higher levels, but quite a lot lined up on the show. Let's start off with the top headlines. Mid-cap see profit taking even as frontline stocks stay ranged. Power sector plays and financials see some green even as most others drag. The 10-year bond yield touches fresh 32-month low on rising hopes of a dovish RBI in the October policy.
Pharma gains after bullish guidance at its analyst meet. Shares rise after the company says it has ambitions of being a global pharma company by 2030. Management tells CNBC-TV18 they are eyeing $2 billion in revenues and 30% EBITDA margins by 2030.
Ease My Trip corrects nearly 14% after a big block deal sees over 8% equity change hands at 38 rupees a share. Promoter Prashant Pitti is likely to have sold around 8.5% stake.
Dabur corrects almost 5% after UBS strikes a cautious note. The brokerage downgrades the stock to neutral, saying rising cola drink competition is likely to impact carbonated soft drink players and end up in a possible price war.
IEX falls for the second day as the street digests potential impact of market coupling on the stock. Elara Cap and IIFL are bearish, saying market coupling can lead to market share loss to 70% by FY27 from 84% currently.
Okay, so it stays status quo. We are not seeing much moves on the Nifty right now. 28 points lower there. Mid-caps are the one which have been under a bit of pressure. So that's where we are talking about a 400 or a 500 point cut actually right now. Yes, the dip did get bought into on the Nifty, but we are still in the red. And consolidation is something which is expected as well after that stellar rally that we have seen on the Nifty as well. 26,000 yesterday. We are off by around 100 points from those levels right now. The media pack is doing well. We have the realty pack, which has made a comeback yet again. CPSE stocks, yesterday that sector was doing well. Today, again, that's the case. Metals, a big mover yesterday. Today, it has added on to those gains. Not in a big way, but yes, it is in the green in a market like this. But we do have big losers in terms of the IT space. FMCG is lagging today. So a lot of moving parts, but on the headline index, it's very quiet.
That's right. You mentioned a very interesting point, about the CPSE index. So today, post-market, most likely you will see a rebalance come out in terms of weight increases and decreases. And a lot of the CPSE stocks, or the stocks which are part of the PSE indices, will be in focus. A couple of names, that have a significant weighting there include Power Grid as well as NTPC. And both of the stocks are quite active in the session. Of course, power stocks also in focus on the back of the fact that the National Electricity Plan has now been finalized. But this is our special segment, Midcap Movers. Hormaz is standing at the wall to take us to the midcaps that are moving around in the session.
Well, the Nifty may not be wanting to do anything today, but the broader markets definitely are, and on the downside in today's trading session. And there are plenty of movers and stock-specific activity that is ongoing today. I'd like to start off with IEX. Of course, can't not talk about it. Down yesterday, extending those losses in today's session, 4.5% lower today as well. Mind you, the stock has entered the F&O ban today, so no new positions there. PB Fintech continues to see some profit booking, down yesterday, down today as well, 5.5% lower. Oracle Financial out of the ban today, 4% down, and Indus Towers continues to feel the overhang from Vodafone Idea. PSU Banks, it was a case of a rally, short-lived, I guess. Last week, one of the top performers, and now seeing some bit of profit booking yesterday and today as well. All constituents of the PSU Bank Index trading with losses in today's trading session. Some stocks that have done well and some have not done well on the back of their respective news flows. Easy Trip after the block deal at one point was down 20%. Dabur after the downgrade. Delta Corp after the demerger that it announced was up 9% at one point, still holding on to 4% gains. And Z Entertainment also trading with gains of around 3.5%. And lastly, stocks that are doing well on the back of volumes. And eClerx is the one, while Midcap IT is selling off in today's session, eClerx is sort of bucking the trend, 10% higher now. HEG and Graphite India both are doing well. 5-star at the highest point of the day now, 7.5% higher. And as is Tata Communications, 4.5% higher on very strong volumes. Back to you guys.
Well, Hormaz, the frontline indices are not doing much, but I hope you have some special plans for the evening. Otherwise, it would be a day without much plans for the frontline indices and yourself as well. But a lot of moving parts in the market. So thank you so much for joining in with all those details as always. Well, with that, let's now welcome Vinay Rajni, Senior Tech and Derivative Analyst at HDFC Securities, for a technical check on the markets. Vinay, good afternoon. Thank you so much for joining in. But do you think consolidation will continue for a bit before we see bigger moves, maybe on the upside or downside?
Yeah, good afternoon and thanks for having me on the show. So as we have been discussing, this mid-cap and small-cap indices have done nothing for last 1 month. If we were to look at the chart, small-cap index has given zero return in last 1 month. For last four consecutive weeks, that index has been consolidating. As far as mid-cap index is concerned, today it is down by 0.8%. So breadth is definitely negative. 3:5 advanced decline ratio is there. So as we can see, strength in the large cap stocks and the kind of data which is FI is posting nowadays, the total focus has shifted from mid-cap, small cap to the large cap space. So the strength is there in the large cap space. Mid-caps and small caps are into purely consolidation. They are down but not out, we can say. So this consolidation may continue for a while, but overall trend of the market is bullish. Nifty and Bank Nifty can do well and can outperform the small cap, mid cap from further from here. So definitely overall market looks strong today because just consolidation is going on in overall uptrend. But one can concentrate more on the large cap stocks and the benchmark indices like Nifty and Bank Nifty rather than looking for mid cap and small cap trading opportunities. So yes, overall market is bullish and intraday dip should be bought into, and especially I'm bullish on the large cap space. And some of the sectors which are doing very well are realty, metal, and some of the financial stocks. So these are these sectors one can look at for trading long sell.
Vinay, you mentioned the sectors that you like. Which are the individual stocks that you're recommending today?
Yeah, so as I said, that realty index is looking very strong. It has been very resilient in last 2 trading sessions, and the rate sensitive sectors have started performing in this market. So I feel that along with the DLF and Godrej property, the stock like Oberoi Realty looks very strong on the charts, and nice pattern can be seen on the short to medium term chart. So Oberoi Realty can be traded long around 1920. For traders, I would suggest a stop loss at 1875. On the upside, I see a target of 2000 in 1 to 2 trading session. So Oberoi Realty I like a lot on the charts. The second pick, I would take it from the metal space. So Hindustan Copper is one of the stock which I like on the chart. With so entire metal index yesterday broke out, and today it's just showing a muted activity or just consolidation is there from the higher level. But overall trend I think seems to have reversed on the upside, and this may continue. So if we were to take the next 1 or 2 weeks view, then metal can really do well from here. So Hindustan Copper is the stock which is there on my radar, which is trading at 341. For traders, I am suggesting a stop loss at 332. On the upside, I am expecting a target of 355. So metal and realty space looks very strong, and from realty I will choose Oberoi Realty, and from metal I will take Hindustan Copper on the long side.
Okay, so realty space, that is doing well. Thank you, Vinay, for joining us. So from the realty space, we also have Godrej Properties, which is surging in trade. It's up around 5% right now, above that 3,300 mark on Godrej Properties. The other one is Max Estates. We have Mahindra Life Spaces, which is doing really well, 4% higher, that one. If we talk about Godrej Properties, this week itself, the stock is up around 12%. So big moves there. And it's one of the largest players in the realty space as well. And if we talk about the other names which are doing well right now, Nelco is one of them. That stock is higher by 4%. So some of these movers in the broader markets I thought we should highlight as well. Let's do one thing. We'll slip into a short break now. When we come back, we'll get to you more on the markets, focus on SpiceJet and Piramal Pharma, big movers of the day. Stay tuned.
जेल में ही गुजर गया, कईयों की जवानी जिंदगी जेल में खप गई। साथियों, हम देश के लिए मर नहीं पाए, लेकिन हम देश के लिए जरूर जी सकते हैं। मरना हमारे नसीब नहीं था, जीना हमारे नसीब है। पहले दिन से मेरा मन और मेरा मिशन एकदम क्लियर रहा है। मैं स्वराज के लिए जीवन नहीं दे पाया, लेकिन मैंने तय किया सुराज और समृद्ध भारत के लिए जीवन समर्पित करूंगा।
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making investing?
Welcome back to Midcap Radar. Well, the company in focus is SpiceJet after it concluded its 3,000 crore fundraise via QIP route. My colleague Nigel spoke to Ajay Singh, the chairman and MD of the company, and asked him specifically about the long-pending issue of the company's dues towards airport and, more importantly, its employees. Listen in.
Outstanding dues at airports are quite minimal, Nigel, and those are being settled as well through this fundraise, but they are actually quite small. SpiceJet has been on cash and carry for a period of time at key airports, and I think while that's tough when that happens to you, one of the advantages of cash and carry is that you carry very little debt from that on your books. Same case for ATF payments. We've been on cash and carry. We've chosen actually to remain on cash and carry for the last 7 or 8 years. And what happens with that is that we are constantly paying for the fuel that we put, and therefore no amounts are due to oil companies at all.
So no amounts due to airports as well as to oil companies. Are we getting that correct?
Very, very small amounts. Very, very small amounts due. And those will be, I think, settled very easily. I mean, those are like what I think the total of amounts due to all airports combined will probably be under 100 crores.
Well, we've addressed the shareholder concerns, the lender concerns, but I want to ask you, what about the employee concerns? And there are 3 aspects out there. Outstanding salaries, the PF that is outstanding, which hasn't been deposited in its rightful place, as well as the TDS that's been cut, and that as well hasn't been deposited in its rightful place. By when can we see all these 3 addressed?
Well, you will see all these issues being addressed over the next 2 to 3 weeks. We are in discussions with the authorities to ensure that we have the calculations right and that we can make these payments almost immediately as we settle these numbers. So, I think we've already committed to the investors that out of the funds that we receive from them, statutory liabilities and employee dues will all be cleared, and this will be done.
So by the end of this calendar year, all the employee dues, the PF dues, as well as the TDS that was cut will be deposited in its rightful place. Is that correct, Mr. Singh? In 2024 itself?
Absolutely. That's absolutely correct.
That's SpiceJet. The stock is down by 5% in focus on the back of a fundraise. Piramal Pharma, that's the other one on our radar, aims to be a $2 billion global pharma health and wellness company by 2030. Nandini Piramal, the chairperson of the company, tells CNBC-TV18 that 25% is a sustainable rate for margins, also guides for mid-teens growth for FY25. Listen in to what she had to say.
One of the things we wanted to do was say, what do we want to be by 2030? And as you rightly said, we want to be a $2 billion company. But one of the other things we also want to do is increase our EBITDA to 25%, which means a tripling of EBITDA. And in the meantime, we also want to reduce our debt to EBITDA ratio to 1, less than 1. So the way we plan to do that is our 3 businesses, we believe that there are secular macro tailwinds that will help us. In the contract manufacturing business, we want to focus on innovative work. We do think 25% is sustainable, and the way we want to do it is primarily by doing operating leverage. As we increase utilization at our sites in the CDMO business, we expect that operating leverage will flow through to EBITDA. As we actually do higher quality revenue, whether it's the innovation or the differentiated offerings, those margins are higher, and we expect to see that benefit as well. We're also continuing our focus on operational excellence and cost and procurement, and we'll continue to manage that. I think overall, we're still saying for the year, we want to keep early teens, actually mid-teens growth and improvement in EBITDA and a significant improvement in PAT this year. So I think we're going to stick with that at the moment.
One of the other stocks that's actually seeing quite a bit of selling pressure is actually Dabur. UBS has gone ahead and downgraded the stock. Winnie standing by with details on that particular note.
Yes, so UBS has downgraded Dabur, and this is to a neutral rating, target price of 700 rupees per share. Now, the three important reasons that they've highlighted why they believe that Dabur may not do well going forward. One, the potential sales risk that is coming in for Real Juice, which accounts for around 9 to 10% of their revenue as of FY24, because of the competition that is increasing in cola drinks, especially after Reliance came out with Campa Cola, relaunched it at a lesser price. So, a bit of a pricing competition or a pricing war is what one could watch out for, and that could in turn impact Real Juice and the business of the company in that front. Other than that, there is also increasing competition in coconut oil. We've seen recent launches even coming in from Bajaj Consumer on that front. Coconut oil accounts to around 2 to 3% of the consolidated revenue. So yes, impact on that front. These two are the sectors that are actually segments for the company that could be facing some bit of a rising competition. Other than that, valuation also is quite high when you compare it with the peers as well. FMCG is trading at a much higher premium, and Dabur too. So yes, rural recovery, that's in place. Long-term story is in place, but near-term, maybe some bit of a pressure is what we could be watching out for.
Okay, yes, that can be seen on the stock as well, down 5%. Thank you, Winnie, for joining us with all those details. But let's move on. In a significant move, the Reserve Bank of India has lifted the restrictions placed on IIFL Finance's gold loan business. These restrictions imposed on in March this year prevented the company from sanctioning, disbursing or selling its gold loans. Earlier today, we caught up with Nirmal Jain, the founder and chairman of IIFL Group, to discuss more on this development. Listen in.
I think we remain focused on the customer. We aren't really very concerned about how the book will ramp up, because the short-term product rotates much faster. Whatever feedback I'm getting from customers, employees, people on the ground, there's a positive momentum. Customers basically like us, and at the earliest opportunity, they'll shift their business back to us. So as far as housing finance, microfinance are concerned, they're independently managed and also funded separately. And I don't think there should be any challenge in getting the growth back in those businesses, subject to industry conditions as such. And in these MSMEs, we do both secured as well as unsecured loan. And typical loan size is less than 10 lakh rupees, or it can be up to 30 lakh rupees, but the average will be less than 10. This is a segment where we have a natural advantage because we have a network of branches. As a group, 4,500 branches. Gold loan alone has 2,700 branches. We have people on the ground. These branches are located in the clusters where these kind of MSME enterprises, typically retail shops or traders, these kind of businessmen, they're around the shops. Many of them have been our customers for gold loan. So we see this as a significant synergistic business to expand and diversify our longer term.
All right, that's the word coming in from IIFL Finance. That's a CNBC-TV18 exclusive as well. Keep getting excerpts of that conversation. The stock is lower today, but of course, after that initial news, there was a pop on the higher side. Let's slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Stay profitable with strategies from the market masters, macro pundits and chart wizards. Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV.
Well, the entire power sector is in focus today as the Ministry of Power went ahead and finalized the National Electricity Plan for central and state transmission systems. The government plans to meet peak demand of almost 458 gigawatt by 2032. Let's do a deep dive into what exactly is the Ministry of Power saying and what is there in the plan between 2023 to 2032. Number one, the NEP or the National Electricity Plan, as we mentioned, is aimed at meeting a peak demand of close to 458 gigawatt. The earlier NEP, remember, was from 2017 to 2022. The total cost outlay for this particular plan is quite significant at rupees 9.15 lakh crore, and that indicates the kind of opportunity size you will be seeing across the entire power with value chain. Now, key targets: number one, to meet the increasing electricity demand; number two, to facilitate renewable energy integration and green hydrogen loads into the grid. What are the new plan targets? Number one, 17,700 circuit kilometer lines and 73 GVA transformation capacity were added annually last time around. So this time around, they want to increase the network capacity from 4.85 circuit kilometers to 6.48 circuit kilometers in 2032. Transformation capacity is aimed at almost doubling by 2032. Now, who are the key beneficiaries of such a move? The obvious answer, number one, is that if there is going to be significant transmission capex outlay, one of the key beneficiaries, of course, is Power Grid. But the value chain also benefits. So look at names like Hitachi, GE, T&D, Siemens, Skipper, KEC. These are all of the companies, and even cable makers like KEI Industries and Apar Industries too stand to benefit from the kind of opportunity size. In fact, today, Goldman Sachs has written a report on this particular development. They believe the NEP is positive and significant positive as far as asset developers like Power Grid is concerned. They believe Power Grid can potentially capture bulk of the upcoming transmission capex opportunity. Remember, they say Power Grid is backed by large balance sheet and also access to significantly lower cost of debt. Now, this particular development is quite a significant development as far as the entire power value chain is concerned. No wonder then Power Grid today doing quite well, and the stock has been on a tear in recent times. It's all the time we have on this edition of Midcap Radar, a lackluster trading session. Your stocks when we return.
CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
As far as India is concerned, the role and relevance and the significance of India, especially as far as the foundation is concerned, and what you're hoping to do on the innovation side.
So India's the country the foundation does the most in. Other than the U.S., that's our largest group. We have a great team there. We work a lot with the national government and many of the state governments. And not only do we see in areas like nutrition or using ultrasound to detect a difficult pregnancy, we're doing a lot of studies with our partners there, which will have a benefit for India. But also, because the digital infrastructure in India is so strong, we can try things out there and take them to other countries. The digital infrastructure itself is a great example where the leadership has laid that foundation, and now both India and Gates Foundation are going to Africa and other places and saying, hey, you should do the same thing.
Was there a specific learning from this trip to India for you?
Well, it was pretty amazing in Odisha to see how the digital approach was connecting with farmers, that they had categorized which farmers were in which location, what were they growing. And so when they would see crop disease outbreak, they could notify them. If they saw weather coming, they could notify those farmers. If the market prices were changing, they could help guide the farmers. And so the digital revolution, bringing that into that agricultural sector, that was the first time I saw that at work. And it's being scaled up in India. Now we'll take it to the rest of the world.
Hello, good afternoon. You're watching Your Stocks on CNBC TV18. I'm Vinny Motiwala. And let's look at the market, what it's been doing. Not much of an excitement that we've seen coming in on the D Street today. Nifty quite flattish as of now, trying to make a bit of a comeback, but down almost 0.06%. So that's almost 14 points down in trade. Sensex 2 is trading quite subdued. A slight bit of a positive uptick, at least right now, is what the Sensex is holding on to. Up almost 18 points in trade. Mid and small cap, the broader markets, that's where we are seeing a lot of pressure coming in, a bit of a selling pressure today in the mid and small cap names. So yes, keeping an eye on that. Specifically, mid cap is down almost 0.3% in trade. Small cap also trading with sharper cuts that we're seeing coming in. Small cap also is trading with 0.3%, and mid cap is down almost 0.2% to 0.3%. So yes, that's how the market is shaping up like. PSU Bank especially seeing a sharper fall today in trade as well. So PSU Bank, among that we have seen PNB, IOB, Maharashtra Bank. Those are the names that are falling in trade. Media today managing to hold on to some bit of a gain, and Nifty Media is among the top sectoral gainers. So yes, broader markets clearly under pressure. Not much of a participation coming in from IT, PSU banks or the FMCG pack. Only Media India Energy is something that we're managing to see some bit of a green. But today we do have our guest joining in with us to stall all your stock-related queries. We do have Rajat Bose joining in with us, as well as Sharad Awasthi joining in with us this afternoon. Good afternoon, gentlemen, and thank you so much for joining in with us. I'm going to start with the first query for today. We have DP Gupta, who's writing to us from New Delhi. This one is on Tata Motors, holding 100 shares at a price of 1,160 rupees per share. So some bit of a loss is what they're making. Currently, Tata Motors trading at 962 rupees per share. He wants to know whether he should continue to hold this or sell. I'm going to come to you, Rajat. What's your view on this one, on the technicals? Is it interesting, or maybe someone should start booking out some bit of a profit?
No, I suppose that Tata Motors continues to show weakness. In fact, there is a bearish crossover between 20-day and 50-day moving averages that has happened today itself. So chances are that you might see it testing the 200-day exponential moving average, which is currently around 935. So that is a possibility. So immediately, I would not say that one should buy, or one, if one wants to see whether it stops falling at 200-day moving average, then one can continue to hold. Otherwise, one may get out of.
Okay, that's your view coming in there on Tata Motors. But Sharad, I want your view also, because fundamentally right now for passenger vehicles, we have seen a lot of these global OEMs actually cut guidances, so we are expecting some bit of that impact coming in terms of demand trends. Fundamentally, would you still look at Tata Motors, or would there be any other bet coming in on the auto side?
We have been bullish on Tata Motors for quite some time now, but I think at current valuations, the one hope thing that the investor can play around with is probably in terms of pure valuations. The rest of the pack trades at 18, 20 times 1 year forward. Tata trades at 11, 12 times 1 year forward. But the only difference is that a major part of Tata Motors earnings comes from JLR, and the premium side of the market does not get higher valuations internationally also. As you rightly pointed out, some of the larger premium vehicle makers have already pointed out to some kind of slowdown there. And even though the electric and the CV and the passenger vehicle part, the domestic business should do very well, there is very good traction there. I think in the long term, that will start contributing to numbers, but over the next 1.5 years, it may not be a major contributor. So I think the best hope for you would be that, normal retail participation does spark it up, and people expect these valuations to catch up a bit, vis-a-vis, the larger names, without going too much into details. But if you look at detailed valuation, I think since majority of the earnings comes from JLR, there could be an impending China slowdown in spite of all the effects. And if that space does not grow at a very healthy rate, the probability of Tata Motors getting re-rated does seem like remote. So expect market-linked returns. I think, 10-15% kind of upside you can expect. If that does materialize, you should try to get out. Yeah, I think that would be the fair strategy to have.
Sure, okay, keeping an eye on that strategy for Tata Motors. Let's move on to the next query. This is coming in from public sector side, and we have Prakash, who's writing to us from Mumbai. He's holding 200 shares of Bharat Electronics, bought at a price of 332 rupees per share. This is a bit of a long-term query, so I'm going to come to you, Sharad. They want to know in terms of the future of the stock, the outlook of the stock. The defense sector has already seen such a big run-up. So what is it that, on the fundamentals that is looking attractive there? And should they continue to look at the stock?
Yeah, I think for most defense stories, if you have a horizon of, extendable up to, 5 to 6 years from now, I think most of the defense stocks will be like, even doublers from current valuations. But if you have a shorter time horizon, maybe 1 or 2 years, then most probably BEL might not be the best bet you want to stay into, because earnings right now is expected to grow at 17-18%. Even if we consider, that there is some acceleration by FY26 and you have much better earnings, and it does report an EPS of somewhere around, say, 9 or 10, even then it's trading at 29-30 times. I don't think it leaves much on the table. But yeah, if you can wait long term, if you can extend your horizon to 5 to 6 years, I think the whole defense pack is a space to watch out for. there could be very strong re-ratings. The order books have doubled over the last 1.5 years in most of the cases. And I think the order book could swell further over the next 2 to 3 years. But might not be linear in nature. The projects could have long gestations. You could have some disappointments on the way. So I think if you can extend your horizon, continue to hold it. I think it's in the long term, 5 to 6 years, it's an excellent bet. I think even if you consider conservatively, these stocks can double within that time frame. But if you have a shorter time horizon, 1.5, 2 years, I think again, 30 times 2 year forward, it's roughly priced to perfection, not much left on the table.
Not much left on the table for the short term, but long term you're expecting to double in terms of the move that one could expect. But in the last 1 year only, when you're looking at the chart, Rajat, the BEL as a stock has doubled in this just last 1 year. On the technicals also, would you concur with the view that Sharad was talking about in terms of long term, yes, but short term maybe something that one should avoid?
This stock has actually moved up. Last year, November, it was around 120, between 120 and 130. From there, it tasted 330 kind of level. After that, this is the correction that is happening. Over the last 4 or 5 sessions, or rather 4 sessions, including today's, it is moving up. But it is now testing the 50-day moving average, which is currently around, say, 292. If it manages to get past that, then there would be any short-term move further up. Otherwise, you expect it to test its 200-day exponential moving average around 249. If one is not having a long-term horizon, I would say it is better to book profits, get out of it, or if you are planning to buy a fresh, wait for the 200-day to be tested. Around that time, you can buy.
Okay. That's a view coming in from you as well on BEL. But let's move on to the next query. And this query is coming in from Indira, who's writing to us from Visakhapatnam. 2 stocks that she wants to talk about. One is Analco, which she's holding 470 shares at a price of 176 rupees. The other one is NHPC. She is holding 920 shares at a price of 114 rupees per share. She wants to know whether she should continue to hold this or maybe look to sell at the current levels. Rajat, what's your view on this one?
Well, first of all, regarding National Aluminium, I would say that it is once again trying to get past the earlier high. Earlier high had been around, say, 119, I think it was 206.70. If it manages to get past that, then only you can expect some further upswing happening. Otherwise, if it fails to take out 200 to 206 kind of resistance zone, then you will expect that 180 will be retested. It might even fall further. So it's a choice, and over the long term, at the moment, since it is range bound for several months, it is very difficult to project the long term.
Okay, and NHPC, what's your word on NHPC? Because she's holding that also at a price of 114 rupees per share. So, Rajat, should she continue to hold this or maybe look to sell NHPC? Rajat? Okay,
well, you can book profits in NHPC. Can you hear me? Hello?
Yes, I can. Yes, I can hear you, Rajat.
Yeah,
okay, book profits in NHPC.
Yeah, book profits in NHPC.
Okay, that's the word coming in there. But, Sharad, your word on NHPC and Nalco, anything that you're finding, and what would your suggestion be for both these?
Yeah, I think from Nalco, typically, the metal side would be a lot dependent on the type of vibes you receive from China. It being a major producer as well as a consumer of most of the commodities. But within commodities, I think aluminium might be in a better space than most other base metals. So that way, I think within base metals, this could be a better choice. But considering the type of expansion plans that they have over the next, 5-6 years, it's very aggressive. And it's a PSU that has that kind of plan in place. I believe in the next 1 quarter or so, there is one major capex that goes online on the alumina side. They have some plans on the aluminium refinery side also to increase capacities. And some mines are also expected to be operational. So all this should work out very well. But with any kind of metal, you have to be, in sync with the broader metal prices as well as the, sentiment around the numbers that the companies will report. So this company is expected to report good numbers maybe next year, expect an earnings of somewhere around 15, 16, then they might remain flat for some time. But don't expect too much of a run up in base metal prices across the board because of the overhang of China. So I think 14, 15, optimistic. We are optimistic on market probably. So maybe it does get peak multiples of somewhere around 15, 16 times. Then you could just be looking at targets of somewhere around 225 over the next 1.5 year. So you get somewhere around 225, try to exit Nalco. I think that would be fair value. Long term, yeah, certainly it's a good bet, the type of expansion they are doing once they start to show up. But I think after that, you might get a much better opportunity to enter into the stock for that kind of time frame. So it's better you book your profits around 225. For NHPC, I think it's a very good long-term idea. The operational capacities are somewhere around 8,000 megawatt. The planned capex right now that's going on is simply double of it, and another 10,000, 8,000 megawatt is on the planned stage. So I think over the long term, this could be something that could, grow at a very handsome rate, a multi-bagger kind of story. On top of that, they're also working on, hydro solar powers where you put, solar panels on seas. I think that's a very big opportunity that can come up from India. They have initiated a tie-up in that field, and that's a very big opportunity compared to their current sizes. They have done an international tie-up, so that should help them in the long term. So I think in the long term, NHPC is a multi-bagger kind of story. Over the next 2 years, yeah, you can expect 20, 25%, 20% kind of growth at the PAT level. Considering that, I think it reports an EPS of somewhere around 6. You give it a multiple of somewhere around 20. So maybe 120, 125 if you have a shorter horizon. But if you can continue to hold, I think this is an excellent multi-bagger kind of story that might, manifold into a very handsome upside over the next 5 to 6 years.
Okay, a multi-bagger story that one could be watching out for from NHPC in the long term. That's a word coming in from Sharad. But Kranti Prasad, that's the next query. The viewer who's written to us, and this one is from Bihar. They are holding 40 shares of SBI cards at a price of 800 rupees per share. So currently, slight bit of a loss is what they're making. Stock trading at 769. He's asking whether he should continue to stay invested in SBI cards, or maybe look to invest his money somewhere else, book out the losses, and then invest that money somewhere else. Sharad, what's your view?
Expensive side, even if you look at the traditional price to book multiples. But I think the card business as such is very optimistic in India. SBI has handsomely grown. It is one of the few PSU banks that has been able to scale up the card business very handsomely. And in terms of that, I think they could be looking at, 20-25% kind of long-term growth. And if the market does continue to value them on the basis of, this growth and a PE multiple, then it is quite possible that, FY26 you report somewhere around 35, 40 and get a multiple of somewhere around, 30 times. So you could be looking at targets of 1,000, 1,100. So I think it's an optimistic bet. It's a bit on the expensive side. But growth rates would continue to be good. And till now, the NPA overhang has not been much. So continue to hold for targets of somewhere around 1,000, 1,100 on the stock.
Okay, that's on SBI cards. 1,000, 1,100 is the target that Sharad has spoken about. But on that note, we're going to slip into a very short break. Don't go anywhere. After the break, we'll continue with all of your stock-related queries with our experts.
President Zelensky, Prime Minister, recalled his visit to Kyiv, their discussions on all matters, the bilateral issues as well as issues surrounding the Russia-Ukraine conflict. President Zelensky was very appreciative of India's attention to these issues and said that Prime Minister's visit had been highly appreciated, and he thanked the Prime Minister for the efforts that he was making for peace and a pathway to finding a way out of this conflict. Both sides appreciated that there was positive momentum on a lot of issues in the bilateral relationship, and they agreed to remain in close touch.
Welcome back. You're watching Your Stocks on CNBC-TV18, and you still have with us our experts for today, Rajat Bose as well as Sharad Awasthi, to solve all your stock-related queries. Let's quickly move on to the next query. And Rajat, this one is for you. We have Shaurya Sharma, who's from New Delhi, holding shares of Infosys. Now, they're holding it at a price of 1,500 rupees per share. 15 shares is what they're holding in terms of quantity. What is the short-term and long-term chart indicating for Infosys? Should they continue to hold this? What is the prospect of his holdings?
In the short term, it is not looking that great. It might even come down a bit, say something like, it would be, say, 1825, 1800, that might be tested in the short term. And over the long term, at least in the short to medium term, it needs to take out 1925 to about 1950. If that happens, then a new high will also happen. And if you are looking at 3 to 5 year horizon, Infosys will definitely do well. That's what I guess, because I'm quite bullish on the tech sector, both the engineering R&D as well as the normal conventional software services company.
Okay, short term not too exciting, but long term is something that is a good story there. Sharad, would you concur with that as well? Long term, yes, should the viewer continue to hold a stock?
Yeah, he can, but I think in the current valuations, what are you expecting? 10-12% kind of bottom line growth for the company. And it's already trading at what, 30 times next year forward. Not much is expected. Maybe, you have a 10% upgradation to the earnings because of not having a hard landing in the US and not a full-blown recession. So I think that could result in some, positivity. They are training around 270,000 people on the AI models, and they are working hard on integrating the AI part of it. Most of the IT companies have worked very hard on, trying to scale up the consultancy business, which erstwhile they were not very gung-ho about or not concentrating much on that. So I think all these could yield results in the long term. But yeah, as Rajat also rightly pointed out, that maybe, medium to short term, not much left on the table. So what I'm looking at is 10-15% growth. And I think giving it a 30 kind of multiple seems a bit of a stretch. So at these valuations, I think my fair valuation comes to somewhere around 1850. So I think it's fully to fairly valued at these prices.
Okay, let's move on to the next query. This one is in Shipping Corporation of India. We have Arunachalam Balaji, who's writing to us from Tamil Nadu. He's holding 400 shares of Shipping Corporation at a price of 381 rupees per share. He's making a loss right now. And Rajat, he wants to know whether he should book his losses or continue to stay invested in this one.
This company has got only 2 shares. Even in the PSU rally, it did not quite participate, and currently it is moving sideways. Say around 230 is the 200-day exponential moving average. If it were to fall below that, then it will fall further. If you have to play ports or shipbuilding or anything, go to other stocks like, say, Cochin Shipyard or GRAC, this kind of stock, not Shipping Corporation. You are nowhere with only 2 ships.
Okay, not too interested in Shipping Corporation. Sharad, is that also something that you are looking at? Don't like Shipping Corporation too much if you want to play the story?
Yeah, I would say it's roughly fairly to fully valued at these prices. It's already trading at 16-17 times. Though the BDI is near the upper end of its range for quite some time now because of the Red Sea issues. So I think, yeah, it's at the higher end, so most probably they'll make some money out of it. They have done some tie-ups here and there with most of the PSUs. We are looking at some maybe, massive improvement on the oil discovery side. That could, give them some bit of fillip. They are the largest shipping operator in the country, and the fleet is not also very old. The average age is around 10 to 12 years, so I think that's on their side. So consistently, I think long-term steady kind of numbers the company will report, but not a humongous kind of growth is expected, trading at already 16, 17 times. So expect market-linked returns, maybe over the next year or so, you get another 10%, so around, 300, 310. I think that's the value at which you can think of exiting. But can't look at it very optimistically as to something great is going to happen, which should result in further re-rating of the stock.
Okay, sure. Last query we have, this one is on JSW Steel. Madhav Pujari, who's writing to us from Navi Mumbai, holding 15 shares of JSW Steel at a price of 900 rupees per share, wants to know whether, what is the future prospect of our investment? Should they continue to hold this or maybe look to sell? Rajat, what's your view?
I would say definitely continue to hold it because it's a short-term trend, medium-term trend, and overall the long-term trend is all are up. There might be minor corrections that can happen. Maybe it will come down to something like a 950 or so. That can always happen. But continue to hold it. It will go. My projection is that over a period of next 12 to 15 months, it can test 1050 initially. After that, 1200 to 1250.
Okay, keep an eye out on those levels over there for JSW Steel. But that was the last query for today. So thank you so much, Rajat as well as Sharath, for joining in with us and solving the viewers' stock-related queries. And viewers, remember, you can always email us your queries on the address that will be there on the screens as well. Thank you so much for tuning into this edition of Your Stocks.
Through exchanges of visits at various other levels. So far as your question related to oil is concerned, that did not figure in the discussions today. As I said, this is the third meeting in between the leaders in the last 3 months or so. A lot of the issues have been discussed, but at this particular meeting, this particular subject was not discussed.
The magic one that everybody is talking about at this point in time is AI and what AI can do, and specifically generative AI. How do you see that linking back to the efforts on the healthcare side, the innovations that you're working on? I mean, how transformative is AI likely to be, or are we on the cusp of seeing that kind of transformation?
Usually when you get new technology, it's applied in the rich world for those who are well off. And what we'd like to do this time with AI is make sure, both in terms of discovering new interventions for nutrition or vaccines or drugs, and helping give people health advice, in voice, in their native language, that we actually bring these AI advances to those most in need. I mean, after all, where's the greatest shortage of doctors? It's in developing countries. And so the foundation is leading the way by giving grants to various people and pushing this forward, even for a topic as complex as nutrition. The AIs are going to help us understand things faster than we would without it.
If you could do a startup all over again and focus on AI, what would the niche be that you would like to address?
Well, if you could go back to my school days even, and then I was saying, hey, how do we make software as smart as human beings? And I was constantly thinking about it. I underestimated how long it would take, but here we are on the cusp of that. And so now the lens I apply is the lens of the foundation. If I was somebody young, sure, I'd compete with, Open AI and all these people. But, now I'm in the stage of saying, how do I help other people work in AI apply it to those most in need?
Today, in Kabul, a female cat.
Markets have been largely range-bound other than the Hang Seng and the Taiwan index.
The 40 hourly has moved higher.
Market cap is going to be close to 10,000 crores.
25,915 is the first rate.
I think we are seeing some very big IPOs in the pipeline.
We want to make sure that long term we have trust with the customers.
And core inflation today is at its lowest level.
Planning to raise around $3 billion in the IPO.
For now, the Nifty is absolutely choppy. This is something that we were expecting as well.
The global funds don't, frankly, look at India, and they will start looking at now.
We want to be a $2 billion company.
Markets are absolutely where they were in the morning.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that is the day so far, and it's an absolutely flat day so far. But, the point is we are flat after recovering quite a bit from the day's lowest point. The low was made around 12:30 in the afternoon, and from there we picked up quite a bit. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, good afternoon.
Hi, good afternoon. And there's been some consolidation in global markets as well, because some of the Asian markets are around the flat line. Even the Chinese markets that have been euphoric since the central bank announcements over there, even they cooled off a bit. There's a little bit of red on US futures. So I think maybe just taking a bit of a breather, markets around the world.
Well, that's right. And we were down 50 points, just around 90 minutes or so ago. But the Nifty Bank, that's made its way back into the green. And Reliance and ITC, both those two heavyweights, they've made a bit of a comeback. So that explains why at least we're trading around the flat line.
Absolutely. And, it's flat is good, better than being down, right? 40, 50 points. It's that kind of a day where not very much is happening. But I have to say that broader markets are weak. And I think that is something which has been there from the morning, actually, after the first hour or so. So off the lows of the day, Nifty Bank, by the way, is the other one. That's doing much better. It's a slow drift higher for the Bank Nifty. The three areas sectorally which are under pressure, IT. So news flow around IT, starting with that Wall Street Journal article about entry-level IT jobs, in the US looking extremely tough out there. That was a fortnight ago, and IT stocks generally have been very weak. Now, of course, earnings season will kick off not very far from now. Consumer is another pack which is down, and PSU banks is as a pack is also slightly lower. And as I said, broader markets, Midcap index is the one which is down about 0.8% the last I checked. And I don't think there's very much by way of a recovery which is kicked in there. So as a result of which, market breadth is about 2.5, 3:1 in favor of what is down. Surabhi.
Okay, if we talk about the individual sort of constituents of today's move, what is up? Definitely power stocks, because of the kind of targets being put out and the capacity addition that will happen in India, and the new regulatory push as well on this. We'll tell you more about it as we go along. But Power Grid, NTPC, these are among the best performers on the Nifty today, and almost a 4% gain on Power Grid. Now NTPC is pushing a gain of about 1.5%. Then you have a couple of the private sector banking names, and like Nigel was saying, they are really preventing a wider decline on the Nifty. And I can name a couple of them: ICICI Bank, HDFC Bank, and even Axis. Last I checked, even Axis up about 1.5%. So they're ensuring that we don't have a wider collapse. And Reliance, at least for what it's worth, is at that flat line. Pull up Reliance's chart. So these are banks which are doing better now in the second half than how we opened out. And Reliance, pushed towards the positive side, but now there's some volatility setting back in. So let's see how it goes. On the flip side, IT seeing a fair amount of profit taking. LTI, Mindtree, Tech Mahindra, these stocks are lower. And then you have names like HUL, and ONGC as well. By the way, SBI is not participating in that bank move. It's only private banks, so let's keep our eye out on it. But yeah, the bigger story is mid-caps because it's a day of profit-taking across the board, really.
Well, that's right, Surbi. And, just a couple of stocks to pull up on your radar. In the last few minutes, you've seen Cummins. The stock was nearly a 4,000 rupee stock. It's moved to around 3,600 rupees odd. And the other one is Bajaj Housing Finance. So much of excitement, right? The stock made a high of more than 190 rupees. Currently, it's hovering around 160 rupees or thereabouts. So let's pull up Bajaj Housing. There was so much of excitement out there. That's today's chart. You pull up maybe a 2 or 3 week chart, from the day it's listed. The stock has seen a sharp correction from the recent peak. So maybe sometimes rushing into these names once they get listed may not be such a good thing, because if you bought at the top, then you would actually be sitting on a loss. And in fact, the stock listed, I think, at around 135 rupees or so. So it's seen a big correction from the peak that we saw out there. Could be a longer term good stock, but in the near term, it seemed to have run ahead of itself. Well, how do you position yourself, though, in the final hour of trade? Mitesh Thakkar is back with us. Mitesh, flat is not bad, and we're trading around the flat line. Your view on the index, and fill us in with a couple of your picks.
Good afternoon, Nigel. I think I would agree with that. It's a decent market. After a good rally, if you're just down 5% on the Nifty and you are still positive on the Bank Nifty, it's a good market, actually. So stay that way. I think today a lot of real estate stocks are having similar a breakout pattern. So I've identified Oberoi Realty as a fresh entry trade, getting past the earlier swing highs of 1900 levels. This time we now bought with a stop below 1900 for a target of around 2,002 billion. So that's one. You could have also seen Godrej Properties as well as DLF discover some positions are there in DLF for me, as as these stocks which are doing very well. So that's one area. The other one is metals, which has done very well. And maybe, that's an area where you would see some good action. Though I think today is quieter than yesterday, because after the gains, after the move, yesterday is just consolidating today. But the momentum remains. So I recommend a buy on Vedanta with the stop below levels of 468 and target of 500. Yeah.
Okay, all right, got it. Thank you very much for that. By the way, there are some very sharp moves in the mid-cap market, and we'll discuss these stocks as we go along. On the losing side, today Easy Trip has taken a knock of almost 15% because of, this whole question mark about promoters looking to pare down their stake. So that's one sharp one. And IEX has continued to fall, another 4-5% down on IEX. We'll get you more on these stocks as we go along, with plenty of newsmakers in the market. Well, OMCs are also in focus, OMC stocks. Now, there are reports that are speculating that perhaps we could see a retail level price cut before upcoming state elections in Maharashtra. Sonal is here with more details. Sonal, I guess this buzz always comes around every time we go into an election. What is the latest and what is the word on the street?
It does, actually, and this is something which is expected again ahead of elections, the state elections, especially the states of Maharashtra, where we do see big revenues coming in for these oil companies in terms of petrol and diesel sales as well. So there are some brokerages who are expecting this. CLSA says that there has been a recent drop in crude prices, contraction in refining spreads, because of which marketing margins are at a multi-quarter high. On the back of this, there's an expectation that maybe ahead of upcoming elections in Maharashtra, there could be a cut likely soon, around 5th of October itself. That is something that they're expecting. They also believe that the government could go ahead and they talk about excise duty along with any retail fuel price cut. So they will save their own revenues there, but there could be some hit on oil marketing companies that we could see. This would bring down break-even price for diesel and petrol and make all these three stocks, that is IOC, BPCL and HPCL, vulnerable if crude prices go above that mark of $80 to $85 per barrel, because after that fall continuously, the crude oil prices have been going higher already. BofA Securities also talks about a possible price cut on the horizon. They say with retail petrol and prices remaining unchanged, spot diesel and petrol margins, they have improved substantially to 7 and 10.9 rupees per litre. They, however, continue to remain very cautious on the sector overall. They reiterate they underperform on HPCL and BPCL because of high net marketing sales. Especially they talk about HPCL that has the highest net marketing sales to refining throughput ratio. That would be impacted the most. Every 1 rupee litre cut both in diesel and petrol prices has an impact of 36% on HPCL's EPS, and for BPCL and Indian Oil it will be between 21 to 26%. So these are some of the factors they think will impact oil marketing companies if there is a price cut that would come by. Also considering that crude prices have already inched higher from those lower levels.
Okay, all right, Sonal, thanks a lot for that. So that's clearly the fear, and in fact explains why those stocks are a little under the weather. Prakash Tivan joins us. Hi, Prakash. Good afternoon and good to see you in. How would you approach these OMCs? That's always going to be the risk, right? You have crude oil prices bounce back up. You have state elections as well, so there could be some populism that comes in there. Your view on these three?
Good afternoon, Nigel. So I definitely feel it's precisely because of this uncertainty and this overhang on regulatory forbearance, which always, lets a market accord a very soft P multiple to these companies. I mean, you have IOC available at, less than 6 times. BPCL, similar situation. In fact, BPCL is the cheapest stock in the Nifty from a P perspective. And I feel if you look at this consideration or this anticipation of a price cut, I think this happens all the time. But given the fact that crude is not something which is all very decisively on its way down, in fact, it's been fairly range bound, and it can kind of spike up if things look up. Especially, winters is the time where stocking happens, and especially in the North American market. So if that were to happen, I don't see any reason why this price cut becomes starts crystallizing. And in the absence of that, you have all these stocks available at such low valuation. BPCL particularly is very balanced. It's not skewed towards refining as IOC is or towards marketing as HPCL is. I believe if you had to take one out of all of these, I would put my money on BPCL, and it's available at very reasonable valuation, as I said earlier.
Okay, so that is the take on OMCs. Let's go back and look at some more stocks that are on the move. Actually, on a day like today, when the broader market's cooling off, I just want to take up some more names. Saregama. You can't ignore a move on Saregama, the kind of the move that we're seeing today. Volumes are also pretty large. 18% is what the stock is doing at this point in time. And the other one that's surging as we speak is Z Entertainment. This is interesting because I think a different company, in that Z Entertainment did a deal, I think, with Mukta for content. Some sort of a content share deal, but the stock that's obviously rising is Saregama. But interesting moves on some of these media names. Then there is Senco, which continues to shine and sparkle, 5.5% up on Senco. And one more that can be highlighted is probably HEG, 6% up on HEG as well at this point in time. So interesting mid-cap moves coming through. Nigel, HEG, anything new?
Yeah, just a view on HEG. The reason that the stock is going up is because a couple of factors. China is announcing the stimulus, right? So the hope is that the steel cycle bottoms out. There's only 5% of the Chinese producers that are making money at current prices. So that means that they either will not produce or the prices need to bounce back up. So if steel prices move up, graphite electrodes is an input for steel, right? It's used primarily for steel making. So if steel prices are going to move up and the cycle is going to turn, then graphite electrode prices that have been under pressure, well, that's going to get some base. The other factor is that the largest producer, who has 30% market share, they, in fact, Graftech, they have increased prices by close to 20% for the new contracts. So the hope is that most of the 20% gets absorbed, and even if the worst case it doesn't get absorbed, at least it puts a base to graphite electrode prices. And as we know, the prices move up together, and prices have been declining non-stop. So now the hope is that pricing will turn around for graphite electrodes, volumes will pick up as well because steel companies will be in far better shape, and that's why these stocks are moving up. HEG, I think, in the last month or so, I think the stock has moved up roughly around 15 to around 20% odd. Prakash, you track these counters, HEG and graphite. India, I remember, 6-7 years ago, they had a beautiful phase when they were giving margins of 60 to 70%. HEG management, always when they join me, they tell me, Nigel, those days are gone, but at least things should bottom out in the near term. What's your view on these counters?
No, absolutely right. So if this China stimulus is something which can have a long-term impact, which I'm still not sure, and I'm not ruling that out, but, the Chinese government comes up with moves which are fairly nebulous in that sense. But if you believe that globally the steel cycle is bottomed out in terms of pricing and things could only look better from here, then of course with the lag, HEG graphite will start doing well. But at 48 times trailing, HEG is not coming cheap. I mean, it's an input and it has so much of a dependence on the underlying business. But I go back to this whole thing that when we are looking at these kind of plays, the shovels and axes play as compared to, buying steel, you will always be more vulnerable to global demands and this thing. But I think by and large, these companies will start paying off. And the other thing you can add to this is refractories, Nigel. You know how well that business also starts doing well once steel making starts doing well. But there is still some time. So let the steel thing cycle start giving you a very decisive move that it's on its way up for the next 12, 18 months. And then probably HEG, and this will probably give you that 20-25% kind of a move potential. But from here on, it's close to its 52-week high. I remember looking at it sometime back, 2,700 odd was the high. And it's closer to that. So it's not, as you said, it's moved in the last 1 month in anticipation of this. I would be a bit sanguine about adding more at this point in time.
Since you mentioned refractories, what do you like from there? IFGL promised, but then it couldn't really keep up, so that stock corrected. Vesuvius has been a beautiful outperformer. I recall, explaining the stock at around 1,700-1,800 rupees. I think it's around 5,500 rupees right now, and that's really made a big fight back because otherwise RHI was top of the pack.
Yeah. No, I think Vesuvius still continues to be the best quality name out there, and I remember your midcap mania it's been maniacal in terms of the move as well after that. But it will give you very good resilience to play the sector, and refractories is far more dependable because given the supply dynamics of this thing as compared to graphite. So I would still look at something like that and hold on. And you could add on dips. I know it looks very well priced. 56, 5,700 is not easy to digest. But in terms of valuation, forward valuation, it's still not as pricey as some of the other names. So I would look at that.
Okay, so steel, graphite electrodes, refractories. For those who are interested in playing the possibility of a rebound, a more sustained rebound, given the China stimulus. Got it, Prakash. I'll stay on some more questions for you in just a bit. Dabur is a stock under pressure. In fact, it's down almost 4-5%. UBS has actually downgraded the stock, which is an interesting note coming through. Vinny is joining in with details. Vinny, this is interesting because most people are talking about a rural recovery and how tactically, positioning is moving towards FMCG. Then why this downgrade? What is UBS saying?
Yes, UBS is highlighting that rural recovery is there. That's not a worry coming in. The worry point for them for Dabur is mainly from the real juice segment because there's a lot of increasing competition that one is seeing in the cola space. There are a lot of new launches that have come in. Let's not forget Reliance had launched Campa Cola, and that was at a price which was much lower than the real juice segment. So the juice segment of them could be under pressure going forward because of the increased competition, pricing war in the carbonated space. And real juice and the juice segment accounts for around 9 to 10% of their revenue. So chunk of their revenue comes in from this side. Not only for juice segment, but increased competition that they're facing in the coconut oil segment that accounts for around 2 to 3% of their revenue. A lot of companies like Bajaj Consumer also has entered into and forayed into this space as well. So that is an increased competition which could be factoring in and which could create some bit of a pressure on the stock going forward. Rural recovery, like you said, it's in place, and that's what even UBS is highlighting, but that is priced into the stock already. The valuations at which Dabur is trading right now is quite high. So that is why they're seeing a bit of a downside risk coming in, downgraded the stock to a neutral rating, target price of 700 rupees per share, and cut the EPS by 11% because of these risks.
Okay, got it. So a little bit of concern on the juice out there. Vinny, thanks very much for highlighting that note. Prakash, what do you think? Do you kind of find sense in this thesis? Or do you think this is a bit of an anti-consensus call and you wouldn't concur? Dabur?
Yes, I would concur to this. And I'll tell you my logic behind this. It's precisely the reason why UBS is talking about the softness anticipated going forward. First, coconut oil is just about 2.5-3% of their revenues. Okay, does it make a difference if it goes down? Competition can come in. The market size is so massive. The segmentation is very different. You always had Marico as the leader, and still Dabur ventured into this. It's not a flagship product of sorts. The other thing is juices has got nothing to do with your consumption on colas and carbonated drinks. They have a standalone kind of a application and usability. So I think this is a bit overdone. In fact, the innovation that Dabur has done in the juice category is only helped them increase market share against a lot of other competition there. And look where it is traded, 58, 59 times trailing, about 42 forward. It's done well in the last 3 months. It's done about 20% in anticipation of improvement in volumes. I believe post-monsoon, the volumes, and that's what the report also says, that the volumes will pick up, market share will strengthen. Some of these competitive intensity or issues could probably impact it, but not so much to downgrade it so drastically. I still feel there is an upside, and their target also is 700, which is good. They're talking about at least about a 15-18% kind of an upside. I believe it could do much better. And remember, Dabur also has some other businesses in Asia, which in the Asian subcontinent, which also do well. So not to worry about it. It's a company that continuously innovates on products, and the price points are fairly robust. So I would still be positive on it.
Okay, so there's still ample juice in Dabur, the stock. I guess that's what Prakash is essentially saying.
I have a more fundamental and very basic question.
Which is?
What's the oil best for one's hair?
Between
the almond and the Navratan tail and the parachutes, that's
Prashant,
very deep question, Prashant.
Coming from a Keralite, it's an odd question.
I know. Why do you think I've grown up? but now at this stage of my life, I go to people tell me, well, it's really bad it's really bad. Don't put it. So it's one of those existential questions. No right answer. You ask 10 people, you get 10 opinions. You have a favorite, Prakash?
No, you can look at my hair and make out that I don't really use much of oil. So.
But Prakash, you're in Paris, right?
Sorry?
You're still in Paris? You're still in Paris?
Yes. Just a couple of days ago, Nigel, yes.
Lucky guy.
I don't think
don't worry.
I don't think he's thinking of coconut oil right now. But okay. Prakash, finally, before we let you go, some interesting stocks. So take your pick on any one. I was just highlighting them. So there's Ease My Trip, all kinds of things happening with the company. They're trying all kinds of new business strategies. They want to do buses. They want to become strategic incubators. And now the promoter is probably going to sell stock. So that's one. And the other, these media stocks. That was interesting. Today's move on Z, on Saregama. Any thoughts on any one of them?
So I don't know what's triggered the Z move, because the Mukta Arts content library is fairly well priced, as in it's been discovered. Mukta itself been a listed company for so long, so we know exactly where the value stands. So I think it's just some excuse to look at buying into Z if there is some sort of a special situation emerging sometime later. But Ease My Trip is the company where the promoters have been just exiting. I mean, it's been priced too high. If you really see the traction, profitability is still some time away, and for them to not focus on profitability within the core ticketing business and go into other things itself is a question mark. So I think the market is wise enough to punish it. There are far better names within that space which could consolidate, and like look at Yatra. I mean, there's lots of special situation that's happened. The Nasdaq thing is off. You probably have an acquisition from the Globe travel side, which would tie in very well. So these are small businesses that have the right to win in terms of market share and business scaling up. So I would look at that, but Ease My Trip is absolutely an avoid.
Okay, all right, Prakash. Great having you on the show. As always, you enjoy the rest of your day, and we'll connect again soon. Right now, need to take a very quick break. On the other side, Nikhil Ranka of Nuvama Asset Management will join in with some market thoughts.
Than a woman. The way that this culture, this society has been upended is a cautionary tale for the rest of the world. In the 70s, most of the civil servants were women, over half the teachers, doctors. There were women jurists, lawyers, in every profession. And then the world upended. cat may go sit on her front stoop and feel the sun on her face. She may chase a squirrel into the park. A squirrel has more rights than a girl in Afghanistan today because the public parks have been closed to women and girls by the Taliban. A bird may sing in Kabul, but a girl may not, and a woman may not in public. This is extraordinary. This is a suppression of the natural law. This is odd.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late.
Investing.
Okay, welcome back. We've got the market, which is, 7 points lower, 25,940 is where we are at. Nikhil Ranka is with us, Chief Investment Officer of Equity Alternates at Nuvama. Nikhil, great to have you back on the program. Thank you very much for your time. You're cautious, let's put it straight up, and for a variety of reasons, from F&O positioning to the new thing, which is maybe China looking a little better at the margin. And I think your view is that you'd watch foreign flows very closely over the next couple of weeks or so, whether all this stimulus, etc., is attractive enough to get foreigners to buy that market. Is this a very near-term view, Nikhil, or you think overall for a while the market needs to consolidate?
So good afternoon, Prashant, and thanks for having me on the show. If you look at near term, what has clearly happened is, if you look at the weightage of India and China in the MSCI Emerging Market Index, both India and China have been close to 20% weightage. But if you look at the trailing 12-month FII inflows into both the markets, China has seen outflows of $92 billion, whereas India has seen inflows of close to $17 billion. So a lot of fund managers, the emerging market fund managers, were running an underweight position on the Chinese market, and that has played out well for them. Now with the Chinese government giving stimulus, acknowledging that the market needs some sort of support. Yesterday we saw Chinese markets have rallied 4%. They have moved up again today, and valuations are less than 10 times CY25 for the Chinese markets. So my sense is, if there's more strength in the Chinese market, a lot of the foreign portfolio managers will be forced to increase allocation to Chinese market. And that would mean that India could have lesser share of foreign inflows as we go forward. If you look at it, in terms of positioning also, the last 1,000 points move on Nifty that we have seen, there has been almost close to 30,000 crores of buying on the F&O side, and another 30,000 crores of cash market inflows that we have seen in the FIs. And yesterday was the first day where we had a large sell figure from FIs after a long time. So yeah, we will have to watch this situation very closely. And the second point is, even by historical standards, if you now look at the valuations of Indian markets, we are now close to 21 times FY26 earnings, whereas the median multiple has been somewhere close to 19.5 times. So we are a bit therefore cautious on the near-term outlook, and we will want to watch the FI flows in the markets for the next fortnight very carefully.
Okay, so yeah, take your point. Let's see what happens to those FPI numbers, because we haven't had very consistent flows come into India anyway. Let's see if that number starts getting negative or not. But Nikhil, to sort of talk about our market on its own merit, I think the other point you're making is on earnings, and that's a point one can fully appreciate. Q2 is the litmus test, right? Q1 we said there's election, and there are other issues and impediments because of which you could ignore a couple of misses here and there. What is the Q2 expectation you have? And in terms of any sectoral preferences, if you have, do share that with us.
So Surabhi, if you look at it, for the full year of FY25, we are building in somewhere close to 13-14% earnings growth. If you look at the Q1 which just went by, there was an 8% earnings growth for Nifty 50 companies at an aggregate level. Now, clearly, the commentary from most of the management was that there were disruptions because of elections and heat waves, and that things will start normalizing from Q2 onwards. And Q2 also will have some impact of the festival season. So if Q2 doesn't see a 12 to 15% earnings growth YOY, then clearly there is a risk that the street will have to start downgrading consensus estimates for FY25. And that could have some sort of ripple effect because one, you are already trading above mean valuations on indices, positioning is at all-time high levels. And on top of that, if there is some sort of earnings disappointment, then clearly we feel that the markets can have some small pullback from here on levels. In terms of sectoral preference, the last time when we talked about, we had said that banking is one of the sectors that we are positive. Bank Nifty at that point was closer to 51,200, 51,300 levels. We've seen a 6-7% up move in most large cap banks from there on. And we still feel that there's another 10 to 12% upside that one can make in these names over a 10 to 12 month horizon. In terms of cautiousness, we've gone a bit cautious on the IT names. So clearly, if you look at it, the commentary from most large IT players, if you look at it, they are not signaling a significant demand revival from where we were in Q1. If you see the deal will announcements also from most of the large Indian players, we haven't seen much of large deal announcements from them. Typically Q3, Q4 are seasonally weak quarters. If you look at the commentary from Accenture a few days back, they have deferred pay hikes for 6 months. So my sense is valuations, we are trading probably one standard deviation above mean. And if earnings trajectory or earnings momentum does not follow for IT names, there could be some sort of selling in those names. In terms of geography, Europe specifically is one of the geography where most companies are saying that they are seeing slowdown. And the second part is if you look at BFSI as a whole is close to 40% of the overall earnings for IT companies. And there, given that there's a rate cut cycle that's happening, the names could get a bit compressed for large banking names in the US. So yeah, we have some sort of cautiousness on IT names going forward.
All right. Hi, Nikhil. Good afternoon and good to see you, Ben. Since you briefly spoke about China, and we have been discussing that the play on China could be metals, but you're talking about the chemical space as well. Do you think that could be the dark horse from here on?
Yeah, so what has happened, Nigel, is over the last 4 to 6 quarters, most of the specialty chemical companies in China, if you look at it, they had set up large-scale capacity and demand was clearly an issue because economic growth had slowed down. And consequently, here also we've seen that over the last 4-6 quarters, chemical companies have disappointed. Going forward, the commentary from most of the companies was that prices at least seem to have bottomed out. And so therefore, because markets are typically 3 to 6 months ahead in terms of pricing earnings recovery, if we see data points from China stabilizing, then that's one sector where positioning also is low. And if we get that green shoots of recovery, then specialty chemicals can start doing pretty well from here on. Is what my view is, because they have not participated till now in the rally that has happened in the markets in a big way.
Yeah, right. And you briefly mentioned that, financials are something, banks financials, something that you spoke to us about the last time, and it's done 6%. You believe that it could do well from here on as well. Which side are you leaning to? Do you think the private sector banks now are a better place than the PSUs?
So if you look at it, private sector banks have moved, honestly speaking, more than what PSU banks have moved. And so tactically, given that most PSU names are today trading closer to book value, my sense is there can be some sort of catch-up that can happen on the PSU side now. Private banks have already moved 7-8%. And then the street will clearly watch out for what is the Q2 update from most of the companies. In the first week of October, we will have a earnings update from most large private banks as well as some of the PSU banks, where we will get to see what sort of loan growth they are reporting. And so my sense is that there is some sort of tactical play that is still left on the PSU bank side. 8-10% up move is something that we feel can come even on that space.
All right, Nikhil, by the way, these are broad sectoral kind of trades, etc. Are you finding enough to do in terms of idiosyncratic kind of moves? Single stock could be a situational thing, or you think those are also they're being very, very, very efficiently priced, getting harder in that sense?
So clearly, Prashant, things are becoming difficult. It's getting difficult to find value in the markets. In terms of specific sectors, something like, the largest power generation company, there's announcement of the green energy IPO. This could be 8-10% up moves that one could tactically play in these names. We've seen that happening with Bajaj Finance also. When Bajaj Finance Housing got announced, the stock listed at almost close to 5 times price to book. And so there was that tactical rally that happened in Bajaj Finance as well. So something of that sort where, so value unlocking is happening in subsidiaries. Those sort of trades definitely can pan out because the market is short on ideas. And therefore, wherever they see that there's 8 to 10% upside that can be made, people very quickly latch onto it.
All right, we'll leave it there. Nikhil, great to speak with you. Thank you very much for coming on, and thanks for that view. Quite interesting. Now, we're all talking about how capital market plays have done phenomenally well, right? This is the prime example of how well capital markets have done. The largest online broking company, Zerodha, announced FY24 earnings. CEO Nitin Kamath has said, and I quote, they're bracing for a big revenue hit. End of quote, amid upcoming regulatory changes. The folks who run it are broadly cautious. I mean, Nitin, for example, regularly warns his Twitter audience that things are not going to be as great as they have been. But 24 has been fantastic. Vamakshi is here with details. Vamakshi.
Well, absolutely. FY24 was a fantastic year for Zerodha. They witnessed an uptick of almost 21% in their revenues, but the net profits were up nearly 62%. But going forward, the management appears quite cautious on their growth outlook as well as their growth trajectory going forward. Nitin Kamath, who's Zerodha CEO and co-founder, said that despite the strong performance that you saw in the past year, the company might be seeing a hit in its financials due to various regulatory changes from this year onwards. Many risks were around the corner, he said, and they all seem to be materializing simultaneously, and they're already seeing revenue and profit plateauing, and they're bracing for a big revenue hit in the coming year. They've also gone ahead and quantified the impact from various regulatory risks. SEBI's True to Label circular, which will come into effect from October 1st, they're expecting a 10% revenue dip on account of this. SEBI's consultation paper on index derivatives, if it does materialize, could see an impact of almost 30 to 50% on its revenue. Additionally, increase in STT is expected to come through from 1st of October, and the impact on options trading is expected to be minimal, but it is expected to be quite significant on the futures trading. The threshold for collecting annual maintenance charges has been raised to 10 lakh rupees as compared to 4 lakh rupees now, and additionally the removal of opening account fee could also lead to a meaningful drop in the revenue, is what the company has highlighted. Along with that, the referral program is now only limited to authorized personnel, so therefore customer onboarding through the referral program, that will come to a halt if you're not an authorized personnel, and resultantly this could impact growth going forward. So this does have a negative read-through for not only Zerodha but for some other brokerages as well, which includes Angel One and 5 Paisa Capital. But nevertheless, the company is also undertaking several diversification measures in order to mitigate these regulatory risks. But given those factors, we do have Zerodha in focus, and along with it, Angel One and 5 Paisa Capital also down in trade.
Thanks a lot for that, Vamakshi. By the way, take a look at the markets. There seems to be an element of expiry that's play out, weekly expiry that is. The Nifty Bank has now moved to the high point of the day. We're up close to around 150 points. A couple of other larger cap names as well could have moved, in step as well. So maybe you pull up Reliance Industries, ITC. It's the Nifty Bank. The Nifty Bank has moved up 150 points, 54,250. That's the crucial mark out there. ITC, let's see what ITC is doing. I think a couple of banking names as well, like Axis Bank, have put on some weight in the last few minutes. But let's focus on power stocks. Power grid continues to climb up on the finalization of the new National Electricity Plan. Vivek joins us to fill us in with more details. Vivek?
Well, that's right. The new National Electricity Plan from 2023 to 2032 has been finalized. The total capex or the total cost of the plan is at 9.15 lakh crore. This plan is aimed at meeting a peak demand of close to 458 gigawatt by 2032. Remember, the earlier NEP was from 2017 to 2022. What are the key targets? Number one, to meet increasing electricity demand, like we just mentioned, and also to facilitate renewable energy integration and green hydrogen loads into the bid. Now, when you're talking about the new plan targets, what is it that they have? They intend to expand the network expansion as far as the transmission capacity is concerned. Also, they will be adding 9 new lines. These are HVDC lines. And along with that, interregional transfer capacity will be increased from 119 gigawatt to 168 gigawatt. Along with that, a transmission network of close to 335 gigawatt is being planned. Who are the key beneficiaries? Number one will be Power Grid. Every time there is transmission capex that is outlined, Power Grid stands to benefit. Along with that, a whole host of other players in the system that you can see on your screen also will stand to benefit. Goldman Sachs has written a report on this particular development. They believe that given its large balance sheet, low cost of debt that the company has access to, Power Grid will be a key beneficiary of the latest NEP guidelines that have come in.
Okay, all right. Explains the kind of enthusiasm that surrounds power stocks, of course, throughout the entire value chain. Thank you for that, Vivek. We'll take a break on that note, come back on the other side, and we will have, of course, all the dealing room chatter coming up with Nimesh, and then some final trading calls for the day coming up with Mitesh as well.
Raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality. Yeah.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. Okay. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries getting involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest caution. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy. But we are spending a lot of money. And in my view, that spending the money causes growth. It also causes inflation. And whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm putting me on the cautious side of that one.
Welcome back. It's not just the banks, some of the financials as well are moving up. Bajaj Finserv has moved to the high point of the day. Good move is what we're seeing out there. Mahindra & Mahindra was quiet for most of the trading session, but that's got a leg up as well, which explains why now the Nifty is above the 26,000 odd mark. The intraday chart of these stocks should come up for you. Even the FMCG index actually has moved up. Nestle is seeing a bit of a spurt in the last few minutes. Nimesh joins us to help us out with what he's picking up in D-Street chatter. Nimesh?
And I did not depth consolidation, so to speak, but again, it's very selective. With, there is buying happening within the PSUs as well. So again, the flows today are muted compared to what we've been seeing in the last few days. But whatever the flows are, seems to be largely in the large cap names and some select PSU stocks. So that's the overall texture in terms of flows. I guess what explains the move in Nifty in the last 30 minutes of trade is because I understand there is a small MOC basket buying as well in select Nifty names in the last 30 minutes. So maybe that's the reason why you're seeing an uptake in the Nifty as well. But the broader market tends to underperform, and that's been the trend for the last couple of days. And there's a feedback as well that maybe the shift is happening towards large caps from the broader market stocks. So that trend continues. But again, today for a change, the flows are slightly muted and very limited to a few Nifty names and some PSU stocks.
Yeah, but there's this last sort of 15-minute uplift. It's making the Nifty look nice, right? We've got 2,600 on the screen, at least for now. Let's see if we can close above that. What about individual stocks, Nimesh? What's the buzz today?
Well, so I normally start with a block deal. So again, today was a large block in KPR Mills, nearly 1 crore shares, close to 3.5% equity call change hands. Again, looks like the promoter entity was a seller in today's block and a domestic mutual fund was a buyer. So disclosures would be quite interesting. The sharp actually has recovered from the lows after the large block. The second name is Dabur. Under pressure today, there are sell flows, is what I understand, at larger FI desk. And additionally, there was a UBS downgrade as well. While they've raised the target price, the call was to downgrade purely on back of risk on earnings going forward. The third name is Tata Steel. We've seen a bit of buying back in the metal stocks, and Tata Steel stands out. Yesterday there was a large delivery-based buying, and even today I understand there are very strong buy flows. So it looks like overall towards metals there is a bit of interest back from larger FIs, and so is the case with Tata Steel. And the last is Equinox India, the erstwhile India will real estate. After a long time, looks like some bit of bid interest is back. There are very strong buy flows and some bid interest as well at leading FI desk in Equinox India.
All right, Nimesh, thank you very much for that. So lots of blocks, lots of action. I mean, it's a hot market for all kinds of things. And Nimesh, of course, getting us a slice of what to expect. We'll keep an eye out on those names. Well, as I said, the blocks are going to continue. And Vivek is now joining us. And what he's given to understand is that 5-star finance may see a block 20%. I mean, so there's got to be a private equity player looking for an exit. I mean, that may happen soon. Vivek, tell us more.
Well, that's right. Just as you mentioned, what we are picking up from our sources is the fact that in 5-star finance, a clutch of PE investors, largely led by, Peak 15, this is the earlier Sequoia Capital. Also remember, Sequoia Capital also owns stake in the company. They are leading, the charge as far as, pairing stake in the company. A whole host of almost 5 private equity players hold a little over 25% stake in the company. We understand that very soon, there could be a block deal that could be launched where there could be a certain amount of stake. We understand close to 20% of the total equity could change hands in this particular block deal. Close to $500 million would be the size of the block deal that we are given to understand. We reached out, of course, to P15. P15 declined to comment on this particular story. But, just for reference, have a look at the shareholding pattern as far as the private equity investors are concerned. Sequoia Capital, almost 3.5% stake. Sirius, that is KKR, almost 6% stake. Peak 15 Partners, ex-Sequoia, they have close to 3.77% stake. TPG Asia, 9.28, and Norwest Venture Partners close to 5.16. We understand a whole clutch of them will be joining hands and will be trimming stake. 20% equity of the total company could change hands quite soon.
Okay, all right. So the season of big blocks perhaps is going to continue. This could be a new name on the radar. Thank you for that, Vivek. Let's move on and get you more market perspective. And this is the CNBC-TV18 exclusive. Manish Chokhani of Enam Holdings believes that valuations in the small and mid-cap space have gone berserk and that investors must avoid having too much of their investments in small cap stocks. He also says that investors must not fall prey to FOMO. Listen in.
The valuations are berserk over there. I mean, again, great companies. But, and again, I usually don't talk about stocks, but just to put some sense. And again, don't get me wrong, I'm not disputing valuations or anything, but just to give the Infosys example, let's say our favorite stock this year was, say, Zomato. It's a $30 billion market cap. Let's say we expect the market normally to give you a 15% CAGR for 10 years, which is 4 times. So it should be a $120 billion market cap in 10 years. Let's say it's a 30p by then, because it'll be a fairly large company. So it needs a $4 billion PAT, profit after tax. To get to a $4 billion PAT, just for context, today TCS with 6 lakh employees makes $6 billion. So is this possible? How will they do it? Will they add more lines? I mean, Amazons of the world have done it. They started somewhere and they ended elsewhere. But if you're taking that bet, your time horizon has to be that, or your return expectation has to be that much lower. And that's the sort of stuff going on over here.
Got that. I want to talk about leadership in this bull market as well. And we'll get back to what to do and advice for investors a little later. So PSUs, capital goods, real estate, infrastructure, that's essentially been the leader of the bull market. But we were defense, etc., right? That part, it looks like we're starting to rotate. People are starting to rotate out of that.
Which is inevitable.
Inevitable. You think that's done, or is just like a pause and refresh case here?
Again, in terms of market cycles, when you see the leaders of every cycle, then they go to sleep for a decade. So the leadership of 2000 to 2007, which you were earlier alluding to, was indeed commodities and infrastructure, power, real estate. And then the excesses which happened in that period made them complete pariahs. So if 4 years ago, we were on a show and Ramesh and I remember we would talk about PSUs and everyone was like sniggering, like, what's wrong with these chaps? But because the correction had been so steep that it's eventually an investor's job is about valuation. Like I said, the greatest Infosys may not give you the return, and the what so-called poorest PSU may give you the best return. So it was a mean reversion trade which happened, and of course all the right policy things happened for infrastructure and defense and railways and so on. So you go from being what I call terrible to bad is a rate of change, but you went from terrible to being good. So that rate of change is so dramatic that's what the markets have discounted.
And now maybe to great.
And now you're imagining it to be great. Some of them may make it, but most of them won't. So I would be very, very cautious in those kinds of places. And typically these are not high return areas. By definition, if you make 25% IRR in an infrastructure business, the cost to the consumer, which is the average public, is going to be too high. So your money made is really on leverage, and therefore the return on equity comes in that business. So, and people are shy of doing leverage after again the last cycle. And the flip of it, sorry to just complete, the leadership of the last cycle was all the high quality businesses in the last decade, which were all getting re-rated. Asian Paints, Page Industries, Kotak Bank,
consumers, retail.
even, and including banks, because banks became 30% of the index. And you're seeing that getting corrected, that Kotak, HDFC haven't performed for the last 5 years. Again, great companies, but it's the excess of that which is now getting reverted back. And now they've become so hated that when will HDFC move? And there are memes on HDFC doing the round the way it was for ITC. And then you saw the way when ITC moved, it just doubled before anyone realized it.
You think...
so things like that tend to happen. I can't forecast what will happen in...
But you're very bullish on the financialization theme.
I am very bullish.
And financials, right? I mean, advice for investors who are watching, Manish. I mean, because in many ways you're saying that a lot has happened. So one must be cognizant of that when you make fresh purchases.
So what happens, and again, it's something I've experienced in the past, so maybe that would be of benefit to investors, is, look, the market tends to be a 75% large cap, 20% mid cap, 5% small cap type market. And that's the distribution. Few of these will graduate to box 2 and few of these will graduate to box 1. So your normal portfolio allocation tended to be a 80-20 mix, that we would keep 80% large cap for safety and 20% to give you the alpha, to give you much better. Given that we guys also came back from, we built a lot of our wealth on the small and mid caps only. But when you start doing that, you realize your portfolio mix tilts because those companies become reverse. The small and mid become 80% of the portfolio and the large become 20. And whenever something goes wrong, like you had crises in 2008, 2018 even, for no fathomable reason, they can tend to fall 60 to 80%. And that is very, very damaging for the portfolio. And that is what really scares you out of the market. Like, again, the same famous example of Infosys. It went from 16,000 to 2,700, which is like almost more than an 80% fall in a high quality company. Because when that happens, liquidity, you'll be surprised, it just vanishes in the stock and you just can't get out. And what you think my portfolio value is, whatever, 100 rupees, it looks like it's less than 50 suddenly. So if you can just keep tilting your portfolio, that if your asset allocation is okay, that you may have maybe 50, 60, 70% of your money in equities. It's very easy right now to feel you're making so much money, get out of banks, liquidity or whatever, put it all in the market. If you're not prepared for a downturn in the market, then you'll get scared out. So asset allocation to equities, number one. Within that, what is your mix in your portfolio? Be very cognizant. Too much concentration in a small or mid category, or too much concentration in one sector. Again, for example, the parallel of TMT in the 2000s. If TMT became 50, 60% of your allocation and that fell by 50, 60%, where were you? So just be cognizant of portfolio balances. I'm not suggesting this is better or that is better, but just do what's right for you and what stage of life you are at. So I'm finding people who are 60, 70. I have a cousin who's 74 years old in another city, and she's calling up and she wants to buy small caps. She wants to buy like the three most powerful, high volume stocks in India nowadays with 60 lakh shareholders, or is it 60 lakh or 60 million? I don't know. A Yes Bank, Idea, and Suzlon. I mean, maybe it's great companies and they have a view on it, but I mean, is it the right stock for you? First, you think about that. People will call up and if they'll ask me, should I buy a bank? And if I end up saying ICICI or HDFC, they're like, but Yes Bank goes up every week. Again, nothing wrong with it. But is that right for you? So just think of allocation in your portfolio and what you're doing.
And the other point I think which you made before as well, riding existing winners is one thing.
Yeah,
going into
that's
new
absolutely
things,
right. So when you're in the middle of a cycle, most horses are going to run. Don't be impatient if in this cycle, this horse handles. For example, if let's say financials haven't run and you feel, oh my God, defense and railway is running, and you leave this and you come to this horse and this horse has already run and it's ready for a down drift or a sideways move. And you've jumped here and you know less about this than you knew about that. It's going to be damaging again if something wrong happens over there. So I think just stay away from what I call FOMO. This is not a FOMO moment in life. Don't get greedy. Returns have been extraordinary and there's no reason India won't. I still think 90% of our wealth lies ahead of us in the next 20 years.
All right, well, that's very optimistic sounding Manish Chokhani, but also a word of caution. But look at the market, which is zoomed and how. I mean, the move, I'll tell you, started at this is essentially the definition of a 3 p.m. move, because the move started at 3 o'clock. With the Nifty was at 24,924 and we are at 26,015, which means almost 90 points from exactly 3 o'clock. So that is the extent of the sharp surge that we've seen on the market. And what has led this? I mean, if you can have Axis intraday up, HDFC Bank intraday up, Power Grid and NTPC. These basically are the four names. And actually, you should put up Reliance as well. Axis on your screen, HDFC Bank, Power Grid, which should come up, NTPC and RIL, and actually ICICI Bank as well. I think this is the bulk of what has led to this very, very sharp surge starting 3 o'clock. The bank Nifty itself has not really done very much. I mean, the Nifty Bank has not moved at all. I mean, it's not nothing. So banks were doing much better earlier on as well, before 3 o'clock as well. It's just that I think non-banks have piled on. Power Grid, NTPC, Reliance Industries, Bharti, M&M, because the big private bank Trioca, that was doing well even earlier. Streep.
Also, Prashant, some of the stocks that were underperforming for the better part of the day, they've either cut their losses or they've actually started moving to the positive side. Lever would be one such case in point. Infosys, I mean, IT has been a non-performer today, really. But even Infosys has moved from the lows. That's ITC. Let's look at Lever. And the sharp move on both Infosys and Lever. Both are big stocks, big heavyweights, and they've actually helped the market move higher. In fact, some other names include the likes of Nestle. A lot of these consumer stocks, they didn't have such a great morning, but now they're all off their lows, and that's sort of helped matters to quite an extent. And aside of that, of course, there are names like Mahindra & Mahindra, Reddy's, Cipla. By the way, Pharma has had a pretty decent session today. Some of the large cap frontline pharma names, Dr. Reddy's, Cipla. These are names on the positive side of the screen. Even for that matter, the Midcap index, from the time we started the show at 2:30, it's kind of reduced its losses. It's still negative, the Midcap index, but the cut is about 0.6% right now. So a bit of a bounce on mid caps as well, though the advanced decline ratio is still low. But yeah, on the large cap screen, It is 26,000. We have about 4 minutes to go, and we need to see if we can get that close, the adjusted close, whether that indeed can be above the 26,000 mark or not. The problem area for the market continues to be one which is State Bank of India. All of the bank Nifty has moved. A lot of the constituents have moved higher. We've been discussing HDFC Bank, ICICI Bank and the likes, but SBI, no such luck. Even in this last move, SBI is flat. It's simply not participated. So that's a bit of an Achilles heel for the market, so to speak.
Absolutely. And let's get in Mitesh Thakur, who's with us with some a view on the trading that's going on in the sharp surge. Mitesh, your thoughts?
So I think possibly some adjustment related expiry related adjustment, but broadly, Prashant, the market remains positively biased, and I would have hoped for a slightly bigger dip to buy into because then the entry would have been very good. Today we got a low of 25,870, and I've talked about 25,870, 880 as the buying zone, just kind of touched and ran away from there. But I think that's the buying area. 25,800, 830 zone, as long as that's holding, I think the immediate that should be the immediate stopper seller, as well as that will help you ride the trend on the upside. So we keep maintaining a positive bias. Tata Power is something which I can recommend as a BDSC trade also. Keep a stop rate of 460, 3.5 for targets of 470, 480 for tomorrow.
Okay, all right, Mitesh, thanks very much. We'll see you with the market again tomorrow. Thank you very much for joining in and taking us through the close today. As we're winding down, let's look at some mid-cap trades as well, and then we'll be heading to the close. Today's, while mid-caps have lost, there are a fair amount of gainers on the screen as well. Some stocks that stand out include, like we've been pointing out, an HEG, Senco. Look at Johnson's Hitachi, about 9% up on Johnson's Hitachi now. Some of the names like GET&D, Tata Communications on the industrial side, these are stocks that have actually done fairly okay for themselves. And if we talk about the newsmakers of the day, then let's look at Delta Corp. Remember that was a big newsmaker in the morning with the demerger of the real estate business, 2.5% up over there. Car trade, which has seen recent blocks and marquee investors going out, but then big domestic investors also coming in, another 3.5% up on that stock. The slam dunk comes in on Easy Trip, down 15%. Dabur is down 4% on that UBS downgrade and some concerns coming through. So those are the major losers. And if I talk about, again, names beyond the Nifty right now, PB Fintech has lost quite a bit, 6% down. Devyani International has lost about 4%. And IEX has continued to struggle. Second day running, IEX is down about 4%. But really, large caps stealing the thunder today, Prashant.
Well, absolutely. And, as you said, power has been a constant theme, as you highlighted, the names like NTPC, Power Grid, etc. Technology, IT has been the weak link, and that index will end down 0.6%, as you can see. I don't know if you can pull up we can have the Nifty heat map. When we started at 9:15 in the morning, 30 stocks were lower and about 20 were higher. I'm not sure what the sort of picture is now. I'll just quickly run you through the broader market and what really happened. I'll start with what was down. Ease My Trip, sort of a big fall there. IEX was down sharply. Policy Bazaar was down significantly today. Dabur, of course, we've been highlighting. Winnie's been getting us the details. You had, for example, AstraZeneca. Same time yesterday, we were talking about that 15% pop. Guess what? It's given up some of those gains today. That's AstraZeneca. SBFC has spent the last 2 days giving up, parts of those 20% rally that we saw on the stock on Monday. So I think it gave up 6-7% yesterday, another 5% today. Zensar Tech, Newland Laboratories, Tribhuvan Zaveri, TBZ, of course, has also done very well, along with this entire jewelry stock rally that we saw over the last fortnight or so. On the upside, just a few names. I'll start with another jeweler, but on the gaining side, Senco did very well today. Power, as Surabhi's been pointing out, GET&D is a big winner. Z, I think again, Surabhi pointed out earlier. There's eClerx, which did very well. Tata Communications, Reliance Power, and PGEL, that's PG Electroplast, the EMS company. So these are some of the biggest volume-led gainers in terms of the session today. I think by the end of it, if I just take a look at what the advanced decline was, it was negative. but nowhere close to what it was looking, how bad it was looking mid-afternoon. 1,600 stocks down, about 1,150, 1,160 stocks in the green. That was the day. We end with about a 70-odd point pop thanks to that 3 p.m. move that we saw earlier. We'll take your leave on this edition of Closing Bell. Thank you very much, but do stay with us because Surabhi and I will take you through Markets Forward, which comes up after a quick break.
President Zelensky, Prime Minister, recalled his visit to Kyiv, their discussions on all matters, the bilateral issues as well as issues surrounding the Russia-Ukraine conflict. President Zelensky was very appreciative of India's attention to these issues and said that Prime Minister's visit had been highly appreciated, and he thanked the Prime Minister for the efforts that he was making for peace and a pathway to finding a way out of this conflict. Both sides appreciated that there was positive momentum on a lot of issues in the bilateral relationship, and they agreed to remain in close touch, either directly or through exchanges of visits.
Dalal Street recovers in the last hour. Nifty ends above 26,000 after hitting record highs intraday. Midcap index snaps its three-day winning streak, ends over 0.5% lower. Banks rise in line with the blue chips.
Power sector stocks like Power Grid continue their climb on finalization of the new national electricity plan that aims to meet a peak demand of 458 gigawatts by 2032. To this end, 50.9 gigawatts of transmission capacity with outlay of over 60,000 crore rupees has already been approved by the government in its first 100 days.
The IPO Q grows longer and bigger with SEBI clearing offers of Hyundai India and Swiggy. While the Korean automaker is expected to raise nearly $3 billion, Swiggy's offer size is pegged at a market valuation of about $1.25 billion. Hello and welcome to a fresh new edition of Markets Forward, your go-to program where we aim to get you everything you need to know as you gear up for the next trading session. And today was turning out to be a slow day, quiet day, blinking red and green, and then boom, 3 p.m. move and the market ending sharply higher. I'm Prashant. With me, my colleague Surbhi Upadhyay. Surbhi, hi.
Hi, Prashant. Although it was only a 0.25% increase on the index, I think the reason it really took us all by surprise was there was nothing happening for the longest time. And then we end with a flourish, finally above 26,000.
It was a sleeper hit, right? Or maybe we were sleeping in the market. Yeah, but
26,000 has been doing this. We hit the level yesterday in that blink and miss fashion.
Yeah.
And today again, the level was eluding us the entire day.
Yeah.
Finally, in the last 10 minutes or so, the Nifty made up its mind.
Absolutely. And, actually, the definition of a 3 p.m. move, because the market did nothing till 3 o'clock and then moved 90 points on the Nifty on your screen. And that basically, all of that, what you see is starting 3 o'clock. So just above 26,004 is what the final close looks like on the Nifty. The banks were doing better, even when the Nifty was not doing well. This is before 3 o'clock. So the banks index on your screen about 0.25% higher, 130 odd points in the green. So ICICI, HDFC Bank, Axis Bank, they were doing well. But you know what? The non-banks is what sort of also started to participate. Reliance was one reason why the market did well. But there were others as well, ITC and a few others which participated towards the end. And there was a pop which we finally saw. Market breadth was not very positive. About 1,600 stocks were lower compared to just under 1,200 stocks which were higher. But this was much worse in the middle of the afternoon, and that those lines not completely converging but getting closer as we closed out today's session. So that's the day. 26,000 is still an important kind of psychological round number, as we've been pointing out. The question is, is this just a pure expiry-related moves, or is there enough in the tank for this move to stretch for the next 2 days of this week as well? It's been a good week, and of course, it's been a good last 10 days where the Nifty Bank is also finally broken out of the previous high and is making fresh ones. Surbhi.
Absolutely. And just to add to some of the sectoral moves that you mentioned, Prashant, today, it was a little more selective in metals. While the sector is still really getting lots of attention because of the moves in China, what we saw was more select buying on some stocks like, Tata Steel on the front line or the Nalco name, which is beyond the Nifty. The other part of the market that fared fairly well was the PSU space, and we had some buying in real estate as well. Though PSUs, I should mention that PSU banks, the biggest one of them all, SBI, didn't really participate. But all in all, we did get that 26,000 close with some underperformance in the mid-cap part of the market. So let's get started because there's plenty to cover. Here's what the lineup on the show is looking like today. We'll get to all the key movers and shakers with Hormaz in just a bit. Now, in terms of individual stock action, Dabur is on our radar. Stock under pressure following a report from UBS, and we'll tell you what it said in a moment. Easy Trip Planner saw a big fall of 15 to 20% in trade today because of some large block trades. Power stocks rallied on the finalization of the new electricity plan. So all the details coming up in just a bit. Then, of course, we have D Street Chatter today with Nimesh, where he gets us all the buzz from dealing rooms and, of course, puts the spotlight specifically on KPR Mill and why that stock was buzzing. Finally, we'll wrap it up with the key events to watch tomorrow. But Hormaz, you kick it off first. Finally, a close above 26,000.
Oh, finally. And yes, it was a sleepy, snoozy sort of a day. Suddenly, in the last 30 minutes, we all came back to life, seeing the Nifty cross 26,000. Again, plenty of stock-specific activity. Can't not talk of Easy Trip. The stock, the block deal that happened, much more than what was anticipated. 16% lower as a result of that. The biggest single-day drop in 2 years. Can't not talk about IEX either. Battered yesterday, battered today as well. Another 4% down. Mind you, the stock is in the FNO ban. So no new positions here, but more unwinding taking place. So another 4% cut in today's session. Brokerages warning of earnings downgrade. On the flip side, power stocks did very well, barring IEX. Of course, our Power Grid was the top gainer on the index today after the new revamped national electricity plan, almost 9 lakh crore rupees there. UBS, you just mentioned about Dabur, the downgrade that came in from UBS. It was the top loser on the FMCG index, and barring ITC, it took along with it all the other FMCG stocks as well. Piramal Piramal Pharma was the other one. Optimistic commentary coming in from the management on the $2 billion company target and on the margins as well. Shows up in the stock price. Off the highs of the day, still 4% higher. Z Entertainment was the reason why the media index was up 3% in today's session. A content deal with Mukta Arts, a subsidiary is planning on raising funds, so positive triggers there, 6% higher for Z Entertainment. The stimulus in China has sparked some hope in metal stocks and has sparked some hope in HEG as well. Second straight day of gains today, 5.5% higher on the stock. Not so good going for Fusion Finance. Another day of losses today. The stock is now down 33% from its IPO price of 368 rupees. Profit booking also continuing in PB Fintech, and last week the stock had almost doubled from its IPO price, but now has cooled off almost 11% from those levels, another 6.5% shaved off today. And lastly, a surge seen in Saregama. That stock was the top volume-led gainer in today's session, 16% higher on the stock and the top gainer on the Nifty 500 as well. Back to you.
All right, Hormuz, thank you very much for that. Let's bring in our guest, Mayuresh Joshi of William O'Neill is with us, and so is Shrikant Chauhan of Kotak Securities. Gentlemen, good to have both of you here. That last 3 p.m. move, coming bolt out of the blue in that sense. Mayuresh, any thoughts? And very near term, what's the sense? Can this go on? I'm talking about very near term. I know a little unfair. We'll only be wiser in hindsight. But what's your sense? Because we are at these levels, and hence the question.
Absolutely, Prashant. No, I think the rally is continuing unabated. I think the flows are continuing. You've seen return of the FIs as well. And the momentum just continues for the market. So the momentum might very well continue for Indian markets in general. And generally, I think what we are reading through in terms of a lot of the other emerging markets, India surprisingly still remains one of the hottest destinations as far as FIs, FPIs are concerned. So yeah, I think the momentum might very well continue, Prashant.
Okay, all right. That is the view from Mayuresh. He's saying the momentum is likely to continue. Let's get in Shrikant as well. Shrikant, what do you say? So finally that milestone has been conquered, 26,000. Now the question is the market still good for more? Will you open long positions on the Nifty, Bank Nifty, or individual stocks, or all of them?
Yeah, good evening, Surabhi. Good evening, Prashant. Very clearly the market is following to the trend of correction and rotation, and whenever there is a correction we are seeing specific buying interest in the market. Even if we consider the open interest, then there also we are seeing gradual shift from 25,500 to 25,800. And today, when the market was very close to this 25,800 levels, from there all the way we saw the rally up to 26,000. So based on the entire setup of the market, I think it is like perfect, and it is very clearly showing us that after crossing the level of 26,000, now the next level to watch out for would be 26,500. Yes, in between, because of expiry, we may see some pressure close to 26,100, 150. But broadly, I am of the view that the market is heading higher. Bank Nifty is also supporting. There also we are seeing the levels of 54,500, 600 sort of levels. That means at least 500 to 600 points of rally from current levels. And Nifty IT today, there also we saw some buying interest in the second half. So broadly, I am of the view that these major components of the market, they are actually supporting to the entire trend. And if we follow the strategy of buy on dips, then I think index as well as stocks, we can trade in this market.
Shrikant, we'll get to our stories in a bit, but 1, 2, 3, top 3 trades right now, stock specific, without going into details.
Yeah, see, from the commodity space, I like Vedanta, which is currently trading around 480.81. The stock has spent almost 3 to 4 months in a triangle formation, and there was a spectacular rally from 200 levels to almost 500, and after that the stock has spent a lot of time. I think based on its technical formation, it is heading for the levels of at least 520, 530 sort of levels in next maybe few days or weeks. The other stock which we like is TCS. The reason is because the stock is very close to its support levels, and I'm of the view that now again Nifty IT will support the market in next few days. So it's a very decent buy at current levels with a very good risk-reward ratio. Here also I am expecting again 4,500 sort of level. And the stock which we like from the mid-cap space is FSL, First Source Limited, which is currently around 343, 345 levels. And there, if you see the pattern, then it is very interesting. It is actually changing its trading range, and based on its frequency and the high frequency sort of trades, this stock is also heading for the levels of at least 400. So these are the stocks on which we are focusing.
All right, so a couple of calls coming in over there on technicals. Let's quickly get to some of the stocks that were in focus today. First one is Dabur, down 4% after UBS came out with a note. They've downgraded the stock to a neutral. Vinny Motiwala is here with more details. Vinny, what is UBS's concern with Dabur?
So mainly the concern coming in for the downgrade this time is in terms of some sales risk in some of their segments. One of the segments is the juice segment and the other one is coconut oil, where they're seeing increased competition in both these segments. Now the potential risk that comes in for real juice is around 9 to 10% of the sales comes in from this segment. So yes, increased competition from soft drinks like colas, that is something that is a worry. We had seen Reliance that launched Campa Cola, which was at a much cheaper rate versus juices and other segments. So there's a bit of a pricing war there, which is causing a bit of a concern. Similarly, in the coconut oil segment, also Bajaj Consumers has actually made a foray into coconut oil, which also becomes a bit of a worry for Dabur, because they hold around 2 to 3% of their revenue comes in from this segment. So potential risk of all this, plus rural recovery is coming in, but that already seems to be priced in, is the highlight coming in from UBS. So after all of this, they think the valuations are still quite high, and because of this, they're cutting the EPS by 11% for Dabur. They believe that the beverage segment sales growth could be limited and a limited expansion in terms of margins. So that is why downgrade, neutral rating, target price of 700 rupees per share, and the stock closed at the day's lowest point.
Okay, got it. Vinny, thanks very much for that. So that explains the pressure on Dabur today. But one sector which didn't see any pressure was actually the power space. Stocks were in fact flying around on the finalization of the new national electricity plan. Let's go across to Vivek to understand what this really means for the sector and individual companies. Vivek, fill us in.
Well, that's right. It's something that we've been waiting for since February, ever since the government came out with the draft NEP. So yesterday, the Ministry of Power went ahead and issued the final NEP. We are still awaiting the finer details of this particular electricity plan. But most of the details that the market was looking for is now out in the open and in public domain. The total cost that is envisaged from 2023 to 2032 in the power space, especially a lot of capex lined up towards the transmission space, the total cost is at 9.15 lakh crore. The plan is aimed at meeting a peak demand of 458 gigawatt by 2032. And also, what are the key targets as far as the NEP is concerned? Number one, to meet the increasing electricity demand, to facilitate the renewable energy integration and green hydrogen loads into the grid. Also, what are the targets of the plan? Transmission network expansion is targeted. Transformation capacity, also expansion is targeted quite significantly. New lines of almost 33.25 gigawatt capacity is expected to be added. Interregional transfer capacity will increase from 119 to 168 gigawatt. And also transmission network of close to 335 gigawatt is being planned. Who are the key beneficiaries? When it comes to transmission, of course, Power Grid will be the key beneficiary, but also players along the value chain. So players like Hitachi, GE, T&D, Siemens, Skipper, KEC, all of these companies will also stand to benefit. Even cable and wire companies like KEI and APAR stand to benefit. Goldman Sachs wrote a note on this particular development. They believe Power Grid is the best place to capture this particular opportunity, given the large balance sheet as well as the low cost of debt.
Okay, got it, Vivek. Thanks for that. But stay on. We have one more stock we want to discuss with you. Before that, let me go to Mayuresh and get his sense. Mayuresh, power stocks. You just heard all the big targets that have been laid out in this plan. Would you be a buyer of anyone?
It remains a structural story, so we know two ways about it. But there has been a lot of price action for most stocks. Valuations also rather at the highest level in terms of the standard deviations over the last 5 years. Having said that, I think the kind of capex plans and the expectations in terms of renewables, around 500 gigawatts from 180 gigawatts over the next 10 years, will mean that the entire ecosystem, power producers, power transmitters, as well as the EPC players, all are going to benefit quite significantly, including power financiers as well. So to that extent, I think Power Grid remains a key beneficiary out of all the actions that the government will take. Tata Power, again, remains a key beneficiary from the power generator space. From the transmission space, largely, I think if you look at the EPC players as well, a lot of stocks like APAR have done really, really well. And they've got market expertise also in the renewables segment, along with Skipper, KEC, the transformer players. Power Mech also comes to mind in terms of not just the EPC contract, but also the O&M contracts that can probably come through. So yeah, I think space looks very, very interesting.
Absolutely. And the entire list of stocks on your screen, Ease My Trip is something we want to talk about as well on the other side, right? I mean, it fell a whopping 20% in early trade, touched its lowest levels since March of 2022. Vivek is back with us with a quick sense of what happened. There was a large block as well. Vivek, take it away.
Well, that's right. Last evening, we did highlight from our sources that we were anticipating quite a large block deal to take place as far as Easy Trip was concerned. Along expected lines, even in the pre-open session, we did see over 8.5% of total equity change hands. As per the term sheet that we had access to, the promoter Nishan Pitti was selling close to 8.5% stake at a 41.5 rupees a share. But after that, the share price did see a steep decline. Remember, Nishant held close to 28.13% stake at the end of Q1. But what happened after that was, even in the second half of the trading session and in the last hour, you did see a lot more block deals happen, a lot more of large trades that took place. And in fact, if you're looking at some of the agencies, they mentioned 14%. So quite almost 20% of total equity today has changed hands, and this has happened in a single trading session. Stock was under pressure throughout. At one point of time, it was at the lower circuit. It'll be interesting to see the disclosures. Once BSE and NSE put it out as to who exactly were the full sellers, and if there was a buying list, whether any of the buyers have bought more than 1% stake in the company. Only then it will be reported.
Okay, all right, got it. Thanks very much for that, Vivek. Let's quickly move on to a lot of the corporate commentary that we picked up today. First up, SpiceJet Chairman Ajay Singh is setting ambitious goals, focusing on driving profitable growth for the airline. He says the plan is to expand the fleet from 28 to 100 aircraft within the next 2 years. He also assured that outstanding dues will be significantly reduced and added that the market cap gap between SpiceJet and market leader Indigo will narrow.
Okay, well, that is SpiceJet for you. MCX is the other company that we spoke with. Lots of interest here. This is, of course, following the revision in transaction fee for both futures and options contracts. Effective October, management told us that transaction charges are pegged around average realizations and will not have a negative impact on earnings. They also added that the impact of interest on clearing funds, which has to be returned to the clearing members, also won't have any impact on the exchange itself. They told us that turnover on the exchange actually hit a new record high of 4.72 lakh crores on the 14th of September. They're pretty bullish on growth in both the futures and option segment for commodities.
Well, let's move on. Piramal Pharma aims to be a $2 billion pharma health and wellness company by 2030 with EBITDA margins at 25%. Additionally, the company is planning to reduce the debt to EBITDA ratio to 1 or even lower. The key focus of the company will be on innovation within the CDMO business.
All right, well, IIFL Finance is the other company which we spoke with. Remember, RBI recently allowed gold loans once again. They banned gold loans by IIFL back in the month of March. Now, the company told us they plan to gradually ramp up their gold business. When asked by when will they return to pre-ban levels in terms of the overall gold AUM, they told us it could happen in the next 6 to 12 months. They're also looking to diversify away from the over-dependence on gold and looking at segments like MSME in the medium to long run.
All right, and with that, it's time for a quick break. We'll be back with the D Street Chatter along with the key events to watch tomorrow in just a bit.
Other levels. So far as your question related to oil is concerned, that did not figure in the discussions today. As I said, this is the third meeting in between the leaders in the last 3 months or so. A lot of the issues have been discussed, but at this particular meeting, this particular subject was not discussed.
Okay, welcome back. It's time for D Street Chatter. Nimesh with all the insight in terms of what happened today. Nimesh, over to you. What are you picking up?
Hi, Prashant. In the last 30 minutes, I saw a big surge, and that actually helped the Nifty to again reclaim 26,000 level. But there were a lot of interest in the broader market stocks. The first stock is KPR Mills. The stock recovered sharply after a large block. Nearly 1 crore shares got changed hands. I understand the promoter entry was a seller, and some domestic mutual funds were buyers. The second stock is Dabur India, under pressure on back of very strong sell flows. Additionally, UBS has to downgrade the stock to a neutral, and they've raised concerns as far as earnings are concerned going forward. The third name was Tata Steel. For second, they're running very strong FI buying in Tata Steel. So there was delivery-based buying, and looks like the FI interest is back across metal names, and so is the case with Tata Steel. And the last is Equinox India, erstwhile India will real estate. After a long time, there was some block interest in Equinox India from larger FIs. So looks like some bit of interest is back at these levels from large institutions in Equinox India.
All right. Thanks very much for that, Nimesh. So plenty going around in the market today as well. Before we wrap, let's get you all the key events to watch out for tomorrow. Upasna is standing by with the list. Upasna.
Well, it looks like quite an eventful day tomorrow. Firstly, let us look at the global economic cues. US will be reporting its initial jobless claims, Q2 GDP data, followed by Fed Chair Jerome Powell's speech. ECB economic bulletin will also be out tomorrow, and Japan's monetary policy meeting minutes will also be released tomorrow. Back home, government aims to announce H2 borrowing calendar, an important event we'll be closely watching out for. Now let us look at the key stocks that we'll be closely watching out for on the back of the corporate action. Whole host of companies such as PVR Inox, Lemon Tree, Masgao Dock Shipbuilders, Wellspun Living and Gujarat Gas will be in focus as AGM of these companies are scheduled tomorrow. Indian Bank will also be in focus as the board will consider proposal regarding additional fundraising plan. Thangamay Jewellers will also be in focus as the board will consider fundraising, and Bodal Chemicals will also be in focus as the stock goes ex-dividend tomorrow. Various host of companies such as Hero MotoCorp, Apex Frozen Food, GMM Pfaudler, Tips Industries and Pratap Snacks will also be in focus as all these companies participate in Bharat Connect Conference Rising Star 2024 by Arihant Capital. And lastly, on the IPO front, Diffusion Engineers IPOs opens for subscription tomorrow. Hence, we'll be watching out for this as well.
All right. Fair bit to keep an eye out on as we come back tomorrow. Thanks very much, Upasna, for that. Well, it's a wrap on this edition of Markets Forward from all of us here. It's goodbye. Thank you for staying with us. More news and updates in just a bit.
News which just came out, a government-to-government deal between US and India to set up a semiconductor fab unit in the country.
Right.
There are elements of technology transfer, etc. That's the cutting edge semiconductor and plans to localize production. Right. I just wanted your thoughts.
Well, I think it's great. I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other. And I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have interest in. And the second is just, better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. Yeah. National security is being prioritized, as you said. Do you see this as part of that in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have, the twin of permitting. It's not going to work. So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead? Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do. Well, no,
it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. A late rally takes Nifty past 26,000 and Sensex ends above 85,000 for the first time. India's 10-year sovereign bond prices hit a 32-month as investors expect the RBI to turn dovish next month. The IPO Q grows longer. SEBI gives the green light to Hyundai Motor India's $3 billion IPO, which will be India's largest public issue to date. Swiggy's confidential $1.25 billion IPO filing also gets the regulator's nod.
My only request to all e-commerce companies is to go by the law, go by the letter and spirit of the law, and we are fine with it.
Commerce Minister Piyush Goyal says e-commerce companies will have to follow the law of the land if they want to thrive here. Adds quick commerce companies will have to work with Kirana stores for last mile delivery if they want to sustain in the long run. Rules out any proposal to allow Chinese investments via the automatic route. SpiceJet Chairman Ajay Singh attempts to allay concerns over the airline's future, promises to settle all outstanding dues and expand the fleet from 28 aircraft to 100 within 2 years, but the stock still drops over 6%. Zerodha's Nitin Kamath braces for a 40 to 60% revenue hit even as the stockbroker reports over 8,300 crores in revenues and 4,700 crores in profits, blames SEBI's new rules around trading in index derivatives and restrictions on discounts for future revenues coming under pressure. Voting across 26 seats in Phase 2 of the Jammu and Kashmir Assembly elections, 239 candidates, including former Chief Minister Umar Abdullah, who's contesting 2 seats, are in the fray. Voter turnout stands at 46% till 3 p.m. Israel launches fresh attacks in Lebanon after intercepting a missile fired by Hezbollah targeting the Mossad headquarters in Tel Aviv. More than 550 people have died across Lebanon as the new wave of Israeli attacks enters day 3. China says it test-fired an intercontinental ballistic missile in a rare acknowledgement that is likely to increase tensions in the region. Xu Hengpeng, a leading Chinese economist at a government think tank, has reportedly disappeared after making disparaging remarks on the economy and President Xi Jinping. Bharti Airtel turns to AI as it steps up its fight against spam calls and fraud, says its new AI tool can assess a call or SMS in 2 milliseconds and alert customers of suspicious calls and text messages. Adds that the solution will be free for its customers and will be activated automatically. 2/3 of world's children are not getting enough nutrients to grow and thrive, says Bill Gates. Calls for policy action to fight malnutrition on a war footing. Warns that nutritional deficits will lead to economic deficits too. That's a CNBC-TV18 exclusive. All right, let's start with the market action. A volatile session on the Wall Street. Sensex and Nifty hit record highs in early trade, which was followed by some profit taking. But a late rally lifted sentiments, with the Nifty ending above 26,000 for the first time. Sensex also ended above the 85,000 mark. Midcaps underperformed in trade. Gold prices hit a record high, boosted by a softer US dollar and hopes of more interest rate cuts from the US Federal Reserve. Safe haven demand triggered by rising tensions in the Middle East and hopes of a stimulus-led recovery in China also supported prices. Meanwhile, crude oil prices remained steady after rising in the previous session. This as excitement for the economic stimulus in China faded. On to the currency markets, where the rupee appreciated against the US dollar to close in on a keenly watched resistance level. This as the greenback struggled in the wake of the rally in the Chinese yuan and mounting expectations of further rate cuts from the US Federal Reserve. Meanwhile, India's 10-year sovereign bond price touched a fresh 32-month high, taking the yields to a low of 6.74%. Lata Venkatesh is here for more. Lata, tell us what caused the surge in bond prices.
Yes, it's been a damn good day for the bond markets. In fact, it's been a damn good few weeks and months for the bond markets. Now yield at a 32-month low. There is a combination of factors. One is that there is the increasing confidence that the Reserve Bank may turn dovish in the October 9th policy, probably even change stance from withdrawal of accommodation to neutral. That's because there's confidence that food inflation, which was the bugbear until now, will fall given the excellent monsoon. Of course, core inflation has been below 4% mark, the MPC target for the last 10 months. And crude is also around the $70 mark. The other reason why yields have been softening is both the Fed and the PBOC, that is the Chinese Central Bank, have announced larger than expected rate cuts. In addition, just yesterday, Nick Timiraos, who is a WSJ columnist and known to be very close to the Fed, was pointing to some very soft labor data. You know, the difference between plentiful jobs and hard to get jobs is declining. And people are reading it as an indication that the November cut may also be 50 basis from the Fed. All this is leading to an expectation that, Indian yields must also fall, and that the Reserve Bank will be soft. And of course, the second half borrowing program, which is going to be announced, some people believe that it may be lower than the 6.53 lakh crore because the government has good tax collections and slightly lower expenses.
Right, thank you, Lata, for that. The IPO Q is growing longer. Market regulator SEBI has given the green signal to Hyundai Motor India's $3 billion IPO, expected to be India's largest ever. Hyundai Motor India is planning to launch its IPO in October. As per reports, the IPO would solely be an offer for sale, with the parent company likely to sell 17.5% stake. SEBI also gave Swiggy's confidential $1.25 billion IPO filing a go-ahead. The IPO would be a mix of offer for sale and fresh issue. In more market news, shares of SpiceJet declined below the QIP price of 64 rupees a share. Remember, the company said it received an overwhelming response from prominent investors for the 3,000 crore QIP. Ajay Singh, the chairman and managing director of the airline, told CNBC-TV18 that the proceeds from the fundraise are sufficient to support the airline's revival for many years. He promised to clear statutory dues in the next few weeks and expects the fleet size to grow from 28 to 100 planes in the next 2 years.
In our view, this money is more than sufficient to fund our business plan for several years to come. We are in this process of reviving the airline. We are currently roughly in the same position that we were in 2015. And the plan, just like in 2015, is to expand quickly. We are flying about 28 aircraft, and the idea is to get to 100 aircraft over the next 2 years.
So by when do you get back to 5,000 flights? You were doing that earlier this year. I think that number has come down to sub 3,000. How soon can you get back to that run rate?
Well, our plan is to get up to close to 40 aircraft by the end of this financial year, and to get up to close to 80 aircraft by the end of the following financial year. So we will stick with that plan, and I think that you will see that 5,000 flight number in the not too distant future.
Let's talk about market share. Market share has been sliding from around 6% in maybe November 2023. You have come down to sub 2.5%. Where do you see this number go to, Mr. Singh?
So, I don't want to give you market size numbers. I don't want to give you market share numbers. We need to add planes in a market that clearly can absorb much more capacity. We will do that at the fastest pace that we can, and we will do it in a profitable manner.
Prior to this particular issue coming out, the presentation that you have put on the stock exchanges indicates that you have some outstanding dues of around 3,700 crores and roughly around 600 crores odd statutory dues. What do these numbers come down to?
Of course, the statutory dues will be paid in full. In terms of lessor dues, we are in constant dialogue with them, and we are finding settlements with all of them. We've already found settlements with some of our largest lessors, and that 3,700 crore number will come down significantly.
E-commerce companies will have to follow the law of the land. That's the word from Union Commerce Minister Piyush Goyal. Speaking to Parikshit Luthra, Goyal emphasized that quick commerce companies will have to work with kirana stores for last mile delivery if they want to sustain in the long run. Further, Goyal also said that there is no proposal to allow Chinese investments via the automatic route. Take a look.
We will continue to look at different sectors to see where we can give that competitive edge through any support that may be required. You will recall that after the initial PLI schemes, we came out with the semiconductor mission and the additional support for the semiconductor industry. We are currently assessing different sectors, and if at all it is required to support any particular sector, I think the government will not be found wanting. Well, I think largely quick commerce will have to have the local kirana store, the corner store, the small retailer for last mile delivery if they want to sustain in the long run and not make losses. My only request to all e-commerce companies is to go by the law, go by the letter and spirit of the law, and we are fine with it. We want to encourage technology, we want to encourage modern trade, but not at the cost of the small retailers.
Countries and companies have been saying for the last 5 years that India's time has definitely come. But considering our disturbed relationship with China, would you consider, Minister Goyal, any changes in our policy vis-a-vis China in terms of allowing investments in manufacturing via the automatic route?
There's no such proposal at all. And we have a framework in place for any Chinese investments, and they will continue to have to go through that framework.
All right, speaking of China, the country has test-fired an intercontinental ballistic missile. The rare acknowledgement by China is likely to increase tensions in the region. According to China, the long-range missile was carrying a dummy warhead and fell into the Pacific Ocean. China did not specify the exact location, though. A top Chinese economist has reportedly disappeared after criticizing the country's economic policy and President Xi Jinping. According to the Wall Street Journal, 55-year-old Xu Hengpeng, who was working with the Chinese government think tank, was detained in April for the comments he made in a private WeChat group. India's External Affairs Minister Jaishankar said the relationship between India and China is significantly disturbed. Last week, Jaishankar said 75% of the disengagement issues with China have been resolved. Now, Jaishankar asserted that he was specifically talking about the disengagement process, and the overall relationship with China remains strained.
Right now, both sides have troops who are deployed forward. And when I said 75% of it has been sorted out, I was asked in a way to quantify it, to give a sense. It's only of the disengagement. So that's one part of the problem. And the main issue right now is the patrolling. Once we deal with the disengagement, there is the larger issue, which is both of us have brought very large number of troops up to the border. So there is what we call the de-escalation issue. Then there is the next step is really how do you deal with the rest of the relationship, because right now the relationship is very significantly disturbed.
All right, time for a short break, but coming up next, voting across 26 seats in the phase 2 of Jammu and Kashmir Assembly elections is underway. 239 candidates, including former Chief Minister Omar Abdullah, who's contesting 2 seats, are in the fray. More details when we return.
taking over the economy. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
US has been trying to reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation will look at it and say, we can't rely on someone who might one day be an adversary, that doesn't make them an adversary today, for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like, you know, if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, you know, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. This semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got US elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that? I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America now. So that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about, you know, disconnecting.
You know, they say that the proof lies in the pudding, but this SEBI study is neither the proof nor the pudding that many F&O traders would want to see, read or hear. Now, 1.8 lakh crore rupees. Now, that is the cumulative loss made by individual traders within the F&O segment between FY22 and FY24. That's the big number from this latest.
Welcome back. Bharti Airtel has launched what it claims is India's first artificial intelligence powered tool to alert customers about suspected spam calls and text messages accurately. The company has said that this tool will be able to assess a call or SMS in 2 milliseconds.
What our solution does is actually uses over 250 parameters on a real-time basis across every single call and every message on our network, which is roughly 1.5 billion SMSs, 2.5 billion calls, and alerts the customer if it's a spam, suspected spam. We have seen tremendous power in this in the last 6 months. It's an AI model which is constantly learning. We've seen a 97% right identification of spam calls, 99.5% right identification of spam messages. So we're very excited that this will really put power back in the hands of the user.
Maruti Suzuki chairman R.C. Bhargava has said that the attitude of certain promoters who are reluctant to invest in their company's growth is hurting the Indian manufacturing story. Speaking exclusively to CNBC-TV18's Parikshit Luthra, he added that promoters are more concerned with private wealth creation.
If I were to ask you one thing which is actually holding back growth, what would that be?
I think it's the attitude of a lot of promoters who are reluctant to adopt growth of their companies and to do what is required for the growth of that magnitude to take place, and are more concerned with their private wealth creation and their quality of life and improving their assets and buying houses and airplanes and such things. I think more and more money must be retained in the company and invested in growth.
The big national story we are tracking: 26 assembly seats across 6 districts went to polls in phase 2 of Jammu and Kashmir assembly elections today. Voter turnout till 3 p.m. had been reported at just over 46%. The first phase had seen a healthy voter turnout of over 60%. This phase will decide the fate of 239 candidates. Former Chief Minister Omar Abdullah is contesting from Gandarbal and Budgam. A group of diplomats from 16 foreign missions were in Srinagar to observe the voting. Omar Abdullah said they were guided tourists. My colleague Esha Anwani decodes the key battleground constituencies from Gandarbal, the Abdullah family stronghold.
The polling in the second phase of J&K Assembly elections is on, and there is brisk voting that is taking place across all the districts of Jammu and Kashmir. In Kashmir, there's a strong competition between Omar Abdullah and Bashir Mir of the PDP, while the National Conference is in alliance with the Congress and are trying to get maximum seats out of them, out of the seats which are going to polls today. More than 25 lakh voters are deciding the fate of these candidates. Now, the highest candidates are in Habakadal constituency. What we also know is that the BJP is aiming to gain maximum out of the Jammu region, and they are trying their level best to get seats in Srinagar constituency as well, so that they can be in a position to form any government independently. While National Conference and Congress is trying to ensure that they win maximum and their coalition is able to win all the seats, at least those till they can show the majority mark. But the BJP believes that they are in a better position, and whether or not that stands true or holds true, one has to wait and see. But now, for now, the voting is going on. People are queuing up outside voting stations and casting their votes. The voting is taking place in the higher reaches as well, with the mountainous areas. We also have a delegation of foreign countries, diplomats from Delhi visiting Kashmir to get a first-hand account of the situation that is unfolding on the ground. And the government is trying to showcase how democracy is flourishing on the ground in Jammu and Kashmir.
The Supreme Court has accepted Karnataka High Court Judge Justice Srishananda's apology for referring to a locality in Bengaluru as Pakistan during a case hearing. The Apex Court also cautioned that judges should exercise restraint in language and conduct. The CJI-led 5-judge bench urged courts across the country to be careful not to make comments which may be construed as being misogynistic or prejudicial to any segment of our society. The Bombay High Court has expressed skepticism over the Maharashtra Police's version of the custodial death of Akshay Shinde, an accused in the Badlapur sexual assault case. As per the police, the accused allegedly seized an officer's revolver and opened fire while he was being transferred from Taloja jail to Thane crime branch. The police said that cops had to shoot him in self-defense. The court called for an impartial and fair probe into the death of the accused. In global news, tensions in West Asia continue to rise as Israel continues to attack southern Lebanon. Iran-backed militia group Hezbollah has confirmed the death of a commander. This has come as after Israeli military claimed that they killed him in a strike, along with 6 more people in a fresh attack. Hezbollah has said that the group has fired a ballistic missile targeting Mossad's headquarters near Tel Aviv. Thousands of people have fled southern Lebanon, and the death toll in the country has risen to 569, including 50 children. Meanwhile, Israel's defense minister has said that Hezbollah has suffered severe blows and Israel is ready to strike further if provoked. At least 53 people have been killed across Gaza over the past 24 hours. The UN has urged the Israeli military to stop attacking schools that provide the last shelter to Palestinians. This has come after Israeli forces killed 32 Palestinians in 3 attacks on Gaza schools over the past few days. From one war-torn nation to another, Ukrainian President Zelensky has told the United Nations Security Council that negotiations will not be enough to end the war in Ukraine. He added that Russia needs to be forced into peace. In his address, Zelensky said Russian President Putin is committing an international crime and will not stop this war on Ukraine on his own.
Putin has broken so many international norms and rules that he won't stop on his own. Russia can only be forced into peace. And that is exactly what's needed. forcing Russia into peace as the sole aggressor in this war, the sole violator of the UN Charter. Our Ukrainian right to self-defense must prevail.
All right, on to a CNBC-TV18 exclusive. 2/3 of world's children are not getting enough nutrients to grow and thrive. That's the word coming in from Bill Gates. Speaking to Shireen Bhan, Gates has called for policy action to fight malnutrition on a war footing. He has also warned that nutritional deficits will lead to economic deficits too.
You said that if you had a magic wand, the one issue that you would like to solve is the issue of malnutrition. And I think people don't understand fully or don't relate the economic implications and the economic impact of that. You know, walk us through what you believe governments need to focus on as the economic implications of malnutrition.
Yeah, malnutrition actually is not very well known. A lot of people, when you say that term, they think of hunger. And of course, if you have a complete food shortage, you are malnourished. But even kids where there's a reasonable amount of food, because their diet doesn't include all the right things, their stomach, their gut, can get into an inflamed state, and then they don't develop either their brain or their body. And there are over 200 million kids that have severe forms of malnutrition. And the insight that by reducing that, more kids, not only will they survive, but that they'll thrive, they'll do well in education and give back to their family and their country. The data on that's gotten so strong that we've been upping this as a priority, starting with our microbiome work about 10 years ago. And now we have some very low-cost initiatives, food fortification, vitamins for pregnant mothers, and bringing down the cost of very nutritious foods, including eggs and milk. And so at the Goalkeepers, we're saying, let's go do those things. And we'll also mention the ongoing research, not ready yet, but things like giving a probiotic to kids. We have a trial out that we could add that if it turns out to work as well as we hope.
And with that, it's a wrap of this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Now, a study that the market regulator released last year said that 89% FNO traders lose money. Now, that number remains where it is, as 9 out of 10 individual traders in the FNO segment continue to incur quote-unquote significant losses. Now, let's tell you more about those significant losses. Including transaction cost, the average loss of over 93% or over 1 crore individual traders stood at 2 lakh rupees each. If that is not enough, the top loss-making traders raised the bar higher. The top 3.5 loss-making traders averaged a loss of 28 lakh rupees per person, of course, including transaction costs. Again, all of these figures between FY22 and FY24. So does anybody make a profit? Absolutely. A staggering 1% of the traders in the FNO segment made a profit over the last 3 financial years. And if there ever was a gulf between domestic and foreign traders, the upcoming graphic will show you that. Proprietary traders made a profit of 33,000 crores in FY24 before adjusting for transaction costs. FPIs made a profit of 28,000 crore, and putting these two numbers together, the individual traders made a loss of over 61,000 crore rupees in FY24. So how did these traders manage the profit? Now, most of these are generated by larger entities using algorithms. 96% of proprietary profits and 97% of FPI profits are generated through these algorithms, according to the SEBI study. Now, if you wondered that the SEBI study from last year would act as any deterrent to youngsters from venturing into this unknown territory, that has definitely not been the case. The number of traders below the age of 30 within this segment has now risen to 43% from 31% in FY23, and 72% of the total trader base is beyond the top 30 cities of the country. Shows you the extent of the FNO penetration in India. Now, if there would be a study that proves FNO penetration being faster than insurance, don't be surprised. We spoke to you about the losses that individual traders made that ran into lakhs of rupees. 75% of those traders had an annual income of less than 5 lakh rupees. And I'll end with possibly what is the highlight of this report, and nothing better can describe this than a famous Hindi film dialogue, and I quote, "रोज आते हैं इस उम्मीद में, आज जीतेंगे, कल जीतेंगे, परसों जीतेंगे और रोज हारते हैं." Now, why do I say so? Because despite making losses for years, 75% of these F&O traders continue to trade as per this SEBI study. So there you have it. Foreign algo trades making money in F&O while the individual retail investor continues to struggle. Of course, what people do with their money is an individual choice, but these stats would definitely.
Let's talk money.
Hello and welcome to another brand new edition of Let's Talk Money with me, Surabhi Upadhyay. Interesting subject at hand today. Hybrid funds offer a way of taking care of the asset allocation part of our portfolio planning. That's one less decision to then keep in mind. Now, there is a whole host of these funds. Some have well over 65% in equity. Some are mostly investing in debt. And some of these funds also invest in commodities. So how do we know which hybrid fund is right for us? Today on the show, we will be discussing all of these different hybrid categories, the tax calculations involved, and the suitability of investment for different age groups, different risk profiles. Our guests on the show today are Dinesh Balachandran of SBI Mutual Fund, as well as Shyam Sundar of Peak Alpha Investments. Gentlemen, thank you so much for joining in. Great to have you on. I really want to keep this as simple as possible, because the problem with hybrids is that, it has so many other subcategories under it that it can leave the investor a bit confused. So let's ask ourselves the most basic question. Why should we look at hybrid funds when we can play equity via pure equity funds and debt via debt funds? So, Dinesh, let me, set the ball rolling with you first.
Great. First of all, thanks for having me over. Now, when I think about hybrid funds, I think one basic requirement for hybrid funds is the fact that when people think about equities, they understand that equities represent one of the best ways to generate wealth over a long-term time frame. But there are many risk-conscious investors who really worry about the drawdowns. So, for example, the moment, let's assume the portfolio goes down by 10-15%, a lot of people really get scared, right? And that thought itself prevents them from being actively involved in the equity markets. This is where something like a hybrid fund really comes into the picture, because you are targeting these risk-conscious investors, where you are telling them that instead of keeping all your money in fixed deposits, why don't you invest in a hybrid fund which has a combination of equity and some other asset class? Normally, it's fixed income. The combination of these asset classes leads to a return profile which is much more comfortable for these kind of investors, where the drawdowns are going to be much lower. You can't completely eliminate drawdowns, but definitely it's going to be lower in magnitude. And it makes you sort of sleep more peacefully at night. And from that perspective, I think hybrid funds, I think the industry has done a good job in terms of catering to these kind of risk-conscious investors, in my opinion. Also, when I think about people who already have investments in pure equity funds or a combination of equity funds and debt funds, the biggest advantage there for hybrid fund is that, one, when you try to balance dynamically between equities and fixed income, as an individual investor, the tax hit that you're going to take is much higher.
Because you'll have to sell down your equity fund.
You'll have to sell either equity or fixed
debt,
income.
and then buy another fund.
Right. So the tax hit is much higher, right? On the other hand, when you are essentially putting your money in a hybrid fund, and assuming that the fund manager actually does a good job, the allocation becomes sort of like quite dynamic in nature. And normally, fund managers have a prudent approach in terms of how they want to sort of keep dynamically allocating between equity and fixed income. That way, you don't take the tax hit, and your portfolio is being sort of dynamically managed. So that is definitely a benefit for a lot of investors.
I think the second part of what you said is something people will immediately understand, because nobody wants to pay additional tax, right? It's the first part that should be our first sort of thought when it comes to the portfolio. That, I think, is coming under question, because who is thinking of drawdowns these days, right? Let me take that question actually to Shyam. Shyam, you tell us, you interact with so many clients, right? The market has gone just one way in the last couple of years. So are people really asking themselves that risk question? Is my portfolio geared to take in a 15% drop?
When people see markets like the one that we are in right now, there's a level of greed that kicks in. And at those levels of greed, essentially, they would like to put in more money in addition to what they already have in equities in the portfolio. Compare that with what happened in 2020, and when the markets really fell quite sharply, people would like to take money off the table. So if you ask any investor what they would like to achieve, they'd say, I would like to achieve a behavior of buy low, sell high. But actually what ends up happening is that they end up buying high and selling low because of these emotional factors. And I think that's the role that a hybrid fund can play in a customer's portfolio very well, because it protects them against this instinct of buying high and selling low, because the fund automatically rebalances within itself. Yeah. And as a result of that, that part of the portfolio, you're able to protect against the customer's most adverse instincts, if you like.
No, absolutely.
So yes, with the market being at the kind of levels that it has been for the last couple of years, some concern is there, but I would say that more than that is the desire to participate and the fear of missing out. And that's where we like to position hybrid funds from that perspective.
Yeah, absolutely, Shyam. Valid points over there. I mean, these are the behavioral aspects that maybe, a product like hybrid funds can guard us against our own sort of behavioral idiosyncrasies. So let's talk about now how to go about it and the categories. Let's just understand the range of funds which are under this broad head of hybrid. And Dinesh, help us out over here, because like I said, that you have some funds which are going up to 60-70% equity, some are as low as 30% equity, and then there is an in-between category. So just at an industry level, how do you guys categorize this?
So normally we group hybrid funds into three main categories. The first category is hybrid fund where the equity allocation is greater than 65%. The second category, or the middle category, is one where the equity allocation is between 35% and 65%. And the third category is one where equity allocation is less than 35%.
Okay.
That's the categorization from a broad perspective. If you want to think about the nuances within each category, greater than 65% is meant for people with higher risk profiles, where essentially they are willing to take higher risk bets, but they are not fully comfortable going to 100% equity.
Okay.
So this 65% equity is for that kind of investor base, where over a long-term time frame, you are supposed to generate pretty good returns, essentially.
And because these funds end up maintaining at least 65% equity, if not more, they also get equity taxation,
Yes, so that's the other key aspect of it, that these funds have an equity taxation, which definitely is a plus in the current landscape.
And the sort of funds, if we talk about the names of the subcategories that fall under this, would be?
So these funds are called equity hybrid funds.
Okay.
So the first category is normally equity hybrid funds. The second category essentially has three types of hybrid funds, where it can either be a balanced advantage fund, or an equity savings fund, or a multi-asset allocation fund.
But wait, if you go back to the first category, there's also something known as aggressive hybrid. So Shyam, come in on this as well, because I know that you like this category, the aggressive hybrid category. So is it the same thing? These are funds maintaining more than 65% equity, which is why they're called aggressive hybrid?
Yes, that's absolutely right. So if you think about the aggressive hybrid funds, they are required to maintain greater than 65% of their portfolio in equity. The reason, there is another category of fund that is quite comparable to it, which is the balanced advantage fund. In that both of them are, in our opinion, slightly more aggressive funds, like Dinesh said. I'll just talk about the difference between these two categories, but these, along with the arbitrage, tend to be the most popular categories. They have the highest AUM with them today. But the difference really between the aggressive hybrid funds and the balanced advantage funds, which I think people can think about in comparison, is that the aggressive hybrid fund is a simple category. There's only equity which is greater than 65%, and the remainder tends to be in debt. The reason this is simple and attractive is because you know kind of what you're getting. With a balanced advantage fund, it's quite an innovative and new category in which what you tend to see is the combination of the use of arbitrage as well. So while equity taxation mandates that you have 65% or greater in equity, a clever usage of arbitrage in these funds enables the fund manager to decide, given the current market valuations, what is the appropriate level of equity they should have. So let us say we are in a situation right now where people feel like the valuations are starting to feel a little stretched. So the aggressive hybrid fund manager does have no option except to remain invested to at least 65% in equity. Whereas if you have a balanced advantage fund, what you end up having there is maybe 50% of straight equity and the remainder being made up using arbitrage. So the net equity level can be below 50%. But the gross equity will still be greater than 65.
So basically,
in essence, you retain the equity taxation, but you have a safer portfolio compared to an aggressive hybrid fund.
Got that. And, that perhaps makes it one of the most popular categories. I want to put up the stats, the numbers again. I think we had them on a while earlier as well. If you look at hybrid funds as a whole, it is the balanced advantage category, which has the greatest AUM as per latest industry data, AMFI data. This category, the total AUM is almost now touching 3 lakh crores, 2.85 to be more precise, but it is the most popular and the largest category within hybrid funds. And also, remember, balanced advantage funds are that second category that Dinesh you spoke about, right? Which basically run portfolios that could have equity between 35% going up to 65%, right? So what is your thought about a BAF, and which are the other funds in this in-between category?
Right. So balanced advantage fund, as Shyam mentioned, it ticks all the boxes that you're looking for in a hybrid fund, right? One, where you have a combination of equity and fixed income. Two, you have equity taxation. Three, the asset allocation is being dynamically managed, which means that when markets are overheated, you will have lower directional equity allocation, and when markets are attractive, you will have higher equity allocation, right? And no wonder it is the most popular hybrid fund category. For us, when we compare balanced advantage with the equity hybrid or an aggressive hybrid category, balanced advantage scores from a risk profile perspective. It tends to have better risk profile than equity hybrid. The other two categories in this middle sort of bucket are the equity savings funds and the multi-asset allocation fund. In the case of equity savings, you are categorically saying that the equity allocation is going to be in that 35% range, more or less. It will be between 35 and 45% for the most part, right? So it tends to have a sort of lower risk profile compared to a balanced advantage fund or an equity hybrid fund, but it also enjoys equity taxation because again, you use arbitrage to get to that 65% level essentially. That's the equity savings fund. The third fund, which I find it to be very interesting, is the multi-asset allocation fund. Because here you're not restricting yourself to just equity and fixed income. You're saying that there is a third asset class out there, basically precious metals or commodities, which tend to have very different behavioral characteristics compared to both equity and fixed income. So when you add that to the mix, I think it definitely offers diversification benefit in the base case scenario. And it can also provide superior returns in certain environments. So that's the third sort of category, multi-asset allocation
which fund. You can look at. And finally, the third broad category is funds that have less than 35%, and they're treated like debt funds from a tax point of view,
yes,
right?
So the conservative hybrid funds or the debt hybrid funds, as we call it, they tend to have less than 35% equity, and the taxation is essentially very similar to what we have for pure debt mutual funds, essentially.
Got it. So now we have understood all the different categories of hybrid funds and what kind of portfolios they run. The question is, how do you decide what's right for you? We answer that after the break.
Let's talk money.
Bells ringing for sure.
Let's talk money.
Welcome back. You are with us on Let's Talk Money, and this week we are trying to figure out how to make the best use of hybrid funds to provide very well-informed asset allocation to the portfolio and also keep your portfolio fairly tax efficient. So let's keep the conversation going. I have a question for Shyam, because Shyam just told us that he actually likes the balanced advantage fund category quite a bit. But Shyam, my question really is this, that maybe different AMCs will have a different algorithm or a different formula or a different model that BAFs follow. So, how do you know which one is the best? And, since we're on the subject, if you could tell us any 1 or 2 or 3 balanced advantage funds that you like. Sure.
The new element that comes in with the balanced advantage fund is this model. And when you have the model in place, then it is possible that the model might get it fantastically right, but it's also possible that the model may get it wrong. So if I look across the fund houses, I think the one fund house that has been an exception to the pattern has been HDFC, where their balanced advantage fund has reasonably consistently done better than their aggressive hybrid fund. But apart from that, as I look across fund houses, I find that more often than not, the aggressive hybrid fund has done better than the balanced advantage fund. So if I look at ICICI, for instance, or Edelweiss, for instance, their aggressive hybrid funds have done better than their balanced advantage funds. Whereas if I look at the 5-year returns with HDFC's balanced advantage fund has done better than their aggressive hybrid fund. So I think it's worth keeping in mind that conceptually, the balanced advantage fund has the ability to time the market better than an aggressive hybrid fund, in that they can reduce their equity exposure quite meaningfully if they feel that that is an appropriate strategy. But what we've seen in the last 5 years in terms of the performance itself is that the aggressive hybrid funds have done better than balanced advantage funds in most fund houses.
Okay, fair enough. Dinesh, come in on this. So for someone who is young, who will primarily have a bulk of their portfolio in, let's say, pure equity funds, but for whatever reason wants to look at one of these 2 options, either the equity hybrid fund or the aggressive hybrid fund, as it's also known, or opt for a BAF in order not to get too carried away and too swayed by, rising equity markets. What should the choice be between these 2 categories? Both have equity taxation, right?
Yes.
So how do you decide what's better?
Right. So particularly for someone who has already a significant amount of equity exposure and is looking to sort of diversify away from that, I would recommend balanced advantage fund. With the simple reason being that from a drawdown perspective, you will always find balanced advantage funds having a much better drawdown profile compared to an equity hybrid fund. Yes, aggressive hybrid funds deliver better returns. But then when markets go down, they are also likely to sort of have bigger drawdowns. And this is the basic premise of a balanced advantage fund, that when it comes to drawdowns, you should have much better drawdown profile. So for an investor like that, I would definitely recommend a balanced advantage fund, or a third fund, which would be essentially a multi-asset allocation fund.
Because where you also bring in an element of commodities.
Commodities. And I think my personal belief is in this decade, inflation expectations, stagflation, these are phrases that are likely to become more popular. And in that kind of paradigm, in that kind of regime, it is important to have that diversification that commodities essentially bring into the table.
And let's also talk about realistic return expectations. So, there's aggressive hybrid, there is balanced advantage, and there is the multi-asset category. Taxation-wise, all 3 are more or less equal, because these funds, the strategies will ensure that you get equity taxation. In terms of return profile, what's the range? What should investors realistically keep in mind?
The way I think about it, low double-digit returns should be the basic sort of return profile over a long-term time frame.
For all 3, aggressive, hybrid, BAF, as well as multi-asset.
The key is really in terms of the downside aspect, where, as I said, an aggressive hybrid might actually give you slightly better returns, but particularly when I try to adjust the downside aspect, then essentially they all sort of fall in line. And in my opinion, the question that an investor has to ask is, what kind of person am I? Am I someone who gets troubled by a 10% drawdown or not? If a person is like that, then automatically you have to sort of veer towards the more conservative hybrid funds. On the other hand, someone is saying that I really am trying to sort of maximize returns within a certain constraint. Then obviously equity hybrid would be or the aggressive hybrid would be the right choice, essentially.
Fair enough. Okay, so now let's actually talk about that conservative investor, because not everybody is comfortable taking a lot of equity risk. And you do want to have a fair amount of fixed income exposure in your portfolio as well. So again, gentlemen, here let's go back to a category. So you can be in category B, but be with funds which have slightly lower equity exposure and they don't have equity taxation, but you want to sleep peacefully at night, so you're okay to pay more tax. And then there is the last category where the equity allocation is even below 35%. So here, which are the fund categories that you would recommend for such a low risk investor, Shyam?
I think one of the categories that has become quite popular now is the equity savings category, because again, through the clever use of arbitrage, they've been able to maintain equity taxation and yet maintain fairly conservative portfolios where the net equity exposure tends to be 30% or even less in some cases. So we really like this category because, like you said at the beginning, Surabhi, everybody wants to pay lesser taxes if they can. So from that perspective, if you have a conservative investor who wants to maintain fairly conservative funds in their portfolio, then rather than having straight debt funds in the portfolio, the equity savings funds have become quite an attractive category. And that's principally because of this tax advantage that they have, where through the clever use of arbitrage, they're able to maintain very conservative, safe portfolios and yet enjoy equity taxation. So we feel that this is a category that is likely to continue to become quite popular in the days ahead, the equity savings fund category. And just like Dinesh was saying, the very comparable thing to that is the multi-asset funds as well, because you do get the additional correlation benefit, which is when equities go down, gold or other commodities have a history of doing quite well. So you tend to get a better outcome as a result of that. So it is starting to become quite difficult to make a case for a straight debt fund compared to a fund like an equity savings fund because of this tax advantage it enjoys.
Fair enough. Dinesh, comment on this. Again, I'm talking about the profile of a person who's either retired or approaching retirement, definitely wants better than FD tax-efficient returns.
Right.
What's the kind of fund they should look at?
Yeah, so there are two options. One is the equity savings fund that Shyam just spoke about. The other one would be the conservative hybrid fund or the debt hybrid fund that we, as we call it. So there, again, the only issue is the taxation is one-off fixed income taxation.
For the conservative hybrid?
It's a marginal tax rate, yeah,
right.
for conservative hybrid fund. Yeah. So now, depending on the tax bracket that an individual falls into, that can be a big concern, or maybe it's not as much of a concern.
Yeah.
The advantage is that the conservative hybrid fund or the debt hybrid fund essentially will have equity allocation normally in the 25% range.
Okay.
Which means that, again, from a sleep well at night kind of perspective, it is a very apt fund for such investors essentially. So either that or the equity savings fund that Shyam spoke about, because that also tends to be a very conservative fund in general.
Okay, great. I think this is really, really helpful. So as we wind down, gentlemen, let's just recap the things that we investors need to really ask ourselves when we are looking to invest in a hybrid fund. Dinesh, to sum it up, why do you need it and what should we ask ourselves before deciding which one?
Yeah, the number one question is diversification, whether you want diversification and the benefits that it provides. Equities represent the best ways to generate wealth over longer time frame, but it comes with drawdown risks. So a hybrid fund helps from that perspective. So when you think about risk reward, hybrid funds definitely add something to the equation. Two, from a taxation perspective, when someone has investments in FD, I think on a post-tax basis, you can easily get better returns in a hybrid fund. And from that perspective, it's actually, in my opinion, sort of a surefire thing that you are better off in a hybrid fund compared to FDs for the most part, essentially.
And Shyam, 30 seconds left on the conversation. Things to ask before picking the right hybrid fund.
I think one of the things that an investor needs to be careful about a hybrid fund is making sure they know what they're getting. So it's important to look carefully at the equity part of the portfolio. Is it large cap? Is it mid cap? Is it growth? Is it value? What kind of portfolio is held within equity? And exactly the same question to ask also about the debt part of the portfolio. Is it long duration, medium duration, short duration? Is it a high credit quality portfolio? Is it a AAA or a AA? What is that? So it's important to look a little bit more carefully about the constituents of the portfolio. But apart from that, for the tax advantages it brings and the automatic behavioral adjustment, I think this category, the hybrid funds category, has a pretty important role to play in customers' portfolios.
All right. Thank you very much, gentlemen. I think this is a lot of food for thought and a lot of very sensible advice as well, right? Why not look at a more tax-efficient way of managing our portfolios? Thank you for joining in and giving us all the insights. Sham as well as Dinesh. Good to have you on the show.
Thank you. Thanks so much for having me.
All right. Well, with that, it is curtains on this edition of Let's Talk Money. Thank you for tuning in. And remember, keep sending us your feedback, comments, queries, and questions. See you again next week.
Let's talk money.
आज भारत का 5G मार्केट बताऊं, बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। आप हैरान होंगे, आज भारत का 5G मार्केट बताऊं, बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। और ये 2 साल के भीतर भीतर हुआ है। अब तो भारत मेड इन इंडिया 6G पर काम कर रहा है। ये कैसे हुआ? ये इसलिए हुआ।
Hello and welcome to this special show. It's 10 years of Make in India program. 25th September 2014 was when Prime Minister Modi had launched Make in India with a plan to localize manufacturing and make India a manufacturing hub for the world. Today, India is playing a big role in supply chains and in a resilient supply chain globally. But what next from the Indian government in terms of reforms, the policy push to encourage manufacturing and exports? Joining us right now to talk about this all is Union Minister for Commerce, Piyush Goyal. Minister Goyal, thank you very much for speaking to CNBC-TV18. Let me begin by asking you about the biggest wins that you consider from the Make in India program and the biggest lessons.
Well, I think it's a momentous day that we are celebrating 10 years of Make in India, a program that Prime Minister Narendra Modi had initiated to reinvigorate job creation and give an impetus to the economy. You're well aware that we had inherited a very fragile economy. The mood was down. Investors were not looking at India as a favored destination, whether domestic or international. And with a high inflation, low growth rates, high interest rates, foreign currency exchange reserves being down, and also an unstable rupee, with corruption scandals all over the place tumbling out of the closet, we found manufacturing to be a terribly neglected sector. When Prime Minister Modi first talked about making in India and growing the economy through manufacturing, many people found it very difficult to believe. I think during the 10 years under his visionary leadership, we have been able to introduce several new initiatives, whether it is the production-linked incentive program to support very critical sectors to grow, the semiconductor mission, our focus on ease of doing business, our effort to decriminalize laws, reduce the compliance burden, the setting up of 20 industrial smart cities, townships, or our courage of conviction to be able to offer a corruption-free government. I think all of these and many more measures encouraged the startup ecosystem, the manufacturing ecosystem, the innovation ecosystem. And today, 10 years later, despite 2 wars and 2 years lost in COVID, we have been able to maintain the manufacturing momentum as the economy grew by 90% during this decade. We have also grown manufacturing and doubled it so that our share of manufacturing is maintained. And going forward, given the strong macroeconomic fundamentals and the collective commitment of domestic and international investors, with the government handholding them, we are very confident of taking this up in the Amrit Kal to contribute significantly to the making of Viksit Bharat, a developed and prosperous nation by 2047.
Right. I would also like to ask you, sir, currently the share of manufacturing in our GDP is 17%. Now, when it comes to the next 5 years, what is the big idea or manufacturing push that we can expect from the Indian government?
India is increasingly being recognized as an important partner for high-tech and emerging technologies. In fact, I have just come in, and my apologies, got a little late, but we were at a space center, and our Indian startups, our Indian in-space agency, and our ISRO facilities collectively are offering a very, very compelling case to promote manufacturing in India for the space requirements of the world. Similarly, towards sustainability, whether it's the equipment required for green energy, whether it is the promotion of sustainable products like green steel, they are looking forward to India's contribution in a very big way. So much so that today, the Indian manufacturing provides an immense opportunity for the developed world to partner with India so that they can make in India using the technologies and innovations that they have developed. Making in India will help them produce at scale and benefit from the economies of scale, will help them get the best of manpower talent, manpower skills, management capabilities, so that they can run efficiently. It also offers them the possibility to export from India at competitive prices. In a way, the 4 Ds, decisive leadership of the government led by Prime Minister Narendra Modi, huge demand of 140 crore Indians aspiring for a better quality of life, the demographic dividend with a young population, 2/3 of our people in the working age expected to remain young, and the advantage of a vibrant democracy, the rule of law, which safeguards their interests, their security, and stability of policy and predictability of government action. All of these make for a great trust to international collaborations on manufacturing.
Sir, the Prime Minister has just completed a very successful visit to the United States, And as a result, we are looking at a watershed agreement in semiconductor manufacturing with the support of the US military. How do you think this relationship is going to lead to more manufacturing in India across sectors in the next few years? Any key sectors or any kind of investments that you can indicate to us which are going to come out of this visit to the United States?
Parikshit, the Honorable Prime Minister deserves kudos, and I congratulate him for a historic visit to the United States of America, the Quad in Delaware, the engagements with the CEOs of Fortune 500 US companies, the Modi and us, Modi and US event in Long Island. It's truly been a phenomenal visit, successful in the outreach. Mr. Modi has clearly emerged as the tallest world leader today, the most sought after, and somebody who is looked upon for his leadership, for his vision, and for his guidance to solve geopolitical problems. During this visit, he has also participated in witnessing our joining the IPEF pillars and the overarching agreement, and also had extensive discussions around emerging technologies, the semiconductor mission that we are focused on in India, and broadly, the visit is going to set the agenda for promoting partnerships between US companies and India to increasingly source from India, to increasingly set up facilities for modern contemporary manufacturing in critical sectors, emerging technologies, sustainability, and I'm very confident that as we are increasing our supplies to very high-tech companies like Boeing, Micron, designing and producing for the best of companies in the US, supplying critical components for their important missions, the space technology collaboration between the two countries in several areas. The United States and India stand together to work as strategic partners and work together to serve the
I would
world.
also like to ask you, sir, President Biden has imposed very high tariffs on a range of Chinese products, including electric vehicles, where the tariffs are going to be as high as 100%. Trump has promised to increase tariffs to up to 60% on Chinese products if elected. Considering that the India and US are working so closely together, do you also consider tariffs on Chinese products in order to boost Indian manufacturing, local manufacturing?
Parikshit, that's a decision which we will take after due consideration of all aspects. As of now, I can assure you that Indian manufacturing stands on its own legs. Indian manufacturing is competitive, offers comparative advantages to other nations. And as I said, with the large demand, you can get economies of scale from the domestic requirement, as well as once you overlay that with international demand from friendly countries like the US, Europe, Australia, the ASEAN region, or Japan and Korea, Russia, I think we have immense potential to promote manufacturing. Decisions around tariffs are taken in consultation with all the ministries and taken at the appropriate level.
Now, when it comes to the China +1 opportunity, countries and companies have been saying for the last 5 years that India's time has definitely come. But considering our disturbed relationship with China, would you consider, Minister Goyal, any changes in our policy vis-a-vis China in terms of allowing investments in manufacturing via the automatic route?
There's no such proposal at all. And we have a framework in place for any Chinese investments. and they will continue to have to go through that framework.
All right, on that note, we take a short break, but don't go anywhere. This conversation with Commerce Minister Piyush Goyal continues on the other side.
क्योंकि हमने इस सेक्टर को आगे बढ़ाने के लिए पॉलिसीज बनाई, हमने मेड इन इंडिया टेक्नोलॉजी पर काम किया, हमने सस्ते डेटा पर मोबाइल फोन मैन्युफैक्चरिंग पर फोकस किया। आज दुनिया का करीब करीब हर बड़ा मोबाइल ब्रांड मेड इन इंडिया है। आज भारत दुनिया का दूसरा सबसे बड़ा मोबाइल मैन्युफैक्चरर है। एक जमाना था मेरे आने से पहले जब हम मोबाइल इंपोर्टर थे, आज हम मोबाइल एक्सपोर्टर बन गए हैं। आपको एक शब्द याद रहेगा,